Good evening, viewers. This is your tutor, CPA Cafe Charles, and today I'm going to be taking you through cost and management accounting. This is going to be an introduction to cost and management accounting. And in this video, we are going to be looking at the definition of cost accounting, the benefits of cost accounting function, the objectives of cost accounting, the factors influencing cost accounting system, features of a good costing system. Then we look at the management accounting. I've separated these two because I want you guys to take a good analysis of each item within the cost accounting and the management accounting. But at the end of the day, I'll give you the relationship between the two, and from there we can combine those two terms and we proceed as in when they are combined. But as for now, I give you the management accounting as a bit separate from the cost accounting concept. So when I give you the definition of a management accounting, I'll also give you the benefits of a management accounting. Then I give you the limitations of management accounting. From there, I'll give you the relationship between the two, the management and the cost accounting concepts. Having seen the relationship, we shall look at the differences between cost and management accounting and financial accounting. Then we look at the users of accounting information and the ethical requirement. And in this video, I hope to make sure I handle only the introductory part so that you get to know the concepts which are used in there. So when I reach the ethical requirements of a management accountant or cost and management accountant, then I will stop there and we shall link up when I drop another video, which will start from the cost classification and cost behaviors, because I've separated the cost classification different from the introductory part, just because from there, if I just mix it with the introductory part, you'll get a bit confused. That's why I'm making it a bit different. So when I'm posting another video, just know it will be starting from the cost classification and cost behaviors. So allow me kick off as we have agreed. I'm going to be starting with the definition of cost accounting. And we said cost accounting is the branch of accounting concerned with the determination or ascertainment and allocation of costs to the products or services for decision making. When we talk about the cost accounting concept, the idea is all about how we know the total costs of production on the goods for the manufacturing firms. We want to find out how much have we spent on production of those commodities we are going to be selling. So the whole idea is about ascertainment of costs only. And that cost, you can get it as in a cost per unit, whereby you make it for one unit of item, or you can get the total cost as in a whole for the items produced. And why are we looking at this information? We want to give it to management so that they can use it for internal decision making. And that internal decision making is all about determining the profits we are supposed to get on the goods we have produced, the selling price, controlling costs and planning, all of that, as we are going to be seeing when we look at the advantages. So you can also determine a cost accounting as the branch of accounting for cost classification and analysis of expenditure, as will enable the total cost of any particular unit of production to be ascertained with reasonable degree of accuracy, and at the same time to disclose exactly how much total cost is constituted. As you know, when you are a management accountant, if you just tell the management accountant that the cost of, let's say, producing an item, let's just use an example here. If you want to if you want to say that the cost of a book is 5,000 Ugandan shillings, then the management accountant will not be contented with that information. The person wants to know, yes, if it is if the cost is 5,000, what constitutes that 5,000? Then you start breaking it into the raw materials that is included in that 5,000. What is the cost of it? Then what is the cost of labor? What is the cost of other expenses we've incurred, which are directly connected to the production? So when you just give a block figure that the cost of a book is 5,000, someone will not be contented. Maybe for these other people who don't do the analysis. But these management accountants, when you tell them that the unit cost is this, what they want to know, can you break it down? And you give the components that this portion goes to this item, and this, depending on the materials that are involved in the production of that unit of a product. That's all about. And when you try to look at how they are really concerned about this cost accounting information, is finding the total cost of an item. So that's how I can explain about that. We can go ahead and talk about the benefits of cost accounting function. When you try to find the total cost of an item, what will that help us? We said you get that information and you give it the management. Then what will that information help to different stakeholders or different people who may need that information? So we said when the cost accountant prepares that information and gives to the management accountant makes decisions for the day-to-day running of the business or the short-term operations of the business. The first benefits we say it allocates. Now we are talking about the cost accounting function. Having determined the cost, now we are trying to look at the advantages of determining the cost of a product. First one, it locates the exact causes for decrease or increase in the profit or loss of the business. When we talk about determining the increase or a decrease in the profitability of the business, here we are talking about when you try to find out the costs which are involved. Why is the business making a loss? For a business to make a loss, it means the total costs incurred in the production of the income, the total costs incurred in the period exceed the income they have received in that period. So if you try to find out the costs that you've incurred, that one will help us, that it will help us to know whether the company is going to be making a profit, because at the end of the day, after determining the cost you've incurred, you can just put a profit component on the costs so that you determine the selling price. So it may happen that when you've incurred more costs, and since the price most of the time is determined by market forces of demand and supply, or in the market, in the current situation, the prevailing prices in the market, you may find that you cannot increase the price just because you have incurred more costs, which makes the company to incur losses. Because at the end of the day, you may increase the price simply because you have incurred more costs, but that selling price you are incurring, it cannot be found in the real or the prevailing market situation. So from there, even if you had incurred more costs, you have to sell with the price in the market, of which will result in a loss. So when you find out the costs incurred in the production, you may either know that this investment is going to be a bit profitable, or it's going to be in a loss whereby the costs are either high or are low. So from there, the cost accounting function helps us to identify the unprofitable products so that we can eliminate them out. Having known that on this product, if I'm to produce this product, I'll be incurring more costs, which will make me earn less profit or necessarily getting losses. Then you can eliminate that product and you produce the goods which are less, where you can incur less costs. In the end, you will be able to earn more profit. And that one is best mainly when you're doing the capital investment decision, or you're appraising the investment ventures. The other thing you can talk about, it reveals or discloses profitability and unprofitable activities. That's the same way as I explained that when you know the cost, you can know how much you're going to be getting from the profit, from the items you produced. Said it reviews or disclose profitable and unprofitable activities. Those points are a bit different with the first one. The first one was about a product, but this one is on the activity. Because you may find when you're producing, let's say, when like companies which are dealing in multiple products, you may find that, let's say for Coca-Cola, producing Minute Maid is a bit expensive than producing these other types of sodas. So when you deliver that information to the management, they will find out how to control the costs so that they can be able to make profits. The other one is on product. But this one, for the activities, you find out that some business ideas, they are not viable, to the extent that even if you want to invest in some money, it is too risky for you to put in your money, whereby you'll be making losses. So you can easily identify. How can you identify that? By first knowing what are the costs incurred, or what are the costs which are likely to happen. We said losses or inefficiencies occur in any form. These inefficiencies, you can talk about them in terms of labor when you're managing manpower. There is a point that when you can, this manpower, it can be, let's say, if there is labor inefficiency, when the workers are not working to their expectations, like when, let's say, there is idle time. Idle time is employees are paid but they produce nothing, and it can be either due to normal idle time, whereby the causes for labor not being productive is not necessarily about the employee, him or herself, is about the organization or other factors which the employee has no control about. Like if, say, there is a machine breakdown, the person cannot work just because there is a machine breakdown. That brings about a normal idle time. But there is also an abnormal idle time, whereby the employees, they would have been working, but just because of these avoidable causes have happened and people are not working, not necessarily that they cannot work, but since if they had taken a good precaution, or the supervisors had taken good precautions, they could be ignoring those wastages of time. Like, let's say someone is resting because the customer orders are not there. Someone is resting because raw material is not there, is not enough. So those are the things whereby someone, you can even, when you're using cost accounting, you can determine that this person has been productive depending on the number of units we produced, or depending on the number of hours someone has worked. The other benefit, you can talk about costs, stable data and information to the management to serve as a guide for decision making. This is very clear because when the cost accounting provides information, let's say about the cost of a product, and that information is given to the management, that's where management starts, because the management accountant cannot do anything when the cost accountant has done nothing. You have to first present what you've got as in terms of the cost, so that for them they can start from there and they start taking actions, whereby in these actions they may be taking decisions to make profits, decisions to control the costs, because after knowing that this producing this item is going to cost us this amount, someone can say that it's okay, since I've known this, let's try to eliminate some of these costs, some of the costs which can be avoided. Let's try to see how we can deal when you are reducing these costs. That's all about cost control. So we can talk about the cost accounting information is useful for price fixation purposes. In this, if you get the cost of, if you have computed the cost of the output, you can easily know that the selling price of the items, because if you know how much you've incurred in production of a certain commodity, it will be easy for the management to set the selling price, whereby they can just apply, let's say, markup, or they can set a margin depending on which system they base on to determine their selling price. But not forgetting that the selling price is always determined by the prevailing market conditions. As you know, in economics, how prices are determined. Most of the times it's not all about the costs you've incurred, but at least that one help us, it help us, whereby it becomes a basis for comparison, whereby you know the cost you've incurred in the production of a certain item, you can set your own selling price, then you compare your company selling price with the prevailing market price. By doing so, you are trying to find out, was it very effective for the company basing on the costs it has incurred in the production of that commodity? If, let's say, the selling price set by the company itself is, let's say, not more than what is prevailing in the market, because at the end of the day, if you incur high costs and you want to put a profit component on it, and it results into a high selling price which is more than what prevails in the market, then you are at a risk of not making any profit, even if you are producing goods of a better quality. So you're making the costs. That's why the cost accounting function is very, very, very crucial in the production process. So that, because the price is already there in the market, so the main objective is all about minimizing costs, so that when you set the selling price, doesn't necessarily vary abnormally from what is really existing in the market. That's how the costing information helps in the fixation of prices. The other thing we can talk about, cost accounting helps in cost control through establishing budgets and standard costs. Of course, as you know, these standard costs, those are the predetermined, you determine the price in advance. Let's say when you're doing a forecast, you can say that I'm expecting to incur, let's say, 10 million in production of a certain item, but when you go ahead and produce the item itself, you compare with the actual costs, then you will find out what is the variation. Is it high or is it lower than what we expected? And what are some of the control measures we can use to control those we've incurred? If, let's say, I had planned to incur 10 million, and in the actual production I find out that I'm incurring 15 million, you'll find that variance or that deviation of 5 million, I'll try to look into my components which made up the cost of 15 million, and I see how I can minimize some of the costs. Some of the reasons you may find that, let's say we are deploying that we are going to buy materials, let's say raw materials of 5 million. And when we reached in the market, since we had some increment in the prices because of the inflation, prices went high. So with that, it made us to incur more than we expected, or we reached there in the market, but we have incurred more transport costs. Yes, the price we said the price for materials to be 5 million, but we've incurred more transport costs to transport the raw materials to our place of work, which increased the total purchase price, hence making a difference. So those are some of the reasons why having a deviation, and what we are trying to look at. Then the corrective action will be, if yes, we've incurred high transport costs, but this was okay, can't we get some raw materials of the same quality, but we get them at a place which is near to our premises or where we are operating from? Those are the things which the management accountant starts to work on, and they find resolutions for those deviations in the costs between the planned and the actual. So the other thing we can talk about, the operation of a system of cost audit in the organization prevents manipulation and fraud, and assists in furnishing correct and reliable costing data. Because if you have the costing system, the costing function, if it is also hard for these companies to set this costing function, whereby you find the companies having a cost accountant, is having a financial accountant, is having also a management accountant, it's a bit costly. So if those systems they exist, first of all, we are doing audit. We audit ourselves to the extent that what the financial accountant has provided and the cost accountant has provided, the management accountant has to review that. By reviewing that, you are removing the manipulation which could have been done by the cost, by either the cost or the management or the financial accountant. You try to rectify, and you say, this amount I've seen, let's say there are some arithmetical errors, because those ones they may happen by adding or subtracting. You find the figures and there is a mismatch somewhere. So there is an audit. The information is audited within that process. So by doing the audit, it gives you a reliable information, whereby by the time the management accountant makes a decision, you find out that that information has been based on the rightful information. Then the other benefit of accounting function, we can talk about valuation of stock. Valuation of stock through establishment of costs by using different techniques of financial statement, various techniques for financial statements purposes. Because when we know the cost, having known the cost, because we said the cost accounting is mainly determination of cost or cost ascertainment. So what we shall use those costs we've generated to make other financial statements like the income statement, because as we said, these statements are measured in monetary values. So when we know the cost, we can easily transfer to our income statement and we'll try to find out the profit we've incurred. We can also generate our balance sheet, because when we determine the stock, part of that stock is going to be in the balance sheet as inventory or stock in our current assets. So those are some of the benefits of the accounting function. Allow me proceed to the objectives of cost accounting. I want to explain something on the objectives. When you find a question is asking about the objectives and the question is talking about the benefits, the answers are the same, but the way you give out to them is different. but the explanation is always the same and the points, they are the same, but just rephrasing them. I found it necessary for you to give you at least these two items so that you can be able to get the difference and how to phrase them. Because I've given you few, but I know you can get as more points as you go search on your own. Me, I have been picking out the basic ones. So the first objective, ascertainment of cost. Cost ascertainment is cost. If someone asks what is cost ascertainment, it's just an accumulation or a summation, the costs which are incurred in the production of an item. So one of the objectives of cost accounting is cost ascertainment of costs, determining the cost of a product or service or any activity through cost accumulation of different cost elements, meaning these cost elements, they are the cost component, what makes an item. Those are the components, those are the elements. So it is when we are determining the cost ascertainment is the process of determining the cost of a product or a service through cost accumulation of different cost elements, which include the material cost, the labor cost, inventory, the overhead costs. Those are some of the costs which we incur in the production. The material, labor, overheads, they are also direct expenses or other expenses which are incurred, but these are the few we can talk about. The other objective is determination of the selling price. We said that when you are determining the cost, what you want to look at is the cost, so that we can put a profit component by using either a markup or a margin, or depending on whatever scenario they use to determine their selling price, so that we can know the profit we are going to make on producing a certain product. So through the selling price of a product is influenced by, this one is supposed to be, though the selling price of a product is influenced by market conditions, as I said earlier, which are beyond the control of the organization, it is possible to determine the selling price within the market constraints. What this one means is that, yes, it's true, the selling price is always influenced by the market forces of demand and supply, as we said, or the conditions prevailing in the market, of which the company has no control about. Those are the factors affecting demand and supply, as you mainly demand, as you know them. That for you may say, me, I'm setting up a price. Let's say I'm setting up a price which is higher than what the market is having, but you may find that people will not buy, just not because they don't want to buy, but the money is not there. The consumer income or the taxable income or the disposable income is not there. So those are there are some factors which affect the price. And most of the times, for us, our aim as an organization, we are aiming at minimizing the cost, so that when we minimize our cost, we just know when we set our own selling price, it will not, even if it differs, but it will not be of a large extent to that in the market. So that's it. The objective of cost accounting is in costing, determination of selling price. The third one, we can talk about cost control and cost reduction. You are seeing we are talking about cost control and cost reduction, meaning we are aiming at reducing the costs of production. Since costs of products or service are predetermined, they always compared with the actual to monitor cost performance. To exercise cost control, broadly speaking, involves the following steps. That's when you are going to control the costs. But what we are aiming at, we are aiming at the reduction of those costs. Even if you find out that you've really did it to the minimum, someone will say, is there any other option where we can reduce it further? Are there some avoidable costs which we can avoid so that we can incur less than what you are saying is minimal? So let's look at how we can control the costs. First of all, we have to determine clearly the cost objective. The cost objective is a reason why you are doing something. If let's say you are engaged in production, what do you want to? If you are producing, let's say, soda, what are you really looking at when you try to sum up these costs you are incurring? We are trying to look at the cost. So our main point, our main issue here is about cost. So it's like let's say if you're a student and you are incurring some costs, let's say tuition, what. The reason why you are paying tuition is because you are paying tuition to pass. The main objective is to pass and score highly. But scoring highly, there are certain things which you go through for you to score highly. That's the cost objective. That one we shall look at it when we go to the cost behavior. I will explain more all the cost classification there. I'll explain more about the cost, the cost objective, the cost per unit. Those ones I will explain more. But to give you a brief view, that the cost objective is the aim. Why are you doing something? Because having known why are you doing something, why are you studying cost accounting? I want to pass, but passing is the cost objective, but there are certain cost units and cost objects which you are supposed to incur, or there are certain things which are there which makes you to reach to that point. So we said determine clearly the cost objective, i.e., or that's to say the predetermined desired result, what you really want to achieve. The second thing is that you measure the performance. Yes, I enrolled for CPA and I'm doing a course unit of cost and management accounting, and I aimed at, let's say, getting an 80%. If you aimed at getting 80% and the final results comes and when you have 85, or if you have 75, then for us, what we are interested in, we are interested in something. What caused that deviation? If you planned to incur, if you planned to score 80%, but you goes ahead and you score 80%, what are the causes, or what made you to, what are the things you did that made you to go above what you had planned? And if you don't reach what you had planned, then what are the things that made you not to reach where you wanted to be? That's all about the cost control and cost deviation. For the student, you are aiming at scoring highly, but for the company, we are aiming at not reaching where we've set. Let's say we were expecting to incur 10 million, but our main focus is how can we produce below the 10 million? Not to the extent of making poor quality items because we want to reduce costs, but we maintain the quality and at the same time we reduce the cost. That's the main emphasis. So when you measure the performance and you find out there is a deviation, either high or low, then the other step is to investigate into the causes of the failure to perform according to the plan. Failure to perform according to the plan doesn't necessarily mean that you're supposed to be below, even if you are above. Now for the case of the organization, we always want to be below, but you may find when you have gone above what you had planned. So for the student, you can even talk about, I did more research on my own. That's why I above what I had planned. So even the organization may find that they have bought goods, let's say from a different supplier, and that supplier charged them a higher cost, or they may be giving those items at a low cost, but they are of low quality. When goods are of low quality, when you go in the manufacturing, they will be consuming a lot of raw materials so that to produce something of a quality. If you are incurring something at a less cost, you are buying it at a less cost, but it is costing you to the extent that you are buying more than what you would have bought. That's also a deviation. So what will be the next step is to institute collective corrections or actions. You take actions on the deviations you've seen. If for the student and you see, I aimed at getting 70, but I got 65, then what made you to not to get the 70 you wanted? If you see that maybe at this particular point or at this particular point in my revision, I relaxed somewhere, so next time you improve. That's the same way we deal with the costs. I hope you guys, you've got that concept of cost control and planning. Then let's proceed to the next objective of cost accounting. Ascertaining the cost, the profit of each activity. This happens to, I always base to the capital budgeting decisions or the investment appraisals, because when you're appraising an investment or when you want to determine the net worth of an investment, let's say you can be having the 2 projects, and those projects you try to find out how much are they giving me as in the cash inflows every year. You can make a forecast of, let's say, 5 years time. Let's say they are giving me, if each organization is giving me this amount, as you will know from financial management that there are certain things we do, there are certain methods we use of how to determine the viability of the investment, like the payback period, the net present value, the profitability index. We can determine the IRR, the internal rate of return. So there are so many things whereby you can determine that this item is going to be providing me a very nice return on the investment. So when you determine, because when you are determining, you first of all determine the cost you are incurring, then you compare what will be the inflows, what will be the money that will come in, the forecasted cash flows for different periods. Then you see whether when you try to less them up and you see if they can. So by that, when you determine the cost, you can be able to know that this activity is going to be productive and this one is not going to be productive. So we can, here they are saying the profit of any activity can be ascertained by matching costs with the revenue of that activity in order to determine the profit or loss of any activity on the objective basis. Of course, when they say the objective basis, let's say you are choosing this investment, you know what you want to get from that investment. So from that investment, you compare what you are going to be incurring. After comparing what you are going to be incurring, you also try to project how much you are going to be getting. Then you know the net worth. The next objective is we can talk about assisting management in decision making. That one we talked about the decision making. That one we talked about. Allow me proceed to the next slide, which is about the factors influencing cost accounting system. We have the cost, the company may decide to put in a cost accounting system, but there are so many factors which affect which accounting system to be installed in an organization. Some of them, we have the size of the farm. If the farm is very big, you expect the farm to be handling so many departments. you expect the company to be having so many activities, to the extent that when you're bringing a costing system, it should be catering all the things which the company deals in. So the complexity of the costing system depends on the size of the firm and management requirement. A large firm has to develop a large volume of cost data regarding activities of various departments of the organization or of the firm. As I said, these firms which are big, they have so many departments which they handle, and each department is using a different software, or they are using a different system, because the system which is managing payroll cannot be, or the program that is managing payroll, you may find it is different from that which is within the production. So when you are to install a cost accounting system, you should also take into consideration what the company is dealing in. If there are so many items, you should select an accounting system which will be combining whatever the company is dealing in. That's point number one. Secondly, we can talk about the manufacturing process or methods. What are the various methods the company is using? Because you may find that the way how the organization is arranged, or the production layout of the organization is different, to the extent that some accounting systems are already rejected from the way how the organization is arranged. You may find that, let's say someone is having an accounting system which is a bit specific to certain items, but you find in the organization where you want to install it, that system is not, that specialization is not even there. They are mixed up with other different departments, and of which the information which comes from that department is supposed to be recorded. And so if you find that some systems cannot hold certain things, then you have to look for a system that can embark all the activities done within the organization. You may find that even someone can say, me, I'm bringing a system that is going to be operating, let's say to staff, depending on how they are going to be coming in and how they are going to be working. So to the extent that you find that the organization has its policies inside, whereby you may find that some employees have to go for, let's say, for a rest, but the other machine will just be computing the time, whether the person is not working or whether the person is working. So that's how you should also look at how the manufacturing process or the methods they use in the production. You may find even the production capacity for you want to install a system which can be working from Monday to let's say Monday to Friday, 24/7, but the machines you have in the organization cannot operate without getting rest, to the extent that if you want to make them work, they cannot produce the items you want, because some machines you may find, when they are fixed, that they can produce 10,000 kilograms a day or 10,000 tons per week, depending on the capacity of the organization. So when you are bringing the accounting system, we should also take note of what items, how the organization is internally organized, the internal control system. You should be considerate of it. When you bring something, it must be of a fit to what the organization process or plant layout and other processes are working. So the other thing we can talk about is organizational structure. It must match the organizational divisions divisions of authorities so that individual supervisors can be accountable for costs incurred in their respective department. This is what I was talking about, that when you have when you're organizing to have an accounting system, you should look for that you should look for that system which gives the heads of different departments authority to the extent that they are the one who's monitoring what these other juniors are doing. So if it's like it should be giving something where the head of the department or the supervisor can reach and balance everything. Let's say someone is using the, let's say, purchase ledger accounts. So it should give the supervisor something like a control account whereby the supervisor can just be checking what was posted in the control account, so that to verify what these juniors were doing when they were handling the purchase ledgers. That's how you can talk about those departments, so that by the time the head of department submits, let's say, a purchase figure or a debtors figure, you'll find that it has been already verified in the system. So when they submit for the next department, it will be of good use and it can be of a reliable source, since it can be audited very fast. The other thing we can talk about is we can also talk about the comparison or the comparability, that the system can also be able to give you a comparison of what someone did. Let's say you are using an accounting software, let's say QuickBooks. You should be able to access financial information of last year to compare them with these ones of previous years. So if we are installing an accounting software or system, it should be catering, it should be able to give you a comparison part whereby you can compare this one and the other one for better planning and other budgetary activities. The last point I can talk about, the other one you can search for your own. The other point I can talk about is external factors. The whole of what we've been talking about, they are within the organization, but there are also other external factors which can affect the accounting system we are using. For you may say, one of the external factors we can talk about the level of technology. You may want to install, let's say, an accounting system, but it is already outdated. Let's say we can talk about Pastel. Pastel is an accounting software. If, let's say, an organization want to install that software, it is already outdated. When you reach in the market, it's not there. You find people are having QuickBooks, Tally, Sage, and others. So the technological factor also will affect what you are going to be installing. You cannot just say, me, I want to put Pastel, but when it is already outdated, where will you get the people to run that system? So the system we are installing should be cooperating with the prevailing technology, not giving something which was done, let's say 1900, there are no people even to run it. So also that one, it becomes a factor to the extent that even if you want to do it, but you will not get the people to help you do that. So that one will be a factor that will be also considered when you are installing. Allow me go to the next slide where we are going to be talking about the features of a good accounting system. These features of a good accounting system want to look at how a good accounting software looks like, or what are the components, what are the exits, what are the qualities of a good cost accounting system. Because at the end of the day, the reason why we are installing this accounting system, first of all, we want to do the costs appropriately. to the extent that you are not making any errors. So if you bring a system, also the system matters. One of the qualities is the installation and the operating costs of the system should not exceed its value to the management. Because at the end of the day, we are minimizing costs. If what you are using to minimize cost is also expensive to the management, then how will you expect them to minimize costs? So one of the costs, one of the qualities of a good accounting system, since it is managing the costs to be low, we are expecting it also to be of a low cost. If it is expensive to the management, it's like when these people, when they are doing taxation, when they are collecting taxes, there is always that quality of economy whereby you cannot collect you cannot use more money to collect less money. You should be economical. At least what you are spending shouldn't exceed 5% of what you are collecting. That's when you can be really doing business. That's the same thing. The cost of installation and operation, leave alone the installation, buying and putting it in the system, but also running costs. The people who are going to be operating shouldn't be too hard to the extent that people cannot even, it will need again more people to handle it. That's what they talk about. Then the other thing, it should be practical. Must be designed to suit the business and helpful to the business. It must be practical. Why? Because there are some system, people say, we have a system in our organization, but the system doesn't function. It is there, but it doesn't add you any value to the company. So when the accounting system is there, it should be of help. It should be giving you more versions of how you can deliver what you want to achieve. Then the other one, we can talk about the cost accounts and financial accounts should be arranged in a way that the results of a set of accounts are reconciled by means of control account. This is what I talked about, that when let's say you are designing the costing system, it should be having a verification point where someone can go and verify what he or she has been doing. Because there are some systems like QuickBooks, you can assign, the administrator can assign other junior staffs to help him or her on certain issues, let's say tax, payables, receivables, managing. He can assign you and gives you rights to those particular things. But at the end of the day, we need to be having somewhere whereby the other person can just go there to click, let's say, on and prepare a certain statement which can verify whatever you've been doing all the day. In that, it is giving you a summary of what the other people they have been doing, and they are reconciled that what they have done is exactly the right thing that should have been done. So it should be designed to that extent whereby those control accounts, they are supposed to be used by the heads of departments, because those are the ones that determine the costs or that make decisions, or they forward the final result to the next department, depending on the line of organization or the line of management. So the other one must be installed gradually. In this, we mean that a costing system, since it is a system, it is not a human effort. So when someone is introducing the system, it should come on a step by step. You start by introducing a bit of it. You make sure some of the staff, they have grasped the knowledge of how to operate the item, so that by the time you make it wholly, or when you introduce it in full to the entire team, they at least have somewhere to learn to go for assistance when they find some complex stuffs in there. Because if you just bring it and you throw, It gives people panic to the extent that there are some people who are just fixed. Someone has been doing a certain department, and you bring in something new, is supposed to get another training for that, which will be a bit hard for certain people. So when you're introducing the system, it should be gradual, or it should be introduced gradually or on a step by step. The other thing we can talk about, actually, when you're introducing it gradually, when you're studying, like the way I'm teaching, I first do the theoretical part, so that by the time I take you through the budgetary, the master budget, I take you to the standard costing and whatever process costing, you'll be having an idea of what really covered in the course unit. That's how it means. Then the other one we can talk about, it should be properly documented and supported with the application user manual. The reason is, if it doesn't have a user manual, it is hard for some people to learn. So when you're designing a system, it should be having a backup, a study package whereby someone can go and read and understand how certain things are done within the system. Allow me proceed, and I'm very sure I've exhausted the cost accounting. So allow me go to the management accounting. It's not all that big. It is just small, because management accounting is just a continuation of the cost accounting, simply because the documents which are used by the management accounting, the management accountants, are prepared by the financial and the cost accountant. So it's just a continuation of the other one. So management accounting is the process of accounting concerned with the provision and use of confidential accounting information to managers within the organization to assist management in carrying out management function. And remember, we talked about this management function. Those are the selling, setting price, setting, controlling, planning, those things. We said is a branch of accounting concerned with the provision and use of confidential accounting information to managers within the organization to assist management in carrying out management function. As we said, this confidential information is already drafted by the cost accountants and the financial accountants. So this management accounting is a bit broad. It comprises of various aspects. It can be mathematically, it can be statistically, it can be financially, costing. It involves so many items, and those items are the ones the management based on to make a decision, even the tax part of it. So if someone is called a management accountant, you just know that that person is having a broad knowledge about certain aspects, because within the management accounting, the thing is very broad. It's not like the cost accounting, whereby the main point is just a certain cost ascertainment, and for the financial accounting is production of financial reports and that sort. When those ones are done, they just forward the management so that they can take action. So the other slight definition we can give, this involves the process of preparing management reports and accounts that provide accurate and timely financial and statistical information required by managers to make day-to-day and short-term decisions. Why are we saying the short-term decisions? These are supposed to be short-term decisions because these financial statements we prepare, the cost statements we prepare, they don't exceed 1 year. We always make them in 1 year. That's why the management is running those decisions within a short period of time if they base on the information we the financial accountant, the cost accountants will provide. So what are the decisions, some of the decisions they make? One of them, formulation of strategies, planning and control activities of the organization, decision-making, optimizing the use of resources, and safeguarding company resources, and others. There are so many, because we are going to see the benefits down here. The next slide is all about the benefits of the management accounting. We have to see the limitation. From there, you will know the scope or the climax of cost and the management accounting when we look at the relationship. The first benefit, it assists management in formulation of policies and performing day-to-day activities of the business, which management has to take tactical and strategic levels through application of management accounting techniques. In these management accounting techniques, we may be having standard costing methods, budgeting and budgetary controls. Those are the techniques they are talking about. The second benefit, we can talk about the assisting in performing planning and control functions effectively. Techniques like standard costing and budgetary control helps in controlling the operation of the business. As I've said, the standard costing is there. We are using the costs which are the predetermined costs we set. Then we compare with what we produced so that we get those deviations. In all, we can control the operations of the business. I hope, guys, you've got that. Allow me proceed to the next benefit of a management accounting. Another benefit of a management accounting, it facilitates coordination of activities of various departments, hence attaining the objective of the business. As we said, that management accounting bases on the financial statements prepared by the financial accountant and the cost statements prepared by the cost accountant. So there is a connection whereby those two, when they provide the information, they provide it to the management, and management makes a decision, of which that decision, it will again go back to those people so that they make adjustments. So there is coordination within the company. This one, when the management accountants make their reports, they give back to either the cost accountant where they got the information so that they can take up the suggested solutions to the problems they have incurred. It helps in adjusting the economic environment of the business by overcoming the seasonal and cyclical fluctuations with the economic booms and the recessions, whereby there is a time when the company is producing everything at a very nice cost, low cost. It is having a lot of profits, but there is also a time when the company is incurring most costs, and of course, when you're incurring more costs, you expect to be getting less profits. So management accountants, since it is a broad aspect, it looks into everything and tries to control those so that we can be having an optimal or a balanced movement within the production process or within the operations of the business. That's another role of management accountant, because for them, they look at when the company is producing less, what should we do to boost the company? If the company is producing more and we are getting more profit, or we are getting whatever we are getting, how are we minimizing that to what we want? That's the role of management accountant. We can talk about it helps in measuring the performance of business and evaluating the capital investments in various projects. That one I talked about it, but as we've said, you can measure even the performance of the accountant, because when the management accountant goes through the work of those two, the cost and the financial accountant, and they find out that the information, they have different information, because when the cost accountant prepares the information, the cost accountant gives the information to the financial accountant so that they can prepare the receipt. When they give you the production cost, you can add it to the other side of the trading account in the profit and loss. You start to generate the income statement. So if these two, they are not doing well in whatever they are presenting, the management accountant can find out or evaluate how they do. So even on the side of the capital investment, there, the management accountants, of course, they compare according to what to what the cost accountant has given the cost, the financial accountant, what he or she has given as in the profit, then they compare the viability. Because at the end of the day, those are the final decision makers. And the major point you shouldn't forget is that management accounting is all about making decisions. Then allow me look at the limitations of management accounting. And in this, I want you to appreciate, I brought this limitation to the extent that I wanted you to appreciate these two aspects, and you try to get to know the advantage, their scope, as in how far do they go within as far as decision making is concerned, and what can be the problem to that. So let's look at the limitations of management accountant or a management accounting. Management accounting, to a large extent, is based on estimates and probabilities. Thus, accuracy may not be ensured under management accounting. Reason, because what we base on, we are all using the methods they use budgetary control systems, standard costing, whereby they're just using estimates, not exact figures. So if they are using estimates, there is a high chance that what they have expected, it will not happen. Reason, there are some things which they have no control, and for them they are assumed that maybe they will remain constant, and you find that they are not constant, they keep changing. So that becomes a challenge to the management accountant. Whatever information they don't have like the information of their own, they get the information they got from other people. So to the extent, since they base on estimates and probabilities, thus accuracy is not, it is only a tool in hands of management and cannot replace management. It's supposed to be and cannot replace management. Why? This cost accounting, this management system is just a system. If, let's say, this system, for it gives you the correct and accurate information based on the information you have provided. But that system doesn't necessarily replace the people within the management. Yes, the system is there. It is giving you the rightful information, but you may find what is really these people, because at the end of the day, if it gives you this information, it's the system that generates what the management accountant has provided to the system. So you may say that yes, it is a system which does everything perfectly, but it does not replace people. So it is a limitation to the extent that if the management accountant feeds a wrong information to the system, it will give a different information, of which it may be either misleading or depending on whatever the organization wants to achieve. So that's also a limitation. We talk about the management accounting derives information from financial accounting, cost accounts, and other records. Therefore, its strengths and weaknesses depend upon the strengths and weaknesses of these basic records. That's also a challenge. Since these management accountants, for them, they generate the information of their own. They can be given doctored statements and other information depending on whatever they wanted to get from the cost accountant, the management accountant. And from there, they will be misguided and they give a wrong, they make wrong decisions. So the successfulness of a management accountant is based on the success of those two, the management accountant. And if you get one of them is not okay, then you expect that somehow, somewhere, you may find there are some mistakes which may lead even to making different and costly decisions. Because some decisions, like the capital investment decisions, they are irreversible, or they can be reversed at a very high rate. It's like, let's say you commit that I'm going to set up a sugar making factory. If a sugar making factory was one of the business ideas we were verifying, trying to find their viability, and you find that you've incurred the money in purchasing those items which are used in production of that precious sugar, and you find that the business is not, or you were misguided, you got the information, you got a wrong information from the cost of financial accountant, and you cannot reverse. Even if you want to reverse a machine which is used to manufacture sugar, you can't convert it to a machine that can make soda. They are different, and you've incurred thousands and thousands of money. So that's a challenge in that, whereby the strength of the management accounts are as good as the strength of the financial and the cost accounts. Then the other limitation, it is costly to install, and only big businesses can afford. It is hard for companies. It is hard for a small company to be having a financial accountant, a tax accountant, to be having a cost accountant, and at the same time having a management accounting. Having all those people, it is a cost. So these other companies, they end up having only one person, like that they have a financial accountant who handles everything in tax, in cost, in management, and everything. So you find it is only one person, but he or she has been overloaded with so many things, just because the company cannot afford to recruit all those people all those experts who can handle everything on time. So the last one I'm going to talk about, it involves various disciplines like tax, statistics, finance, mathematics. You can add everything, cost. So without those various skills or knowledge, then it's hard to find solutions, because it's also hard and it is very expensive for someone to acquire a person who has a bias in aspects which are within the management. Because at the end of the day, we expect the management accountant to make a decision after considering all the costs, not saying that, we've incurred less costs on this item, so let's go ahead and invest in the money. You may be incurring less cost, but at the expense of other people, or you are not considering, let's say, the public interest or the environment aspect. So all that is supposed to be included within the report that the management accountant does. So allow me proceed to the next one, and I want to talk about the relationship between the cost accounting and the management accounting. There are minor differences between management accounting and the costing accounting, since the former, which is the management accounting, is an extension of the latter, meaning management accounting is an extension of the cost accounting. They are closely linked as they use common basic data and reports to a significant level, because we said the cost accountant stops at the point when he or she finds the cost of production. But for the management accountant, goes ahead to the point of determining the selling price. So the cost accountant is to the significant level of cost determination. Then the other one to the maximum level of selling price determination. In accounting, primary emphasis is on cost. In cost accounting, primary emphasis is on cost ascertainment and control, while management accounting utilizes the principles and practice of financial accounting and cost accounting, in addition to other management techniques for efficient operation of the company, e.g. statistics, mathematics, economics, laws, etc. So I think you've got the relationship between those two. This cost accounting, you can call it, process-wise, you can call it that the cost accounting is an input to the management accounting, because what the cost accountant does becomes the output of the cost accountant becomes the input of the management accountant as far as their duties are concerned. So allow me proceed to the next slide, where I'm going to be talking about, since we've known the relationship between the cost and management accountant, then we can combine them. And since we've seen there are few differences between the management and the cost accountant, so we are going to combine the cost and management accounting. We compare it with the financial accounting. At least the financial accounting and these two, they have a very big difference in terms of the way they are prepared, in terms of the number of users, in terms of the documents they prepare, and in terms of the period of preparation of those statements, in terms of the legal requirement, in terms of so many things, as we are going to see. Financial accounting, then the cost accounting, the cost and management accounting, because under cost accounting, stock is valued at cost only. But in financial accounting, we may find we are not only computing the cost, because when you remember when you are trying to determine the financial statements, we consider the cost and we also consider the price, because we have to determine the sales, of which the sales will get the units sold times the selling price to get the sales. And to get the cost of sales, we use the costs. So we use the costs we got from the cost accountant to determine the cost of production. There is a difference. Here in stock, stock is valued at cost or market price, but the other side, stock is valued at cost only. Why? Because we are producing our own goods. We are not buying them from the suppliers. In financial accounting, financial statements are reported in a specific formats, so that different organizations can compare. In financial accounting statements, we have a format, how we prepare, format for companies. We have the format, how we prepare, how it's supposed to be looking like, and it's a requirement by government to prepare those statements in that format, which is not the case with the cost and management accounting, because with the cost and management accounts, we just use them within the organization. They are not published outside. That's why we can use any format we want, which is not the case with the financial accounting statements. Under financial accounting, the information is used by both internal and external users, whereby we can give it to customer, we can give it to shareholders, we can give it to even the employees, the general public, the government. But this cost accounting information, they are used internally by internal users. The employees can view it, but most of the times it's used by the management and the shareholders. Sometimes even the shareholders can try to have a look, but most of the times it's used by the management accounting, just to run the day-to-day running of the business, the operations of the business. Then we can talk about the legal requirement. Financial accounting statements they are required by law, which is not the same way for the cost and management accounts. Management accounts, you just prepare them as and when they are needed. It's not but for the financial accountant, for the financial accounting statements, you have to prepare them every year and they're supposed to be published. Under financial accounting, the focus is on historical information. We said as per the historical concept in financial accounting, we said we base on the cost of the item. The purchase price of the item becomes the cost of the item forever. If you bought an item of 10, let's say 10 million, and next day the price goes to 12 million, we only consider the 10 million as the historical costs. And those are the ones we put in our statements. But for these management accountants and cost accountants accounts, for them, we just, since we are preparing future, we are making forecasts, we are making estimates, we are making predictions. We just base on the future costs or the present value, the present costs. Because if you want to know the deviation or the variation between the prices of different commodities, you will have to use the current and maybe the future. You predict the future or what was there as the base period. Then the last one, we can talk about the disclosure. In financial accounting discloses financial information and the positions of the company. What we are looking at when you are preparing financial statements is that we want to know the profitability of the company and how the company stands, or the net worth of the company. Then for these management accounts, for us, we want to know the information so that we can give it to management and we make a decision, and that's all. So those are the differences between financial accounting and cost and management accounting. But don't forget that when this information, anyway, I'm going to talk about it when I got the users. The next thing is the users of accounting information. I was saying the accounting information, before we talk about the users of the accounting information, there's something I want you guys to take note, because sometimes you may find that this thing will be a bit of help when you find, let's say, some scenario question, to the extent, because they may ask that this information, what will be the quality? What are the qualities of this accounting information? I did not make a slide about it, but I can talk about it briefly. Because this accounting information, we need to know the quality we are giving before knowing the people who are going to use. But these are the ethics we can, or the characteristics of the accounting information. We should provide that accounting information on time, meaning the first characteristics is, or the quality is, time or timeliness. We should provide that information as and to when it is needed. Let someone, not giving someone something, someone is asking for a financial statement of this year, you give the person after 3 years. It doesn't make sense. The information is supposed to be timely. It should be complete. You should be having everything. It should be complete. It should be relevant. I'm asking you financial statements of this year, you are giving me financial statement of 2 years, or you're just giving me a different statement. And there are so many others, the completeness, concise and precise. You can talk about them, but they are hard to be set at this level, but I want you at least to get a highlight about them. So we go to the users of accounting information. When you are defining these users of the accounting information, make sure don't stop at the user, him or herself, but go ahead and find out what that person wants for the statements they're asking. I'm repeating, these users of this accounting information, we are not interested in the users themselves. We are interested in what do they want when they say we want to see this. Let's say we want to see the financial statements. What do you want to see? That's exactly the point. So these accounting users, we have the owners and investors. I'm just to give you like 4. The rest you can look for the information and you add there. Owners and the shareholders, stock the investors, stakeholders of corporations need financial information to help them make decision on what to do with their investment, either to sell or hold the business. The business owners use the information to determine if the business is profitable or not. As we said, for these stakeholders, these are the people who provide money to the business, or the people who lend money to the business in the form of buying shares. So for them, they want to know if the company can sustain them by providing them dividends on their investments, or the company cannot provide their dividends, so they make the decision whether to quit or to stay in the business. These business owners, we said business owners, they are the ones giving money to, or the owners of the business. They are the ones giving money to the business. So for them, they want to know, is this company really making profits or it doesn't make profits? So that they also make a decision whether to sell the company or to change into another line of business. The other one, we can talk about the management. Management, as we said, whenever we talk about the management, just know we are talking about the decision makers. So whenever we talk about the management as the users of accounting information, what really do they want? They want information to help them make decisions on the day-to-day operations of business. The third thing, we can talk about the financial institutions or lenders or banks. These are the people who give businesses credit facilities or credit assistance. What do they want in this financial statement? They want to know our credit worthiness. Are we making profits that we can be able to pay them, or we are not making profits, we are just making losses? The other one we can talk about, especially the tax authorities. For them, what they want is whether the company can be able to pay the tax in time and an appropriate amount. The other one we can talk about the customer. Those are the people who buy goods who buy our goods. So they want to know whether we can give them goods on a low price, or we can be able to give them discounts and others. We can talk about even the general public, where the general surrounding of the business, where the business is operating. Are you not polluting the environment? Corporate social responsibilities and others. We can talk about the employees and creditors. Employees, for them, they are interested whether the company is making profits, so that they are sure of the job security and the company is able of paying them the money, their salaries in time and in the rightful amount. Allow me proceed to the next slide and talk about the ethical requirements of management accountants. And this is where I'm going to stop. When I wind up this ethical requirements, that's where I will stop for today. And as we discussed in the beginning, the ethical requirements we are talking about, these management accountants, first of all, they have the professional bodies that govern them, how they do their activities, or these are like the responsibilities, the way how they do their job, the do's and don'ts set by their professional bodies which are governing them in their way of operation. What they should be following when they are executing their duties. One of them will have competence. Competence, we are saying, maintain an appropriate level of professional competence by ongoing development of their knowledge and skills. We can talk about it in performance, or perform their duties in accordance with relevant laws, regulations, and technical standards, or prepare complete and clear reports and recommendation after appropriate analysis. So that's what we expect from them. We expect when they are doing their duties, when they are executing or when they are making decisions, they must be professional. It's better you call a spade, not calling a spade a spoon. That's when the company is making losses, say it that the company is, for this financial year, it has made a loss of this amount. Not again doctoring the information and you start giving the information the other way around just because you have some interests you are saving or the personal interest you are providing out. And when you're giving out that information, there are certain laws. You are not supposed to do this. So are you really up to that extent? Then are you giving the recommendation as exactly as they are supposed to be given? If let's say the company is making a loss, or you have reviewed the, let's say, the cash budgets, and you are seeing in, let's say, certain months we are operating in negatives, and to the extent that if you forecast that we are going to be having negatives, there is no operation which can be negative. So you have to give a recommendation, and that recommendation, you should not just give a recommendation. Let's say we acquire some money which can finance our operations for those periods. You should also assess the way are we supposed to get the money. Is it by loan? If we get a loan, is it of a help, or it will add another burden to us? So you look through everything and you make a final decision which is reliable. That's what they mean by competence. The second one, because there are only 4. The second one is confidentiality. Inform subordinates as appropriate regarding the confidentiality of information acquired in the course of their actions, and monitor their activities to acquire the maintenance of that confidentiality. You are not supposed to issue information to any person who is not entitled to that information. Are you doing it? If, let's say, this information is not supposed to be given to the public before the top management views or review everything, are you not giving it out on your own benefit? So those are the things. Are you making the information you are getting to be that someone can trust you with whatever information they have authorized you to handle? That's what they are talking about when they say the confidentiality. The third one, we can talk about the credibility. Credibility, we can talk about it in terms of communicate information fairly and objectively. You communicate the information, but the information is as per what you want to achieve. The fourth one is, we can talk about it in avoid actual or apparent conflict of interest and advise all appropriate parties of any potential conflict. Refuse any gift, favor that would influence their actions. Because when you are making certain judgments, you may find that instead of saying that we are making losses as per the financial statement, but because you have to save certain people or someone has told you to report this and this and this, then you go out there and you start giving a wrong information just because you have interest or someone has given you something to say something about, which is not exactly the truth. So I will leave you to research about the resolutions of ethical conflicts. These ethical conflicts, those are the ethical conflicts. They result as a result of the absence of the ethical requirements. If someone is not capable of doing the information in a rightful way, then you just know there is ethical conflict, whereby the person cannot give a fair view of whatever he or she is reporting because someone wants to bribe. You cannot keep the information. Someone wants the information from you and is bribing you or threatening you to give the information by force. Those are the ethical issues, then how do we resolve them? That's what I want you guys to go and search about. Because when you're resolving, like if someone is giving you bribe, what do? You can report to the supervisor. Maybe if the supervisor is also involved, then if the supervisor is involved, you don't, because you can't report someone who is also threatening you to a certain level. But if you try all other ways of how you can resolve the conflict and you see it cannot end, because the reason why these ethical conflicts they come in is that their results or your actions may be, because when you perform something, if let's say you are the head of a department and you are threatened to sign some documents which you don't even understand, which you have not read through, any circumstance or any result that may come out of that action is held to you as the person who authorized certain transactions. So if you try to see and things are not coming, the last resolution is just quitting. You just leave the job, because at the end of the day, it's you. If you authorize something and you are not sure of what you are authorizing, then any result, which whether bad or good, will be upon you, because you are the one authorizing some certain decisions. And that's all for today. Allow me stop here, and I hope guys you've benefited a lot, and I kindly asking you to subscribe and keep following the channel, because I'm going to be dropping more videos, and I hope you'll be able to learn more and more from my channel. Thank you so much, and God bless you. Good afternoon, viewers. Last time we stopped on ethical requirements of a management accountant. So today we are going to continue from where we stopped last time, and we are going to be talking about the cost classification in detail. But before we head there, allow me first give you some few highlights of the items which we are going to be seeing within the cost classification. The first one is cost. What is cost? A cost refers to the amount of resource that is sacrificed in pursuing an objective. First, the amount of resources that are sacrificed in pursuing an objective, or that is given up in exchange of goods and services. These are the expenditures we incur in the production of a good or a product, or rendering a service. These costs are usually expressed in monetary values or in monetary terms. And these costs, they include human labor, a form of human efforts, material, resources, time, and utilities consumed. As we know from the point of view that cost is both, or combines both, the actual cost and the notional costs. Actual costs, those are the physical items that are incurred in the production of a certain item. Let's say the material, the human effort, that's labor, and the other expenses. But with the notional costs, those are the risks we've incurred, or the opportunity cost that we foregone in the production and delivery of a good. This notional cost, you can talk about, these risks may include, let's say if you have seen that in a certain environment, there are some things which can distort the production. And by the time you start up the production plant for producing a certain item, you know there are certain risks which are involved in the production of those items. So when you're computing the total cost that is incurred in the production, we take into account the things we can really see the physical items we've incurred, and that is the actual cost, and the notional cost or the other risks we've incurred in production of certain goods and services. I wanted to explain something about the cost unit. That's the other term. It's called a cost unit. This is a unit of quantity of a product or service in relation to which costs may be ascertained. It is a physical item or a product, a single product to which costs are ascertained, that you can find out how much are we going to be spending in terms of the raw materials, labor, and other expenses to the production of that particular item. Let's say it can be a liter, a kilogram of sugar, a kilometer, like in terms of, for these people who are dealing in services, you find that per someone is charging transport cost as per the distance or as per the person who is involved in the movement. So those are the things we call about, we talk about as the cost unit. It is a single item, or it is a unit, one unit of a product to which costs are ascertained. That's what we call a cost unit. Then there is also a cost center. A cost center, as you hear the word center, it's like a collection point. It can be a process, it can be a department, but in a whole. The other time when we talked about the cost unit, we said it for it, it is for per unit, but this one, it is for the whole units we produced. So these costs we accumulate them to determine how much we've incurred in the production or delivering those services. This is the location, person, or item of equipment for which costs may be ascertained and used for the purpose of cost control. You can also define it as it is the segment of a business. A segment will mean it can be a process or a department, all other organization in which costs can be segregated, with the head of that segment being held accountable for the expenses. That department can be, let's say, a production department, but that production department is having a production manager. That production manager is the one responsible for the costs we've incurred in the production department itself. That's what we call the cost center. It's like a collection point. It's a pool where we allocate those, we ascertain the cost, those costs we've incurred in that particular department. We can talk about the cost objective. The cost objective, it addresses the purpose for which cost information is required. It's our aim. What are we aiming at? We are aiming at minimizing costs. So our aim is to ascertain the costs we've incurred in the production of a certain item. And that's what they mean by a cost objective. A cost object is an item for which you are separately measuring cost. It's that objective where the cost ascertainment is meant to be done so that we can know how much we've spent on a certain item. We can talk about the example of a cost objective can be an output. The most common cost objective are a company's product or service, since it wants to know the cost of its output for profitability analysis and price setting. Our aim as a manufacturing company is to produce output or to render a service, but we want to know how much are we going to spend in the production of that certain item. And when we know the costs we've incurred in the production of that output, we can be able to determine the profitability of the item we have produced, and we can also set a selling price for those items we have sold. It can be an operation, it can be a department, it can be a process. As I said, it can be even a business relationship. How are you related with the other person? We may be trying to find out how much costs are we going to incur in our relationship between this company and the other, let's say the supplier, the customer, how much are we going to incur so that we engage ourselves with the supplier, when we engage ourselves with the supplier. So that's all, some of the items we are going to be seeing in the costing classification. Allow me go to the next slide, and the next slide is having a cost behavior. But for the cost behavior, I'm going to do another video where I'm going to talk about it on its own, because at least for it has some computations and some graphical representation of which I need you really to grasp, because when we do those calculations, you try to understand how the costs behave depending on the changes in the level of activity. But here I'm just going to give you a brief view of how costs behave. This is the way a specific cost reacts to a change in the level of activity or activity level. And they behave in three ways. We have the variable costs, we have the fixed costs, and we have the mixed costs. For the variable costs, these are the costs which vary proportionately with the changes in the level of activity. The word, when you're defining variable cost, don't forget the word proportionately. It doesn't necessarily mean that the costs are increasing just because even the activity level is increasing, but it should be in a proportionate way, or in proportion. The costs are increasing in proportion to the changes in the level of activity. As the output increases, we expect the variable costs also to increase in the same proportion. So don't forget about the word proportion, because it's one of the keywords which really makes the definition become meaningful. So we can talk about the fixed cost. These are the costs which don't change with the level of activity for a specified degree, or in short run. You can put, there is that condition we always add. You don't just, because we know that fixed cost, yes, those are the costs which don't change with the level of, which don't change irrespective of the level of the change, irrespective of the changes in the level of activity. But to a certain point, these fixed costs, they change. And I can give you an example. Let's say a company is renting, because one of the good examples of fixed costs, we have rent. Rent, if the company is renting certain building, you will find that even if the company is not producing, we are incurring that cost. That's why we are saying it is that cost which doesn't change with the level of output. Even if the level of output increases, the other fixed cost for them, they will remain constant. But to a certain degree, as I'm explaining, we've said if a company is renting a building, we expect that even if the company is not producing, it will be incurring the rent as an expense. But take a scenario whereby, let's say the building we are renting, it has a capacity of carrying, let's say 10,000 tons of let's say soda. And if we exceed the 10,000, if the capacity of the building is capable of accommodating 10,000 units of soda, so if we produce more than 10,000 units, it means we have to incur an extra cost of renting another room, which will accommodate the items which are in excess of the 10,000, which is the accommodation capacity of the building. So by incurring another extra cost, meaning on top of what, let's say you've been incurring 10 million as your rent, when you go ahead and rent another building, you'll also pay an extra 10 as in rent. So which makes the total fixed cost to increase up to the 20 million. The 20 we paid for the items up to the full of the building of 10,000 units, and the extra units we produced more in excess of the 10,000. So that's how fixed cost can change. but they change and they remain constant to the extent, because if you head and rent another building, you will incur the same cost because it will be of the same capacity. It will remain the same, but we shall add an extra cost we've incurred, which makes the fixed costs to change at a certain degree. So when you are defining, it's very, very, very add that word. Let's say they don't change in a short term or in the short run, because at some the conditions where in the long run it may change. So allow me proceed. I want to explain something about the cost classification. What is cost classification? This refers to the assembling of costs in different categories based on their common attributes. Here we are grouping costs according to their common characteristics. And one of the categories of cost classification, we said it is cost behavior, but that one, as I've given you the small highlight of it, I'll explain more about it when I'm going to do another video for it, because it has some computations of which I want you to take note. That's why I'm going to make it a video. I'm going to make its own video so that you get to know more about it. So we can classify costs according to the behavior, as I've said, how costs react to changes in activity level in terms of the variable cost, fixed cost, and the mixed costs. Of course, the mixed cost, for them, they have the fixed component and the variable component in them, as we shall see in the videos. So cost classification, assembling costs into different categories based on their common attributes or characteristics. So we are going to be seeing the different categories of how we can group costs or how we can classify costs. The first one, we said classification by behavior, and that one I'll clarify more about it in the next video. The second thing we can talk about is classification by traceability. This classification by traceability, it is in relation to the cost unit or the cost center. How? Because as we say, the cost unit, it is the final product. In this, when you say classification by traceability, we mean that how costs can be traced on the final products. Here we are saying if expenditure can be allocated or traced to a specific cost center or product in an economically feasible way, then it's called direct. You can highlight this one. It is called direct, so that if we can directly trace the cost we've incurred on a particular item, then those are the direct costs. We've said classification by traceability is how we can trace the costs we've incurred on a particular product or in a particular department or process. If we cannot trace those costs directly to the product, then they are called indirect costs. So you get to know the things that when cost is directly traced, or you can directly allocate it on a specific product or specific cost center, then we call it a direct cost. If it cannot be traced directly to the product, then they are called indirect costs, and those are the overheads. We shall see how we can get their actual costs. This classification examines the extent to which costs can be traced to a specific product or cost unit. That is classification by traceability. We are trying to find out how we can trace a certain cost we've incurred on the output we've produced. Then the other classification we can talk about is classification by nature. This is done according to what they are, or their natural grouping. Here we are just talking about these costs in how they really occur, naturally how they occur or how they are. We can talk about if it is material, then the cost will be material cost. If it is labor, then the cost will be labor cost. If there are other expenses, then we can call them overheads or expenses. This classification, we are just looking how classification by nature, we are looking at how those costs, how they are, or depending on their natural groupings. So you have to understand that when you're grouping costs by nature, we group them into three. We group them into material cost, labor cost, and the expenses. Material costs, this refers to the cost of material of any nature used for the purpose of production of a product or a service. So when you are determining the cost of the raw materials you are incurring in the production of a certain output or a certain unit or product or service, then you have to incur their incidental costs you've incurred. Leave alone the cost you've spent on the materials themselves, but there is also the carriage inward or the transport costs you've incurred to transport those raw materials from where you got them to the place of work. There are also other taxes you pay when you are, let's say you are shipping the raw materials from abroad. There are other charges you pay, which are supposed to be included in the valuation of the cost of that raw materials. But you should also know that when you are valuing the materials, you should exclude the trade discounts, because in accounting, trade discounts, they are not recorded anywhere in the financial books, because those discounts, they are not, you have not actually paid them. We record the money you've paid. Even the taxes, if let's say someone is shipping raw materials, let's say from abroad, you find that there are some taxes you pay, and some of those taxes, they may be like in VAT. You may find that some taxes you are paying, they are claimable. You can go and claim them, and they refund you back the money you've paid. So those ones, we exclude them when you are valuing the material cost. But the other thing I want you to take note about is that when they ask you what is material, please don't explain the material cost. When they are asking for the materials, make sure you are explaining the materials, not the material cost. And when they are asking for material cost, make sure you're not explaining this. Materials, the difference between materials and material cost. Material is, those are the physical substances which are used in the production of goods and services. Whereas the material cost, this is the cost of raw materials, or the cost of those physical substances which we are going to use in the production of goods and services. That's one of the classification by nature. That's material cost. The other one is the labor cost. In the same way, when you are told to explain labor, don't give labor cost as a definition. And when you are told to explain the labor cost, don't again explain the labor itself, because the difference is labor cost. This is the cost we've incurred on the human effort which are used in the production of a product or delivering a service. But labor itself, those are the human effort, whether skilled or unskilled, that is used in the production of goods and services. So the cost we spend on labor, they may include salaries and wages paid to permanent workers. It can be in terms of overtime, gratuity, and other bonuses, depending on how the company is paying its employees. So the other one, we can talk about expenses. Those are the expenditures we've incurred, other expenditures other than material and labor we've incurred in the production of goods and services. So allow me go to the next classification. We have classification by function. Classification by function, here we are talking about a function can be a department. So we are classifying those costs according to where those costs were spent. If let's say those costs were spent on administrative work, then we group those ones into administration and the office expenses. If those costs were incurred in the manufacturing department, then we combine them as our factory expenses we've incurred. If those costs were incurred in selling the items we've produced, then we call those costs as the selling and distribution costs. So this classification by function depends on how the business is performing, because some organizations have different departments. So we accumulate those costs depending on how those costs were utilized in different departments. If the costs are in the administration, we group them into administration. If they are into production, we put them into production. And these costs, they include production or manufacturing costs. This is the cost of all items involved in the production of a product or a service, such as direct material, direct labor, direct expenses, and other factory overheads, so long as they have been engaged in the production process. The other thing, we have the administrative and the general expenses. You can as well add something here and you call them administration and general costs or office expenses. These are expenses incurred for general management of an organization. For the general management of an organization, these are costs which are incurred in the general management of an organization and are in a nature of indirect costs. Why are they in the nature of indirect costs? Because those costs, they are not incurred in the production of the goods and services. They were like supporting costs. Yes, we've incurred certain costs, but they are not directly traceable to the cost. So they are incurred not indirectly in the production process, and they are termed as administrative or office and administration overheads. And where those costs can be spent, officials, for them, their role is just to formulate policies, to do the directing the organization and controlling the operations of the organization. So they assist, they are the ones overseeing the entire production, but their cost cannot be directly traced to the output. Then we have the selling and distribution costs. Selling and distribution costs, these are also indirect costs related to selling of a product or a service. These may include the depreciation of the delivery vans. It may be the sales commission, salesman commission, and other bonuses. Maybe the cost of advertisement and most of the customer related issues, like giving them courage outwards and giving them some trade discounts if they can qualify for. Then we have another category, which is the research and development costs. These costs are spent mainly on doing innovations and carrying out some research to help in the to help in the production process by developing new product ideas and adding some other requirements or looking for new ideas where you can improve the product. Let me talk about another classification by basis of controllability. This is mainly how costs can be controlled by the actions of the managers or by the actions of the management. Are these costs are those costs being incurred to the extent that they can be controlled by the organization, or they are influenced by external factors? They cannot be controlled. So when you are looking at these costs, we look them into two ways: the controllable costs and the uncontrollable costs. With the controllable costs, these are costs which are regulated or controlled by specific members of the organizations. Most of The variable costs are controllable costs like materials, wages. The reason why they are controllable is that you are the one, it's the company which determines how much we are supposed to pay the workers, or the amount of electricity the production plant may consume. If there are no wastages, the materials we need, it's the company to determine how much of the material they should incur depending on the number of units they want to produce. And other variable costs, because we say the variable costs are controllable costs because their costs can always be influenced by the management or the actions of the organizations. Then there are other costs which are uncontrollable. And most of the times, these are the fixed costs. Fixed costs like rent, when you are renting a premise, they just give you their cost of rent. You cannot influence that, or you are not directly involved in the determination of the amount that you are going to be paying. So that's how they classify those costs by the basis of controllability. The other one, we can talk about classification on the basis of normality. Classifications basing on normality, costs are classified according to whether they are normally incurred at a given level of output in the condition in which the level of output is normally attained. There are certain costs which we incur, and part of them, they may be due to the normal condition of how we are producing certain items, or they've incurred just because of the abnormal situations which came about and we were able to spend more than what we should have spent on the production. These are categorized into the normal costs and the abnormal costs. Normal costs, these are costs that are incurred under normal operating conditions and are always expected to be incurred in the production, in the process of providing goods and services. It's like when you are engaged in manufacturing. Let's say you are manufacturing products. We expect that there must be normal losses. Those normal losses may occur. All these normal costs, we are supposed to incur them, like the cost of raw materials. We expect when you are incurring, when you are engaged into production, we expect you to incur certain cost of material, labor, and others. But there are other costs which may happen, like you may incur costs when the machine breaks down. The machine breaks down, it's not that you are supposed to incur that cost, but since it has occurred under an abnormal working conditions, so you find that you've incurred that cost, and some of those abnormal costs they incur. When we incur them, we transfer them to the costing profit and loss account. Then for the other normal ones, for them we can put them in the cost of the item themselves, but these abnormal costs, they are not supposed to be part of the cost of production. But the other abnormal ones, they can be part of the cost of the production. Then we have the second last, which is classification for decision making. These costs, every decision involves choosing from among at least two alternatives. Only those costs and benefits that differ between alternatives are relevant in making a selection. So these costs we may incur certain costs because we wanted to do a project appraisal, wanted to determine the net worth of certain projects before investing in our money. So by doing so, there are costs which we incur, and they will help us make a decision. And there are also other costs we've incurred in the comparison of those items, even if you select, because by the time you make a decision that I'm going to be producing this item, you must have incurred some investment appraisal on different ideas in which the company should invest its money. So the other items which you did not decide to produce, you incurred some costs on them, and that's the opportunity cost. These are the examples of the costs which we incur when you are making decisions, like the opportunity cost. Opportunity cost, this is the benefit, potential benefit that is given up by selecting an alternative idea over the other. These costs, we incur them when we are making a decision. It is the alternative foregone when the actual decision has been made, and that's opportunity cost. So the other one, we have the relevant concept costs. These are costs which are pertinent for a specific purpose or situation. These costs differ between the two alternatives, and they are crucial in making decision. So we have those different costs we incur when you're making a decision. The other one, we can talk about the irrelevant costs. They are those costs we've incurred when you're making decision, but they were irrelevant, but they were important in the sense that they helped us to find out what we can really produce. These represent costs that do not differ between possible alternatives under consideration. These include the sunk costs. These are costs that has already been incurred and cannot be changed by any decision made now or made in the future. You have already incurred, let's say you have committed an investment of a huge amount of money. You cannot reverse, you cannot get back that money. Those are the costs. Then the other one, let's look at the last classification, which is based on time. These costs can be classified as historical and predetermined costs. The basis of time is when those costs are incurred. If it is historical, it means those costs were actually incurred or they happened in the past. But if it is a predetermined cost or a standard cost or a budgeted cost, it's something you just forecast. It is in the future. So these costs, which are classified based on the basis of time, they include the historical costs. These are costs ascertained after they have been incurred, and such costs are available only when the production of a particular thing has already been happened. Let's say you have purchased a motor vehicle, let's say 2 million. If you have already incurred that cost of 2 million, then that one becomes the historical cost of that item for the rest of its useful life. Then this predetermined cost, these are costs that are estimated and they are set in advance in a scientific way compared with the actual costs for adopting controlling measures. These are costs we just set, and when the actual cost happens, we compare it with what we had suggested, and we see whether we have a variation or we have incurred exactly what we had planned. And that's all about the cost classification, and I'm hoping to stop here for today. Then the next one will be about the different types of cost, and I talk about the cost behavior, because for it, as I said in the beginning, there are some computations. What I want you to do is to follow and subscribe to my page so that you get notifications whenever I drop a new video. Thank you for watching, and God bless you. Good evening once again. This is again Charles Kafel. Last time we stopped on cost classification, and we had left one part, which was classification by behavior, and I told you I'm going to add more clarity on the cost behavior concept. First of all, cost behavior is the way a specific cost reacts to changes in activity levels. Here we are trying to look at how costs are going to be behaving especially when the level of output or level of the activity level of activity changes. So here the most important aspects we are going to be handling, those are the variable costs, the fixed costs, and the mixed costs. First of all, the variable costs, those are the costs which vary proportionately with the changes in the level of activities. And we say those costs, they not only increase as the level of activity increases, but they increase in the same proportion to the increase in the output. Then the fixed costs, these are the costs which change with the level. Sorry, these are costs which are not affected by the changes in the activity levels. For them, they don't change at a certain degree. They don't change even if the level of activity changes. But as I explained earlier, that fixed costs sometimes they change with when the level of activity changes, but the cost itself remains constant after a step up, and those are the stepped fixed costs, as we shall see. Then the mixed costs, of course, those are the costs which have both a variable component and a fixed component. So as I told you, this cost behavior is an example of a cost classification. So it's one of the ways we can classify costs by checking how the costs react to the changes in the activity level. So allow me kick off. I analyze them in details, and towards the end of the video, I'll give you some calculations, some small calculations of how you can easily understand what we are going to take to study as the theoretical aspect. Variable costs, these are costs that vary in direct proportion to the volume of output or activity level. So we said they vary directly in a direct proportion. When the output increases, they increase, but in the same proportion. With a variable cost, the cost per unit stays the same. Yes, the cost per unit is the same, but the more units produced or sold, the higher the total variable cost. For example, the cost of materials, wages. In an organization, you may be having a hourly rate or the rate at which you are paying your employees. Let's say you are paying them on time basis. You may be paying them 10,000 per hour. So the 10,000 is a constant amount, but depending on the number of hours someone works, he or she will be able to get, the more the person works, the more the person will earn. So if let's say the 10,000 is the hourly rate, and you find that the person has worked, let's say for 8 hours, you multiply the 10,000 times the 8 hours, you get the same, the amount the person is going to be paid. But it will not be the same for someone who has worked for 3 hours. You will get the percentage will be the same as in the 10,000, which is the hourly rate, but everyone will be taking a different amount of money depending on the number of hours they have worked. So when we talk about the activity level, the activity level may be in terms of units, maybe in terms of number of hours, maybe number of machine runs, maybe anything, maybe even the hourly rate, as we said, that the activity may be in terms of hours. Variable cost per unit is constant at all levels of production and can only change if manufacturing environment changes. You may be working in a normal situation whereby you've been producing 10,000 units. Let's say they have been paying you per using piece rate, as we shall see when we go to labor costing. And there are some scenarios, or let's say the machine breaks down. You may find that the number of units you are going to produce, they are going to reduce, but that was as a result of change in the manufacturing environment. We are producing more units because all the machines were working. So that's how we can increase the what? The variable cost per unit. Graphically, we can illustrate this as the total cost line curve slopes upwards. Why? Because we said as the output increases, we are expecting the costs to also increase, but they are increasing in a proportionate way. So the same amount of cost, if let's say for when you produce one unit, someone is paid, let's say 10,000, and that 10,000, when the person produces 2 units, it means the amount of 10,000 which is paid per unit is going to be doubled by 2. That's the same proportion they are talking about. That's why the total variable cost curve is sloping vertically from the starting point. The reason as why it is starting from the starting point is because when the company is not producing, we don't incur variable cost, because we said those variable costs are incurred as per the unit of output. When we don't produce, we are expected not to incur variable costs. But for the variable cost per unit is constant. That's why the second curve is a horizontal, meaning whichever amount or whichever output someone produces, that person will be getting a fixed pay per unit. But for the total cost, for it is the accumulation of the number of units someone has produced multiplied by the number of the unit variable cost to get the total variable costs. So we go to the fixed costs. We said fixed costs, these are costs that stay the same in the total regardless of the number of output produced, but to a certain point, as I'll explain later when I'm doing some illustration. You will appreciate the fact that sometimes fixed costs may change. But as for now, let's proceed that these fixed costs are the costs that stay the same in total regardless of the number of units produced or sold. Although total fixed costs are the same, fixed cost per unit changes as few or more units are produced. In this case, we can talk about the straight line depreciation expense. When we are removing a constant amount, as the depreciation expense is the same, but we are removing it the same regardless of the amount. Remember, when you take, let's say, if you have bought an asset of 10 million and you take 10% of the 10 million will be 1 million. That 1 million, even next year, we are going to keep the 1 million, but remember the net asset is going to be reducing. When you take out the 1 million, the net book value will turn to 9 million instead of the 10 million. But the depreciation expense will remain the same. The total fixed cost, we say they are constant at all levels of production. That's why you are seeing the total fixed cost curve is horizontally, meaning at all levels of production, we are expected to be doing exactly the same because even if you see here, the cost is the same, but at different activity level, as you can see here, we are incurring the same cost. That's what we mean by that. Then for the unit variable cost, for it keeps changing, because when you get the number of units we have produced, of course you will see that it keeps changing. It will be varying, and that is how it is. We can continue to let's go to our next thing, and that is the semi-variable. Now the mixed cost, we are dividing them into the semi-variable and the semi-fixed, because here we are talking about the semi-variable. These are costs that have both attributes of variable and fixed elements. They have a variable component and a fixed component. The reason why we are incurring that fixed component is that we are trying, that is the cost you incur for the service to be available or for the items to be available. It's like the minimum you are incurring for the service to be available. This one is done for these sales agents, because when you're paying a sales agent, most of the times they pay them a retainer, and that retainer, it is regardless of the number of units they are selling. But they give them, on top of the retainer, they give them commission. So that commission keeps varying on the number of units you are selling. When you sell more, you are expected to be getting more. That's meaning the retainer will be the fixed component, then the commission itself will be the variable component. We say these are costs. These costs have both attributes of variable and fixed elements. The fixed component is charged to make the service available for consumption. They are partly affected by the fluctuations in the level of activity. Fluctuations in the level of activity. In the level of activity, we have utilities, we have salaries to sales person with a monthly salary and additional pay for the product sold. We have factory supervision, that's maintenance, among others. As you can see, the total semi-variable costs, it starts as it is horizontal, then it becomes a stepped up. There is an inclining amount depending on the number of items that are sold. As you can see from here to here, the person is paid a fixed component. You can call it, let's say, the monthly retainer for the sales agent. Now from here up to here, that one is a variable component, whereby the more units someone produces, the more amount is going to earn, because you're seeing it is slanting like this, meaning the more you sell, the more you earn. The more you sell, the more you earn. That's how it is. Then the unity variable cost, of course, the unity variable cost behaves as a variable cost. For it is a straight line, and that is it. Then we can proceed to the next one, which is the semi-fixed costs. These are mixed costs which are influenced by different ranges of output. They are influenced by the different ranges of output. Such costs change as a range of activity or output is adjusted. It is the same thing I was telling you, that sometimes fixed costs, they change, and this is what it is, the semi-fixed costs. An example we can talk about is rent. When the rent paid for, or if an organization pays rent for storing, let's say, the output produced, you may find that the capacity of the building can hold certain amount of items, to the extent that if you put more than the company, what the building can accommodate, it will not be fitting there. So you will need to incur another cost, another similar cost of rent to accommodate the number of units which have exceeded the range. Here we can talk about another example as the transport based on the number of tons. If transport cost is charged depending on the kilograms or the weight of the items someone is transporting, you may find that the person with high weights or tons of a certain product will be paying higher costs than the other. Then the other one you can talk about if it is in the distance. If the transport cost is paid in the distance covered, the more you cover the distance, the more you pay the costs. Yes, the cost, the transport cost is fixed, it is the same, but it is changing as per the range of the activity level. Then you have also the supervisory cost based on number of workers. When you are paying supervisors, they supervise according to the number of workers. When the number of workers increase beyond a certain range, then you are supposed to pay them an extra income for supervising those people. As you see the graph it starts from the point where, as you see, when the output is X or X, the level of supervision is constant. That from it is OP, meaning as the number of units exceed that range, we are expected to incur an additional. An additional means we are starting from where we are paying. If let's say the rent expense was 10 million, you will see that if we are starting from the 10 million, we are stepping up to a certain amount, let's say 10 million. Meaning from OP, it will be the same as from PT, or it will depend on the amount someone is being paid. Because you may find that in some scenarios, people are paying, the output goes to a certain range, they add the small, it depends on how they organize to pay for the addition output that has been produced. Because even here, you are seeing we are paying the constant amount, but it has just leveled up from here, from OP to OT, then from OT to another level, depending on the number of units that are being produced. So as you've seen, if the plan is to produce in a range of OX, it will pay fixed cost of OP. Should it change to a different range, say XY, then it should be ready to pay an additional cost amounting to OT. Meaning it is from OT because we are including what was paid when we were producing at OX, and the one on OY. So that's how it is. And from there, I think you can understand how these things coming to that the fixed costs doesn't necessarily mean that they don't change forever. Sometimes they may change. And actually that's what I wanted to talk to you about. The cost behavior pattern is a bit challenging, because at certain point you may find they have given some calculations, and you have to see how you can draw these graphs using graph papers and all of that. You illustrate, and this is what I'm going to do. Let me share. There is a number here I did. We assumed that variable cost per unit to be at 20,000 or 20 shillings. Made them in shillings, and this one is in shillings, and this one is in shillings. So you may see, as we say, that the total cost is an example of a mixed cost, because a mixed cost has both a component of a fixed cost and a variable cost. So to get our total cost, it is the fixed cost plus the variable costs. When we get the fixed costs plus the variable costs, we are getting the total cost, and that total cost represents our mixed cost. So this one is going to be the mixed, this one is a mixed cost. When you see that, you just know that that is a mixed cost. Then this one is our total fixed cost, we can call it A. And this is our variable cost, but the variable cost has a component, has times the variable cost per unit. This is the formula for defining the variable cost. The variable cost, number of units produced times the variable cost per unit. That's how we get the variable cost, the total variable cost. So we say the total cost equals to the fixed cost plus the variable costs. But remember, to get our total variable cost, we multiply the fixed cost times the number of output. So we assume that we are producing from 1 unit to 12 units. And we also assume that the fixed cost, since it is not changing, we maintain it at 10,000 within a certain range. As you see, from 1 to 4 units, we are charging a total fixed cost of 10,000, or the 10 shillings. Now the variable cost for it, it is constant. As we said, the variable cost per unit is constant at all levels of output. What changes is the total variable cost, but it changes in a proportion to the level of output. We can try to compute for this. If you want to get the total, variable cost, it will be the number of units, which are 0 units at when you are not producing, those are the units, times the variable cost per unit. It will give us a 0. The reason as why it is giving us a 0, because when you are not producing any item, we expect to incur total variable costs. That's why here you are seeing, when you come here, you are seeing there is a 0 somewhere. That's why here there is a 0. When we produce 1 unit, it will be the 1 time multiplied by the variable cost per unit, which will give us 20 shillings. And this 20 shillings is the value you are seeing here as for the total cost, total variable cost. Then if you are to get the variable cost, we say the fixed costs, we incur them even if we are not producing. So to get the total fixed cost, it will be getting our total fixed cost, it will be the fixed, to get the total cost, it will be the fixed cost, which is 10 shillings plus our variable costs, which is 0. And that gives us 10 shillings. So even when we are not producing, the total cost is increasing. Is there, we incur the total cost because we had already incurred the fixed costs. So the implication here is that when you are drawing total fixed costs, that means total fixed costs, they are not starting from 0. We start from where the fixed costs started or where they ended. So to get, you can keep multiplying 2 times the 20,000, you will see that you'll be getting 40,000, meaning it is growing in a proportionate way, meaning when I incur the 2,000, remember the variable cost per unit was 20 shillings. So it will be the 20 for this first unit and the 20 for the other unit to become 40 shillings as the total variable cost in the production of 20 units. So when I reached on this 51, at this one, we assume that when we reach here, we assumed that let these first costs, the fixed cost, we assume that at this company, when it produces the output, the 4 units or the 50 unit, the capacity of the building can only accommodate 4 units. So the 50 unit, the company will be required to incur an extra cost, and we assume the extra cost to be 5 shillings. When you add the 10,000 plus the 5,000, we get the 15,000, which will be our new stepped fixed cost, whereby that we have exceeded the range we had assumed. We had assumed that our range is going to be these 4 units of output, or 4 kilograms of output. So when you increase that one will only have an effect on the total cost, but not on the variable cost. For the variable cost, it is the same. It keeps changing with the level of output. But for the total cost, because when you add to get the fixed cost in these 5 kilograms of output, it will be the 15 plus our new variable cost, then which is 100,000, which gives us 115 shillings. This 115 is the new total cost. But that 115, it would have been 110, but because we had a stepped fixed cost of 5,000 or 5 shillings, so it made us to incur an extra cost of 11 and 15, 115. So if you are to draw this curve, then it will reach at a point for this total fixed cost, it will be moving horizontally, but when it reaches the 5 kilograms of output, it will increase by 5, and then it becomes constant until it reaches to the 20, whereby another range will be exceeded, whereby we will also incur an extra 5,000. We add the 5,000 or the 5 shillings to the 15 shillings to make it 20. But what you have to know is that when you want to, if you are defining the variable costs, we say these are the costs which vary in proportion to the changes in the level of activity. If you just ignore out the word proportion, it will be wrong to the extent that even when we are seeing these total costs, if you just say that variable costs, these are the costs which change with the changes in the level of activity. Because even these total costs, they are changing. Are you not seeing that they are coming from the 10 to 30 to 60 to 70 to 90? They keep on increasing. But the difference is that they are not increasing at the same rate or in proportion to the output. This one is increasing, but it doesn't increase in the proportion. Like for this one, the variable cost, you will see that when you get, let's say we use the last one, which is 240. When you divide it by the when you divide it by the number of units which are, you will be getting the same exact amount of $20 or 20 shillings we've incurred. But if you divide the total cost of 260, divide by the number of units which are 12, you will be getting a different answer, meaning that they are not in what? They are not in proportion. So when you forget about the proportion, then you are giving a wrong thing. So that's why I was like, when you're explaining, make sure you put the word proportion to distinguish it from other costs which keep also increasing as the level of activity increases. Then the other thing, for the fixed costs, that's why we said we have to put within a relevant range, because when the output exceeds the range, then we are supposed to incur an extra cost. That's why when you're defining the total fixed cost, you have to say that these are the costs which do not change with the level of output within a relevant range. I hope there we are clear, and I hope that one has helped you a lot to understand what we really mean by the variable costs and fixed cost plus the mixed costs. Then the other thing I wanted to clarify more is that these costs, there is how you do the separation, the cost segregation, of which it is going to be our next video, and is going to be how to segregate these mixed costs. We get the variable component and the fixed component by using our methods, the high-low method, using the least squares, using other, there are so many methods we can use to separate those costs. And that one, I'll do a video of how to segregate those costs when they have given you a complete cost with a different activity level. So allow me stop here for today. And I just encourage you guys to subscribe, because there is a lot which is coming. And I hope this video has been very helpful for you. Till we meet again, it's bye for now. Good evening, viewers. This is your tutor, CPA Charles Scofield, and I'm going to take you through the different types of costs. And when we know those costs, in the end, they will help us prepare a cost statement. It's going to be a short and brief video, but the emphasis is about how to prepare a cost statement. That's where I want, because it's the basis of whatever we are going to be discussing regarding costs. Because you find when you're doing job costing, process costing, all we are trying to look at is how to determine the cost. But before I take you to the job cost statement or the cost statement, allow me first take you through the types of costs. I know some of these costs we saw them when we are handling the cost classifications, but let me try to go ahead and explain them in details. So the first one, the first category of costs is product cost and the periodic costs. I'm giving them in two ways because some of these costs, they are related, and it will be easy for you guys to understand and pick the information, because when you talk about the product costs and the periodic costs, they look a bit, one is the opposite of the other. So you will be able to understand these costs very easily. So as I said, the product costs and the periodic costs, let me first talk about the product costs. Those are the inventory costs or the stock costs. These are costs that are incurred to acquire or manufacture a product. These are the production costs or production or manufacturing costs. These are the ones that are directly involved in the manufacture of a product. They don't appear on the statement of profit or loss until the product for which they are incurred is sold, and when the product is sold, these costs are transferred to the cost of goods sold account and relate to the product manufactured. So these product costs, for them, they don't appear in the income statement. Reason is that when we are transferring the cost of the goods we have produced, we are only transferring the when we have made a sale. If you sell the goods, then it's our responsibility to determine how much was incurred in the production of those units that are sold. So they only appear there as they come in the production cost. Since the company is not dealing in purchases, because when you're determining the cost of sales, it is the opening stock plus purchases minus closing stock. But in this time, we are not buying goods from suppliers. We are making our own goods. So instead of adding the net purchases, here we are going to be adding the production cost, because we produced our own goods. So that's where we report those production costs. And I hope you guys have got it clearly. Allow me go to the periodic costs. You said periodic costs. These are costs which are not included in the product cost, or they are not incurred in the production, or they are not part of the goods produced, or they are not incurred in the production of the goods and the services. These costs are not included in the product costs or manufacturing process, and are usually treated as expenses for the period in which they are incurred. Those are the non-production costs, which we consider as our periodic costs. We treat them as periodic costs or operating expenses, and we deduct from the figure of the gross profit to get the net profit. but we don't include them when you are valuing the value, when you are trying to look for the value of stock or the goods produced, and that's the difference. The other one, they are treated as a product cost. These ones are treated as a normal operating costs, which are supposed to be deducted from the income statement. The second type of cost, we have the variable and the fixed costs. Fixed costs, these are costs which do not vary with the changes in the volume of activity in the short run. That one I explained it, and I will add something that whenever you are giving a definition for fixed costs, you go ahead and add either in the short run or within a relevant range. Those two words must appear on your definition. If you want to find out more, you can just go back to the previous videos, then you'll try to understand how and why we are supposed to add those words. Then the second one is variable cost. These are costs elements which tend to directly vary with the volume of activity. Directly vary or which are proportional to the volume of activity. They can be in form of variable direct costs that can be directly identified with a specific product. When you talk about the variable direct tax, we mean the direct material, direct labor, and direct expenses. And direct in and variable indirect tax costs that supports the production process and not easily identified with the product or the cost unit. These are the indirect material, indirect expenses, indirect labor. They are just supporting costs to the final costs. The third type of cost, we have the relevant costs and irrelevant costs. Relevant costs, these are costs which are permitted for a specific purpose or situation. They differ between the two alternatives and they are crucial in decision making. I hope even that one I explained it. You can check my previous video and try to get more clarity about it. The irrelevant costs, these represent costs that do not differ between possible alternatives under consideration and are common to all alternative under review of the decision makers. These irrelevant costs, when you are comparing, let's say, an investment, you are appraising an investment. These irrelevant costs, those are the costs which are similar, that in this business idea they are there, that even in the other business idea they are there. So they don't differ from a certain product and the other. So when you're making a decision, you find those costs which are similar, they are incurred in this side and even the other side they are there. Those are the irrelevant costs. But the relevant costs, those are the costs which comes as a difference in the business ideas we are appraising. You may find that certain items, they have different costs which we incur, and the other one they don't have. So those ones become a basis for the decision making, so that you compare those costs between those items and you see which one has more costs than the other, so that you can make a decision on whether to take the investment or to leave it. The other type of cost, we can talk about the avoidable costs and the unavoidable costs. Avoidable costs are those which under given conditions of performance efficiently should not have been incurred. These are the costs which you can avoid if necessary precautions or measures have been taken. They are not expected and not provided for under normal working conditions. Those costs which you can easily ignore and you don't incur them. So they are the opposite of the avoidable. Those are the unavoidable costs. These are the costs which are inescapable and expected to incur within the limits. These are like the normal costs that even if you are doing whichever kind of business, you have to take into consideration that these costs may happen. But the other unavoidable for them, we don't even take into account because it is very easy to ignore them. When you're handling, when let's say you are buying material from a certain supplier, you may find that there are certain costs which can be avoided from there, so that you make the goods to be a bit cheap. But there are other ones which you cannot avoid. If you buy goods in bulk, you are expected to incur transport costs. So those are some of the avoidable costs. And allow me proceed to the next type of cost, which is controllable and non-controllable costs. Controllable costs, these are costs which are subjected to direct control at some level of managerial supervision. These costs, they can be controlled. It's like when someone, let's say labor inefficiency, to the extent that when you're not supervising workers, you may find whatever they are producing, they produce at their own pace. But when you are there and the level of supervision is a bit high, you can control some wastages, the idle time and other costs, which we will incur when we are not supervising them. Opposite to that is the non-controllable costs. These are the costs which are not subjected to control at any level of managerial supervision. We have the fixed costs. Those ones we don't have any control about them. So we just have to settle them because we can't decide or we can't ignore them. Allow me go to the next one, and the next one is job and processing costs. First of all, when you want to understand these costs, the job and the process. For the job, a job is an activity that is done based on the customer's specifications. The customer comes with a different idea of whatever they want, then it's you to try to make a job cost, whereby you start to analyze what are the costs that are going to be incurred in delivering whatever the customer wants to. So to the extent that when the customer comes with his or her specifications, you just employ whatever is there to make sure you deliver the customer's order. Meaning, when you are dealing with a job, it's a specific item and you do it as per the customer's requirement. So when you are determining it, for example, you can talk about in the carpentry workshops, you may find that a certain client comes with an order for, let's say, chairs, and the other one comes with an order for bed sheets, for beds, and the other one may come with an order for tables. The knowledge we use and other costs we incur in preparing those items that the client need, they are different, whereby they even need different people to work on them, because the skills that are needed to produce a table, they are different from those that are needed to produce, let's say, a bed or a chair. They're a bit different. But with the process cost, we are dealing with only one item, and that item goes through a series of different stages before it becomes into a final product, whereby the output of a certain process becomes the input of the other process until it comes out as a fixed commodity. But with the process costs, for them, we consider a similar product. The client may come with a demand less of 10,000 units, but we just know that we will use the same output for another client. That's the difference. Job costs, they are related to those costs incurred in producing a product or a services that is unique in nature and provided to meet the customer specifications. It's the customer who comes with whatever he or she wants. Then your role is to determine how much are we going to spend on the different items that are needed to manufacture that item. Process costs, that one is done, relates to costs that are accumulated to every department or production units for a lengthy production run involving products that are indistinguishable from each other. The other one we can talk about the budgeted and the standard. This is an expense that has been planned. This is an expense that has been planned before in advance, for which funds are typically put aside by the business to cover a given activity or to provide a service. These costs, you plan or you forecast them and you put them aside to cater for whatever activity you are going to perform. Then the standard costs, this is the predetermined cost which reflects in advance what each product or service should cost under given circumstances. Then I can proceed to the next one, which is the historical and predetermined costs. Remember, we talked about these costs when you are handling cost classification. Like for these historical costs and predetermined costs, we say those are classification by time or on the basis of time. That these historical costs, those are future costs. They are costs which were incurred long time, but these predetermined costs, those are future costs. Historical costs are actual costs of acquiring assets or producing goods or services, and they follow the system of accounting. Those historical costs, those are the costs we use when you're doing financial accounting. But these predetermined, they are computed in advance of a production process on the basis of specification of all the factors affecting cost and cost data. So you can allow me go to the future costs and conventional costs. Future costs, these are those costs expired or planned to be incurred in the forthcoming period. They normally form the basis for budget and used in making decisions that influence future directions of the company. These are costs which we plan in order to see the future, in order to make decision on the future directions of the company. Then the other one, we have the conversion costs. The conversion costs or the conversion costs, these are costs that are incurred to convert raw materials into finished products, and they include all those costs that are incurred in the production except the cost of raw materials. They are like supporting costs in the conversion of those raw materials into finished goods. They include direct wages, direct expenses, and the other overheads for converting raw materials into finished goods. The other type we have discretionary and out-of-pocket costs. Discretionary fixed costs are costs which are set at a fixed amount for a specific period of time by the management in budgeting process. These costs, they are always fixed. Most of the times they are always, we just take them as fixed costs. These are the costs we just put aside when we are doing, let's say we are making, when the management is making research. You may find that those costs, yes, they have set aside, but even we can even do without incurring those costs. Whereby like if you are to incur donations, if you are to donate or give gifts, even if you don't give those gifts, we are expected to be performing very nicely, but their role is they contribute on how the raw materials is going to be, or the produced units, how are they going to be increased so that we can increase our sales. You can incur some costs like for research, how to improve the product, how to add value, and what should be reduced from whatever we had included depending on the customer's requirement. So those are the costs. Then you have the out-of-pocket costs. This is a portion of costs associated with the activity that involves cash payment to the third party or to the other party. This is actually money moving out of our bank accounts to pay certain expenses. So having known the different types of costs, so we are going to see how to prepare the cost statement. A cost statement or a cost sheet is a document which provides for the assembly of the estimated detailed elements of cost in respect of the cost unit or cost centers. This is a document that provides how costs are assembled or are classified or are grouped depending on the items of those costs that are connected to the output we have produced. All these are the components which were added up to produce the output we are seeing. It is a summary of cost of manufacturing a product. So it summarizes the cost of manufacturing a particular product. It gives us whatever has been incurred in the production of those outputs. Meaning we are going to be dealing with the production or the product costs. Then the periodic cost will come later. But when you are doing a cost sheet, we all looking forward to get those costs which are combined and are responsible for the production of the items we are seeing. These costs are summarized in 4 ways. The first one, we have the prime costs, and prime cost includes the direct material, direct labor, plus the direct expenses. That's the prime cost. It is having that direct component. We have the material, we have the labor, we have the direct expenses. The other category, we have the factory or the indirect costs. And these factory costs, we have the prime cost plus whatever we have incurred in the factory, which are the factory overheads. Then the third one is the cost of production. To get the cost of production, it is the factory costs plus the office administration overheads. So you can even proceed to the fourth one to determine the total cost or the cost of sales, which is the production cost plus the selling and distribution overheads, plus others like the research and development, financial charges, and other costs. So let's look at the importance of a cost statement. Why do we need to prepare a cost statement? This cost statement, first of all, it presents the total cost on the basis of the logical classification. We classify the costs, we sum them up to get the total costs we've incurred either in the production or the whole total costs we've spent in both the production and the non-production activities to get the total costs. Because to get the total cost, you add the cost of production plus these other non-production costs. The first one we said, it presents the total cost on the basis of a logical classification. Secondly, we can be able to assist in fixing the selling price. Having got the cost of production, we can now put a profit component to the cost by using a markup or using any margin so that we can determine the selling price of the goods which we've produced. The third one we can talk about, it is used for effective cost control and comparison. when we add up the costs, we can know that in this scenario, we have spent a lot of money on, let's say, buying materials and paying workers which are directly involved in the production. So we can try to compare with what we incurred last time, and we see how we can reduce on the costs. The other importance of a cost statement is for preparation of cost estimates to tenders and quotations. Of course, when you know the costs you've incurred, it will be very easy for you to determine the price of the commodities that you are supposed to sell the output. If, let's say, you are doing a cost statement, a job cost statement, you will be able to determine the worth of the job you are doing, having known the costs which are going to be incurred in the production of the goods depending on the customer's specification. So you will be able to put the rightful amount on the quotation, on different quotations of the client. The last one, it is used in determination of the cost per unit and the total costs at different stages of production. You can even know before the output comes out that as per the raw materials I've incurred, as per the first process, I've incurred this and this amount, depending on the number of costs you've incurred as per that department. So by the time the output gets out, you know that I'm on top of whatever we've incurred. If we deduct, if let's say the losses we've incurred, because the normal losses, they are always there, if we remove them, you'll be knowing how much is the costs the products you've produced. So allow me give you the format of a cost statement or a cost sheet. For the cost sheet, we start with the direct costs, and we say these direct costs, those are the direct material, direct labor, and direct expenses. And those ones, they give us a prime cost. So when we reach at the prime cost, we add the indirect manufacturing cost or the factory costs to reach at the production costs. So we can start. The first one, we start with the material. When you are producing the output, you have to start with the material. Certain items, you first buy the material. After buying the material, of course, you incur the labor. After incurring the labor, you may also incur some expenses like a hire of machines that can help you to lift the, let's say, the raw materials, which contribute to the direct expenses. So we start with the direct material. When you are dealing with the direct material, we may be having the opening stock, which was the closing stock of last month. It becomes the opening stock of this period. So it will be the opening stock plus the purchases, but these purchases are for raw materials. Then we can add, because when you are purchasing goods, there are sometimes you incur transport costs. That can be in terms of carriage inwards. You add it back to the cost of the purchases so that you get the total costs incurred. You may be having some returns. Let's say you've bought some goods, some raw materials, and you find that part of the raw material is not, or you've bought more than, or they have supplied more than you had ordered, or some of the goods are damaged depending on the quality someone wanted. You can be having some returns of raw materials. Then you less it off from there, and you also less the closing stock of raw materials to get the cost of raw materials consumed. When you get the cost of raw materials consumed, then from there, having known the cost of the raw materials, we can now add these other conversion costs so that we can convert those raw materials into finished goods. Among these conversion costs, you have the direct labor, direct expenses, and this time the direct expenses, we say the royalties. Royalties is a direct expense, so we add them up to get the prime cost. Prime cost, we add the indirect materials or factory or work costs, and these costs, they include those costs which are incurred within the factory, but they are not directly traceable to the output, but they are incurred in the production department. So when you add them back, you will be getting the production cost. When you get the production cost, then we may be having some work in progress, opening work in progress, and closing work in progress. When you have those opening work in progress, you add back the opening on the production cost, you add back the opening work in progress, and you less the closing work in progress to get the cost, the production cost of goods completed. When you get the production cost of goods completed, then from there, if we are told that we need to prepare an income statement, we can go ahead and stop there. We take that cost to the income statement. We take the production cost of goods completed. But if you are not told to do so, then we can add back these other office and administrative expenses. Those are the expenses that are incurred within, those are the costs that are incurred within, those are the costs that are incurred within the administration department or the supporting department. So from there, we can add the other selling and distribution expenses. Of course, those are the expenses we are incurring when we are selling the output we have produced. When you add them all, you will be getting the total costs or the total cost of sales, and that will be because our main emphasis or making this cost statement, you want to look at the total cost. And after getting the total cost, then we have to stop there. And that's all. The next video will be I'll pick a practical question and we solve it so that you can try to get more of what really how we prepare this cost statement. I'll get for your question, then we work it out. Thank you for watching. Please subscribe so that you can be able to learn more on this channel, and you can share to others so that they can also have a benefit and we try to learn together. Thank you. Till we meet again. Hello viewers, this is CPA Charles Kafel, and I'm here to take you through material costing, which is a subtopic under material costing. What are the materials and what is the material cost? When you meet a question which is asking you to define material, make sure you don't give a definition for material cost. And when they're asking material cost, you make sure you're not giving a definition for material. You separate the two. Materials, this refers to all components or physical substances which are consumed in the production or in the manufacturing of a product or rendering a service. These are the physical substances which are consumed in the process of manufacturing a product or rendering a service. Those are the products. Those are the physical substances or the tangible items which are consumed in the manufacturing of a product. And those materials, they form a big percentage on the product because we put in the system and we employ other costs so that we can convert them into finished goods. The cost of the raw materials is different to the material because the material themselves, those are the physical items themselves, but the material cost is the cost we incur on those physical substances which are used in the production of a product or rendering a service. So when you talk about the material, those are the physical items, but for the material cost is the cost of those physical substances that are consumed in the process of manufacturing a product. So materials, when you talk about the materials, we have the direct materials and the indirect materials. The direct materials, those are the materials which are directly involved in the production of an item. Those are the physical substances that are being involved in the production of goods and services. But when we talk about the indirect, these are like the supporting materials which cannot be traced on a product. These materials, yes, they are incurred in the production, but they are not directly traceable to the product. You may try to get some of the examples. If let's say the company is dealing in furniture making or a carpentry workshop, the cost of timber is a direct material. But when we talk about the varnish they used to smear on the woods and the nails and the other spare parts they use in the production of, let's say, a table, a chair, those ones become the indirect cost because for them, they act as a supplement to the direct costs, the costs which are really, or the materials which are really traced to the output, or they form a big component of the item. These indirect cost for them, we just they are like supplements which cannot be easily traced on a unit, because you cannot trace a cost of, let's say, varnish, which we use to smear on the surfaces of, let's say, a chair. It is very hard, but you can know the number of units of, let's say, wood which we use to manufacture those, let's say, chairs. So you get to know those differences, that the direct materials, these are the materials whose costs can easily or conveniently be traced to the final product. For example, cotton that is used in textile mills or industries. The cotton itself is a direct material, but other supplements which are used on top of the cotton, those are the indirect material. But the main product or the main item which form a big component of a product is the cotton. So the indirect materials, these are costs, these are materials indirectly used for converting raw materials into finished goods. You can talk about the varnish for furniture, spare tires, tools. These tools, these are the loose tools, they are like spare parts. Then the nails, lubricant, and others. The combination of both the direct material and the indirect material costs form the total cost of the raw materials, or total cost of the materials. Here we have defined the direct materials and the indirect materials, but they may ask you what are the direct material costs. The only difference is that when you are defining the direct material cost, instead of using, here we said these are materials, you just say these are costs which can easily be traced on a particular product. If they say materials with not material cost, you put materials whose cost can be easily traced to the product. I hope that one is clear. Allow me look at material control. Material control, this involves planning, controlling, and scheduling the material right away from the procurement, storing, and usage of material with an objective of earning economy or efficiency. Material costing, material control is just aiming at how can we control these costs we are incurring, or how can we control wastages? How can you make sure that the materials we've got, they are not too expensive? We've minimized the cost, and on top of minimizing the cost, we have also made sure that these raw materials, we have used them efficiently. That's all about the material control. We are aiming at achieving economy, and economy means minimizing costs. And with efficiency, we are on the side of eliminating the wastages, so that we can be able to produce good quality items, and we use less materials, and we've incurred less costs. That's all about the material control. Material control involves quantity control, and this quantity control involves policies and procedures put in place to ensure that the minimum amount of material is used in the production and service department. As I said, we are aiming at, first of all, minimizing the number of raw materials we are going to be using in the production process. And how can we do that? By acquiring good quality raw materials in the production, because when you get goods of raw materials which are of a good quality, you can be able to use less materials than when you get raw materials which are substandard, and you find that you are using more units of materials, because the materials will be consumed at a very high rate since it is of low quality. So by controlling this, we make sure we get raw materials that is of a good quality. That's how we can make sure we have a quantity control. The other one we can talk about in terms of the quality control. The quality control over procedures and policies put in place to ensure material quality standards are complied with at all times. When you get materials of a high quality, you are expected to produce goods which are of a high quality. And by doing so, you are, first of all, minimizing the costs which you are going to be incurring in procuring more materials which are of a low quality, if you are using raw materials which are of a low quality. So that's how we can achieve the quality control. Then the other one is the financial control, whereby we minimize the amount of money we are spending on the raw materials we are buying. Yes, we make sure we are buying raw materials of a high quality, but we also go ahead and consider the fact that we are not supposed to buy those raw materials at a very high cost. So by doing so, we are reducing on the financial costs we are incurring in procuring materials. I hope you guys, you've got that. Allow me to proceed to the next one, and we talk about the objectives of material control. The objectives of material control: when we control the usage or the purchase of the raw materials we are introducing into our production process, we are able to receive materials and store them properly. So by storing those materials properly, you are maintaining a quality to the extent that when you store those, because some of the substances or some of the materials, they have different reactions towards the conditions, the environmental conditions. So when you store them badly, you will find that some of them can be spoiled and others can get contaminated. So when you make sure that you are storing the items under necessary conditions, you may find that you are achieving the material control. The other one, to ensure proper production and the preservation of raw materials. When you control the material in terms of, let's say, the quantity, we know the materials we want and the quality of the material we want, we are able to produce or to continue producing the output without holding into our production, because we've procured the rightful amount of raw materials and of a good quality. So we are making sure that the items we have brought, they are of good quality, so we are able to improve our production and we preserve those raw materials we have. The third one is to make sure that proper classification and coding of materials. Proper classification of raw materials, you group the raw materials depending on, let's say, on their process, because you may be having that process A is taking this kind of raw materials, so you group it according to, let's say, the production process. You may group according to their similarities or some similar attributes, and by doing so, you are making sure that the material you've acquired is at the right place and at the right time when it is needed. The other one is the coding of raw material, is that we will code the material as per the numbers we've given. Let's say we can say this material, we bought it in a lot number this. So depending on the system you're using, you can say that as per the material we have, we are making sure that the materials which came first are transferred to the production process so that they can be produced or processed into final products, so that we can eliminate the wastages and other kinds of delays and obsolescence which may occur when we keep stock for that. Let's say the material which came first, we leave it and we first handle the material which came first. It depends on which system the company or the organization is using. The fourth one is to provide proper information to management about the stock of raw material. When you control the material, you are able to get the information about the number of units of the raw materials we have, the quality. You can even know the value of those raw materials, which can help management to make decisions and take control of some of the costs we've incurred. The other one we can talk about to ensure good housekeeping and effective material handling. When you control the material, you are able to know which material needs which conditions, whereby it will be very easy for you to know that this material is supposed to be kept under these conditions, and you can make sure that those materials are catered for before they reach the store. The other one, to assist in verification and provision of supporting information for efficient or effective purchase action. When you've controlled the material, you are able to get the necessary information which can be used when you're doing another purchase. Let's say when you have kept proper records of the materials we've bought, and we know which suppliers we got those items which were of a good quality, we can always refer to those records, and we try to find out how we can make sure that we are handling the purchase easily, and we respond to the queries which may arise. The other one, to make sure that all types of desired quality are available when needed for effective production. When you make sure that you control your material, you are able to know the rightful amount of raw materials that is needed to a certain production process. So when you're able to know all of that information, it means even the production will not be on hold because of certain material issues. You'll be having everything that is needed when the production is taking place. The other one we can talk about, to ensure the optimal investment in material to avoid overstocking or understocking of raw materials. When you take good control of the raw materials, you'll find that you'll avoid these wastages, whereby you will not overstock. You will be knowing all the information and all the kind of material that is needed in every department in order for the production to take place. So it will help you avoid the overstocking of goods, which may lead to wastages. The other one we can talk about, to maintain proper record about material receipts, issues, and balances. These are concerned by recording of the materials we've got. when we've received the material, let's say we have purchased the material, we make sure that we record the information in terms of the items or number of quantities we have purchased, their prices, and when we issue out some of these materials, we make sure that we also make sure that we add just our stock ledgers and stock cards or the bin cards to make sure that we have the rightful amount so that we can manage our minimum and the maximum stock levels or the order levels. The last one, to ensure issues as per specifications. When you do the proper recording of the information, you can know that if the person wants this and this amount of raw materials, I'll be knowing where to pick that information because I had already recorded and I had kept those goods in different places depending on which department those items are supposed to be working. Allow me to proceed to the next one, and I'm going to be talking about the policies to consider in order to achieve those objectives we have just given above. How are we going to, what are the methods we are going to use so that we can achieve those objectives? Or what are the things we are supposed to do so that we achieve those objectives we've highlighted above? One of them, we are saying proper selection of suppliers that are ready to meet the needs of the farm at all times. Meaning, if you make sure during your procurement process that you shortlist suppliers who can deliver materials to the company at any time the material is needed, whether the money is paid or is not paid, that supplier must be able to supply those raw materials as at when they are needed. So when that one is done, you are sure that material will be available and the production will also take place without any delays because you have made sure we have done the rightful way in when we are doing the procurement, that we selected the people who can supply us the goods as and when they are needed. Then the second one, what we should do so that we can achieve those objectives we have given above, is that we maintain the stock records against which materials are recorded when received and being issued. When you are preparing these stock records, most of the documents we prepare, those are the bin cards whereby we just put the quantity of the raw materials we've, let's say, purchased or we've issued out or we've returned, let's say, the supplier. We put all that in the bin card. So a continuous stock taking within the organization, it helps in monitoring our stock levels so that we can know when to do another purchase, and we'll be knowing how much are we left with, how to purchase the material which is needed for the production to be continuing. The third step is regular stock taking, monitoring of stock items and the material audit to establish and reconcile physical stocks against the stock records. When we record this information, we don't stop there. We go ahead and we check the actual raw materials and we see, because we may be recording, yes, in the store we have such and such amount of material, but you may find that some of the materials may get damaged from there. So you have, instead having recorded the information that you have the rightful figure, make sure you go ahead and cross-check with the goods themselves to confirm whether the goods are still in their right quality. And if they are in the right quality, then you verify with what is in the records. You make sure you go ahead and do the stock counting. You count the items and you verify or you compare with the records you have, let's say in the bin card or the store ledgers. You see the balances which is on the store ledger, whether it is exactly the same which is in the physical items themselves. The other one we can talk about provision of proper storage facilities. As I said, if these materials, they are not kept safe, some of the materials can get contaminated, others can get damaged just because they are not kept in a good environment. Because some materials, you may find some of the materials are delicate and they can easily react to the climatical changes, whereby you'll find that you are changing the quality of the raw materials. So if you want to achieve a better material control, we have to be having a proper storage facilities whereby we can make sure that everything is kept safe. The second last, we can talk about separation of duties, such as departments involved in handling materials as separate. This separation of duties is mainly in these big companies, because these small organizations, you find it is hard for them to be distributing those different departments, but it is better you do the separation of duties whereby the people who are handling materials, let them be separate from those people who are in the procurement department. You be the procurement department, let it be somewhere, but you have also the store keepers or the material inspectors, whereby they can always notify you whenever they find that some of the materials are getting spoiled, others are getting outdated, whereby you can be able to get every information that or monitor whatever the raw materials you may have kept in the store. So we need to separate the duties. We leave the procurement department to do only the role of procuring the raw materials and looking for the suitable suppliers of the raw materials. But when you have received the items, let those items be handled by the stores department. The last one we can talk about, material purchasing should be done centrally by a qualified person. As we are going to see in the next slides, how we can procure goods using centralized system. But to talk about briefly about it, is this centralized system is where organization or where the purchasing function of an organization is only handled by one person, that the different departments within the organization, they submit in their requisition letters or notes to ask for the raw materials they want to use in their department. Now it will be the role of the procurement officer or the purchasing manager to go in the market and try to look for the customers which can supply the goods on a given date and in a specified period of time within the rightful quantity that is needed in the organization. So when you do that, you make sure that the company is receiving the good quality materials which can be used to produce good quality output or products. So having known the policies that we should use to achieve a good quality or a good material control, then allow me to take you through the purchasing or the procurement function. Because we've been talking about how the materials reaches in the store, but we want to find out how do we look for the customers, for the suppliers who are going to supply raw materials to the company. And this is the procurement function. When you are doing these course units, don't focus much about going into the deeper procurement department, because this cost and management accounting, we just take some highlights on some of the things, but when you are reading, don't go deep into the procurement, because procurement itself is a different and it's idea or concept which is a different discipline on its own. So when you're reading through these notes, make sure you're just taking just a highlights to help you understand what is done in the procurement department. So when we are doing the procurement, we are just going to look at how we look for the client, for the suppliers who are going to supply goods on let's say on credit or by cash, and we look at the documents. What are some of the documents we need to prepare so that the procurement process goes well. So the procurement function, the procedure of material acquisition and control vary in different organizations. We say the procedure of material acquisition and control vary in different organizations, but all of them follow a general pattern in the purchase, receipt, storage, and issuance of materials. Here we are trying to look at certain companies use different procedure of how they purchase their items and how they control them. It depends on the size of the organization, but at least what they have in common is that when they are procuring the items, they go through the same stage. Even at the time when they're receiving the materials they have bought, they also go through the same procedure. Even when they are storing those goods, they go through the same procedure. And even when they are issuing out the materials, they also go through the same procedure. The rest may be different, but those ones, they are the same to all the organizations, whether it is an NGO, whether it is a government entity, they all go through this procedure of procuring certain items or material. The function of purchasing and receiving of materials fall under the purchasing department, while issuing and storage are under the department of store keeping, which also falls under the purchasing department, which serves as a support service or supplementary in an organization. Here we are talking about that when you're buying the goods or when you're buying the raw materials from the suppliers, that role is handled by the procurement manager or the procurement department. But when we are receiving the items, we don't receive the item through the purchasing department. We receive those items through the stores department, but that stores department is under a broad umbrella of the procurement department. The stores department is the one responsible for the issuing. Why? Because we've already received the materials and we've kept the materials in the store. So they are the one who's responsible when the material is moving out. And they are also responsible for the storage, how the raw materials are kept when they are in the store. So I hope you have got that. The basic objective of material purchasing function is to ensure continuous supply of raw materials to production and maximum reduction of the cost product. The main emphasis here is that when you are purchasing the raw materials, we expect that the material are going to be there on a continuous basis when we need the materials. So if we are to maintain a continuous supply of the raw materials, it comes as a result of selecting a supplier who is capable of supplying the company with the required material and as when it is needed. Secondly, we don't stop there. Having received the raw materials, we are also aiming at how can we reduce the costs we are incurring. When we reduce the cost we are incurring on the raw materials, we are also reducing, or we are also indirectly reducing the cost of the product. Because if we buy the raw materials at a cheaper price, we expect even the cost of the output to be cheap. So we don't concentrate normally on the raw materials, that making sure that they are available as to when they are needed, but we also go ahead and ensure that we receive those raw materials after screening those suppliers, and we see who is capable of supplying us the raw materials continuously, and they also supply us those items of a high quality but at a very minimal cost. That's all about the procurement function. So let me talk something brief about the procurement manager and the roles and the qualities, because if you don't have that person, then you will not be able to get the continuous supply of the raw materials, and you will not also be able to reduce the cost because you have an incompetent procurement manager. Let me talk about the procurement or the purchase manager. This is an officer always in charge of ensuring that the right quantities and qualities of materials are purchased at the right time, right price, and from the right source. So those are the things they do. Having sourced out the suppliers, they make negotiations with the suppliers depending on the quotations they have incurred, and the quantity and the quality of the material, if the person can supply the rightful amount of material that is needed in the production process. They also bargain about the time, when and where they're supposed to deliver the items. So when you're talking about the procurement manager, we have to know some of the qualities. I'm just going to talk about like 3 of them, but there are many. You can search about them and you add on your own. One of them will have integrity. Personal integrity is an important quality of the purchase manager, because purchasing those materials involves committing or putting in a lot of money in the process. When you are procuring those items, we are spending a lot of money. So when the person is not when the person is integrity or the capacity, someone, you can't trust the person that this person cannot really do something on his or her own knowledge and based on their skills, then we expect that that person is going to make us put the money in onto a wrong, and it will cost us when you are producing those items, and it make the goods become very expensive. The other one, we can talk about initiative. When you are talking about initiative, when you are dealing with so many suppliers, because you first shortlist the suppliers, you first search for the suppliers, you get their quotation, then you start screening them. So if someone cannot initiate, someone can give you an offer, you've seen the company is capable of providing you the materials you need and the right quality you want, but you find that the price is the only making a difference, whereby the person has to at least have that say, whereby they can negotiate with the suppliers, and you see that the company is benefiting. So it's not that the person is just supposed to be there to just receive things and make decisions depending on whatever they have brought. They have to put in their own efforts to make sure that we've got alternative sources, we've got whatever is needed for the materials to be provided to the company. Then there is also ability to learn. Someone who is there all the time to learn, because when someone is connected to the market or to the market forces of demand and supply, there are so many changes. At some point, you may find that even the price itself, it keeps on changing. So when someone goes into the market, you should be able to learn more new ideas, which you will bring to the management when you're advising them on which procurement advice you could give to them management. I hope those ones will be enough. Allow me give you some of the duties. The other one, we are talking about the qualities, but let me talk also about the duties of a purchasing manager. What will be the roles of the purchasing officer or manager? What will be the roles and responsibilities of this person? First of all, to organize and direct the procurement function effectively. how can you direct the procurement function effectively is by making sure, because we go by the main objective of the procurement department, that it is supposed to give us the continuous supply of materials and we minimize at a minimum costs. So you go through the whatever someone is supposed to do to make sure that there is a continuous supply, and at the end of the day, we are reducing on the cost of production. The other thing we can talk about is to prepare purchase budgets, because when you've made the negotiation, before you go to the field to make negotiations, you have to first know what are the demands, what are the company demands as far as the production is concerned. Having known the item we want, then you can draft a budget, or you make a forecast that basing on whatever we used the last, let's say last year, we assume that this year we shall add an extra of this, or we shall reduce, depending on how what you produced went or were sold and how the remaining can be sold. So you prepare the budgets before you go to the field. Before you go to the field to look for the suppliers, you know what you really want. The other one is to advise the procurement committee on the right source of supply. You advise because you are the one going in the field, so you should be knowing people who can supply the company the materials, and you should also be knowing the price, how they can supply, how fast can they supply the material, and at what cost. So you'll be advising the company, because in this advice you may be, let's say you may be having a supplier who can supply goods of a right quality, of a good quantity, but the supplier is, let's say, far away from where you are operating from, whereby if you are to incur, you will be incurring, when you're transporting those bulk materials, you will be incurring a lot of costs. You can advise the management to buy at a place which is near, but even if the price is a bit high, but you compare the transport costs that is supposed to be added to the cost if you take the other long distance supplier. Those are some of the guidelines someone is expected to give the management. The other one is to execute agreement and placing of orders on supplies. When you shortlist the suppliers, they give you their quotations. When you have got the quotations, of course, they have their terms and conditions on how they deliver those items and when you should make an order so that they can deliver in the time you are saying. And they also have their, like in terms of the trade discounts and the cash discounts, depending on whatever they had put there. So you have to go ahead and go through whatever the company is suggesting, then you compare with what you really want, and you see if you can achieve what you are supposed to do. Because by the time you press a purchase order, you are able that, and you are really willing to cooperate with whatever conditions those people are giving you. Next one, we can talk about follow-up of purchase orders to ensure timely delivery of the ordered goods. When you make an order for raw materials, you make sure you don't just stop there that I made my order, so I'm just waiting for them to respond to me. You keep emailing them, calling them, finding out how fast is it for the company to receive whatever they are ordered. The reason as why they are supposed to be doing so is that when you don't do so, you may find that the production will reach at a point that the material is done and people cannot work because the material is also completed. So to avoid those things, you make sure that you keep following on the orders you've made so that they are delivered in the period when they are needed. The other one is receiving the material as per the specifications and placing of orders. That one is self-explanatory. Then we can talk about the inspecting and testing of the raw materials. When you buy the items, you will have some of them you may test to find out whether the quality you are requesting is exactly what they are offering to you. Most of the times when they are when suppliers are sending their quotations, especially to those items which needs to be tested to confirm their quality, some of the suppliers, they, on top of the quotation, they make sure they put even a sample of the item so that they can test and confirm whether it is equating to the standard that the organization needs. The other one we can talk about with which are not in order with return the material which are not in accordance with the orders. That one is self-explanatory. Allow me explain the one for the confirmation and authorization of bills of payment for the supplier. Of course, they are the ones they confirm. Reason is that they are the ones who initiated the process of procurement. So they have to confirm that what they made in a purchase order is exactly what they have received. So they arrange or they authorize the payment that it's okay, you go ahead and pay. We've received the exact information or the exact material that we ordered for. Then the last one we can talk about to give suggestions to top management for important purchasing decision making. That one we spoke about it. You advise the management on how the purchase or the requisition of materials should be handled. Having known the duties of the purchasing manager, let's also talk about some of the inventory records or some of the documents which are used in the procurement department. Because we said in the procurement department, there is a stores department, which is within the what? The procurement. So we expect one of the records or the books we have in the procurement department, we have a bin card. A bin card is only and only responsible for recording the quantities, not the monetary values. We are only recording the quantities of the material we've received, materials we've issued, materials we've returned, and the balances. We are only recording the quantity only, not the monetary value. So this is a detailed document showing the quantity of goods kept inside the store and prepared by the store keeper. At every point of time, he or she records every receipts, issue, and balances. So when we know the balances, we've known what we've issued out, what we've received, we can also know the maximum and the minimum, and the reorder level, when to place another order. Or we know which amount are we supposed not to exceed, so that we don't understock our material. And what is the maximum that we should be having so that we don't overstock our materials. Then the store ledger is where we record the quantity and the value, or the monetary value of the material. We record that in terms of the issues, the receipts, and the balances. They also help us in maintaining the stock levels. But when you are preparing the store ledger cards, for them, since we are attaching the monetary value, then the concept will come as, how are we pricing these items we are receiving? Then we shall be using other different methods of inventory valuation, which include the first in, first out, and the last in, first out, or the weighted average cost. Those are the three methods we use when you are valuing the stock in the store ledger cards. And the reason why we are putting the price component or the cost component, we are trying to look at the value of the closing stock. When we know our closing stock, we can transfer that figure and we use it in when you are preparing financial statements, because you know that the closing stock will appear in both the balance sheet and the income statement. So I'm going to give you some of the differences between the bin card and the store ledger. Because we said in the bin card, we are only recording the quantity. There is no monetary value that is attached. But for the store ledgers, there is monetary value. Then we can also talk about where these cards are, where they kept. That's also a difference. That in the bin card, those, since we are just recording the quantity, they are supposed to be in the store ledger. But for the stock ledger cards, since for them they have the monetary value, then they are supposed to be in the accounts or the cost accounts department. In the bin card, transactions are posted individually. You do each item is posted on a different bin card. But in the store ledger card, you may find that we can do even like for a certain period, we can make sure that we are recording one bin card, which is having, let's say, on a monthly items we purchased on a monthly basis, let's say on a quarterly basis. Then in the bin card, posting is done at the time of issue of material. That's when we make the recording. But when we are in a store ledgers, we make issues, posting is done after the issue of the materials. The last one, entries in the bin card are posted by the issue clerk, whereas the other side they are posted by the store ledger clerk. And in all of them, we are aiming at recording the quantity and the amount. In the bin card, we are aiming at recording the quantity of the minimum, maximum, and the reorder levels. But for the store ledger card, for them, we want to put even the quantity plus the item plus the value themselves. So allow me go to the stores management systems. These are the systems which we use when we are doing the purchase. So when we are doing the purchase, these are some of the few things we can use. One of them is the central store. Under this system, the storage and the purchase of material for the whole organization is done under one department headed by the procurement manager. For this one, every department submits its purchase requisitions, notes or letters to the central purchasing department, and they are all handled by the procurement. All the departments within the organization, which may be the production department, finance department, marketing department, and other departments. For their heads of those departments makes the requisition, and those requisitions, they are submitted to the procurement manager so that he can go ahead and make the orders. As you see the diagram, all the other departments, they are giving out their purchase requisitions to the central purchasing department, and it is only the purchasing manager which is supposed to go to the market or to look for the suppliers. Let me talk about the advantages of the central purchasing system, and one of them is that it is cheaper in the sense that we can pay less since we are buying in a bulk, or we are buying a lot of items. They can give us trade discounts and other discounts depending on the number of items we are taking. So when the item, because when it is only one department buying the items, it means we are going to be having a lot of items we are purchasing. So when you are purchasing a lot, you expect to be receiving trade discounts, which are a benefit to the organization. So it will be cheap. The other one we can talk about, it ensures the right quality and quantity because of specialized personnel. Here we are using a qualified person to go and to go in the market and look for the suppliers who can supply us with the material that is of high quality and the quantity we need. So we are capable of getting the material that is of a high quality. And since it is handled by the professional person, so we expect even the continuity of supply to be good, because you can outsource the people who can do a supply to the company. The other one, you can talk about buying and carrying costs can be reduced because of bulk purchasing. When you are purchasing goods in high value or in high quantities, you may find that even where you are buying those items, they are giving you free transport, to the extent that even the people who are going to give you transport, even if the supplier doesn't give you the transport, when you are giving these transporting companies to transport your goods, they will not charge you highly, because you will be giving them more jobs, because you are buying in bulk. There is a lot to be done, so the costs tend to be a bit lower as compared to somewhere where people are buying in few items. There is minimum investment in stock, since the requirements of all departments can be pulled for determining the stock levels to be held. There is minimum stock investment because we go in the market at once and we buy whatever the whole organization is going to be using. So from there, we are sure that this department needs this amount, because we can know that this department needs this amount of resources or materials for its activities to take place. So we shall be knowing the level, these stock levels, how and when the material is supposed to be done, and how we can make another purchase. The last one we can talk about is a reduction in expenditures. In these expenses, you can talk about when you're paying so many, when there are so many clerical staffs or clerks, which is minimized by this central processing, because it is only one department handling. We are not supposed to recruit supporting staff to come and be in each department to cater for the store or the material we are purchasing. Everything is catered for by one person, so some staffs are eliminated, and when you are eliminating some of these staffs, it means you are reducing on the cost of production. So allow me take you through to the disadvantages. Yes, it is okay, we've got very nice advantages out of the central purchasing system, but there are also other disadvantages. One of them will have high cost of transporting heavy and bulk materials to the user department. Sometimes they may find that yes, you are transporting the goods in bulk, or the workload is there, but the things are very heavy because you are purchasing heavy item or so many items. So it becomes very heavy to the extent that you are supposed to incur a lot of expenses in terms of loading and offloading of these transporting companies, which increases also the cost of production. The other thing we can talk about, the material issues may be delayed because of many formalities. For example, these requisitions, they go through different steps. The head of department first approves. After approving, then you give it to the procurement. The procurement also goes through. There is a lot of bureaucracy there. So by the time the materials needed, and someone has to go through that process to make sure that the order is, or the requisition of certain items are bought, you find that we may lack stock just because of the formalities that we have to go through so that we get the stock on board. The other one, it is risky to keep all materials in one central store. In case of losses by fire, by floods, or theft, we lose everything. It is very risky to keep everything, all the company documents at the same point. We keep the checkbooks in the same way we are keeping the other stationery. So we may lose some items because of keeping everything at the same time. It is not safe and it is a bit risky. The last one, we can talk about lack of good keeping and material handling because of overcrowding. the materials are congested in one room. You have the checks, you have other stationery, you have other materials that are used in the cleaning, you have everything at the same place, meaning the goods are congested. There are also, some of them may be even contaminated because you are putting everything at one point. Let me talk about the other type of, the other system, which is the decentralized purchasing. Decentralized purchasing is the opposite of the centralized purchasing, meaning the disadvantages of the centralized purchasing becomes the advantages of the decentralized, and the disadvantages of the centralized become the advantages of decentralized purchasing. So I'm not going to give you the and the disadvantages, but I just wanted to use that approach whereby the advantages for decentralized purchasing, there will be the disadvantages of decentralized and vice versa. Under this system, all departments within the organization can fulfill their own demands by doing localized purchasing. Every department, let the finance department go to the market and buys whatever they want from there. Let the marketing department go to the market and they buy whatever they want. Each department makes its own process. In this one, the advantage you can talk about, one of them you can say that in this process, there are no delays because of following the formalities, because it is only the head of, when the head of department approves, you go in the market and you buy. That's how it is. It is very fast, meaning we cannot lack stock. So I told you, you check the other side and you look for the advantages and the disadvantages. Let me go to another type of store, which is the impressed store. Impressed stores, these are the system which based on the cash, on the petty cash. It's where the company makes, they buy items. Let's say if the company is shipping the raw materials from abroad, they budget that this amount of money will be enough for the period. And by doing so, they go in the market and they buy the materials as per the plan and they bring to the organization, meaning that material is already budgeted and they know that this material is supposed to serve for this period. It is mainly used in those big companies where they use specialized standard materials, whereby those materials, maybe they get them from far, so they are supposed to order them in large numbers and they keep it for some periods. That's how it is. Allow me go to maybe to give you the some of the advantages of this impressed costs. There is reduction in clerical work as materials are requisitioned only once in the period. Let's say assume that this year we may use stock of 10 million. We go in the market, we buy the stock of 10 million, we bring at office. We have done that one once. It is no more going back there. Then the other one we can talk about, it is easy to calculate the usages as the same is the difference between the impressed cost and the closing stock. We can determine the of the material we have used. We can just get the quantity we bought, we less the closing stock, so we shall be knowing what we've used. The other one we can talk about the risks arising from in production and the production hold-ups owing to delays in delivery of material. Here we are not expecting delays because the material, they come before even the production starts. We budget and we say we use this, let's say 10,000 tons of, let's say, cotton. So we provide that 10,000 tons and we keep them until the estimated. Whatever remains becomes the opening stock for the next month. And we can just deduct what remained from what we have bought to get the materials we've used. And when we get the materials we've used, we can use even that one to a benchmark for making a forecast for the next coming period. Allow me to talk about some we use in material control. Some of these documents we use in the material control have the material requisition note. We've been talking about the requisition. Now this is the material requisition note. It is a request made to the purchase department to procure material of a given description and a required quality and quantity within a specified period of time. What we are supposed to be knowing is that we put the time when we need the materials, meaning we are supposed to request for the material before all the stock is done, depending on our stock levels. The other one, we are supposed to put the quality and the quantity we want. Then the last one we can put is that we submit the request to the procurement department. If at all we are using the centralized system of purchasing. If it is just the other decentralized, then we just go by the heads of department, they approve and we get everything. So this document is prepared in triplicate. We prepare 3 copies. The first copy is kept by the person who is initiating the purchase. That is the first copy. Then the original one, we give it to the procurement department, and the other copy we may put it to the approvers, so that when you are distributing those copies, by the time the other procurement approves, even the other approver, you may find that they have already approved, or by the time they go through, even the other parties, they are going through and they can make changes as to when they need and whatever they want to exclude. The other document you can talk about is a bill of material. This is a summary showing all the materials required for a particular job or a production run. This is just a list of whatever that is needed in the production or that is needed for the production to take place. It is an advance requisition to the storekeepers for making available the desired material at an appropriate time. This one, it is prepared for in advance. Remember, when you're when you're making a requisition, it may be by a department, but in the stores department, for them, they make, when they are preparing this bill of material, they make it for the whole organization. But each department keeps on making a requisition depending on whatever they want. But there is already a bill of material that is already there for the whole company. Then generally 4 copies of it are prepared, and 1 copy goes to each of the following departments. We have the stores department, production department, cost accountant department, and the production planning department. And it is useful for the following. 1, provides a quantitative estimate of the budget of material required for a given job or process. It substitutes material requisitions and expedites the issuance of material. Thirdly, it provides a basis for charging material cost to the respective cost centers or processes or jobs. When you know the list of material that, let's say, a certain department wants, you will be able to ascertain the costs that are going to be incurred in that process or in that department. The other one, the storekeeper can draw up a plan of material purchase and issue for a given time. So allow me go to a next document, and the next document is called goods received note. The material receiving section is responsible for receiving the goods and verifying the contents of the packages along with the goods received note sent by the supplier. When the supplier sends the goods to the company or to the organization, the supplier provides also the goods received note, identifying the items that were supplied as per the purchase order we drew to the supplier. So when the receiving department, they receive those goods, they start inspecting what is the quality they have provided us and what did we ask for in our procurement or in our purchase order. This section should ensure that the goods have been received as per the purchase order and recorded in the same consignment. A consignment is like a lot that is sent from the supplier, or a batch of goods that are requested for by the organization. That's a consignment. But a consignment is a document containing the goods that have been supplied. So generally, this goods received note is in 5 copies, and those ones they show how the material we've requested and how we've received and how many we've received. The original is sent to the purchasing department, 1 copy the stores department, inspection, accounts, and others also retained by the receiving department. Then the other one, we can talk about material delivery note. This describes what a package contains, including the description and the quantity of goods delivered, and gives an overview of what the recipient had ordered and what has been sent to them. This is more like the goods received note, but it is a bit different. This one comes with the goods. This one shows the goods we've received, and we compare those goods with our purchase order. So I hope you can get the difference between those two. We have a material return note. That one shows the goods we are returning. Either we may be returning the goods to the supplier, or we are returning the goods from the people who have issued. We may receive the goods and we issue the goods, let's say, to our departments within the organization. And some of the materials, they have not used them, so they return some of them. It may be within the organization, or it may be when we are giving it out to the supplier. We have the material transfer form. It's a transfer when you are removing goods from one place to another. Then the last one, let me talk about this one as the last one, which is the purchase order. Because I don't want to go more into this. This is a procurement, as I told you, it is a procurement discipline, of which we are not supposed to go through deep into this. What we are supposed to know is briefly how the goods are purchased, what are some of the documents, what are the advantages and the disadvantages. Those are the things we are supposed to be knowing. The rest is not covered before in our syllabus. The purchase order, this is a letter sent to the successful or the selected supplier, asking them to supply the specified amount. Now the purchase order is done when the organization has already screened the person who has been selected by the company to supply those items. Then they give them what they really want. Because by the time when they are searching for the suppliers, they send in their quotations. When they send in their quotations, we view the quotations. After reviewing the quotations, we select which one can supply the items, and not stopping there, we also go ahead and check is going to supply those items at what cost. So we select the one which is going to give us the rightful quality and quantity, but at a least price, because that is the main emphasis of the purchasing department or section within the organization. So that is how it is. We put the quantity, the terms, the time of delivery, and the location where they're supposed to deliver those goods. We put even the rates. Those are the most of the. I'm not going to be drawing these documents so that you can have a look at them, because at our level, they will not be asked. No one can ask you that you present for me, draw for me a purchase order. But what you should know, what are some of the things which must be there. Of course, we expect the rate to be there, or that's the cost. The cost price, we expect the terms of the supplier. We have the quantity, the time of delivery, and the location where to deliver those. Those are the things. If you know where you are taking the goods, you have the price, the amount, the time they want them, then you deliver. That's all we are interested in knowing. But this purchase order is also prepared in 5 copies. The original is sent to the supplier, then these other ones, some of them is retained, because as you know, the purchase order is originating from the purchase department. So the purchase department, since is the one submitting the purchase order, is supposed to remain with a copy. Then the storekeeping will have a copy for confirming the goods when they receive them. Then the accounts for preparing the payments. Then the inspection also to view the quantities, the value, the qualities, and other things they may inspect on the commodity. Then let me give you some, because I thought about this one, that why shouldn't I give you some, what are the reasons, why are we supposed to be having, why are we supposed to be knowing those source documents or the supporting documents? There is a reason why we are supposed to be knowing those ones. Of course, when you know a document, let's say the purchase order, what is the use of a purchase order? Those are the things we are going to talk about here. Reasons for keeping the supporting documents. Let's say when you supply goods and they give you an invoice, what is the use for that invoice? If they give you a receipt, what will be the use of that invoice? Those are the things that receipt. Those are the things we are looking at. All materials be either from the supplier or the local market should be properly authorized by the concerned people, because it acts as a proof that material purchase has been approved. So whenever you are making a purchase, even if you are just going to be buying those goods by cash, they are supposed to be having a signature of the approver to confirm that those items we've bought, they were actually authorized to buy them, or we needed them in the organization. That's why we are authorized to buy them. The other one we can talk about is, upon receiving the materials from the supplier, they should record to ensure that material have been duly received in the store. Because if you don't get those goods received not, and you try to get the items they have supplied and you record them in the books, we are not going to be having any information of which we shall be using to generate other statements. So it is important when they bring those goods, when we've received them, record them so that we know the quantities, the quality, and the price. So where are we recording this information? The quantities, we can put them in the bin card, as we said, or in the store ledger cards. There should be an invoice from the supplier for the material that has been delivered. And if paid by cash, the receipt should be provided to provide the documental evidence for material cost, because we want to know that we've bought this item at this price. So how are we confirming that? By getting either the invoice or we get the receipt to confirm the exact figure we've incurred. Lastly, we can talk about when material delivered should be recorded, and even when returns or issues to different departments or cost centers, hence knowing the cost of material used in each department. When we have received those materials and when we are returning, or when we receive some goods, let's say from our other departments, the unused materials or the remained materials, we should also adjust so that we can know that each department has used this and this amount of material. We know the cost and we know the amount. The last one I'm going to be talking about is the procurement process, because we've been talking about how goods enters into the organization, but we haven't known which steps are we going through so that we can procure goods. So this is just a brief idea. I did not explain as in making notes on each of every item, but at least having understood what I explained, what I've been explaining, we can just get the information on whatever things you are seeing here, because they are very easy. And I can, maybe to just help you clarify some, let me just start with, when you're making when there is a need for raw materials, that's where everything starts from. When there is a need for raw material, let's say we need raw materials to produce certain items or as per the client order. If let's say we have an order from the client and we want to give the client the items, but the items themselves or the products, they are not available. So what we do, having received an order or having known that there is a need for a certain item, we do the requisition. We write the purchase requisition, and that purchase requisition, it is a form showing whatever amount of raw materials we want, the quantity, the quality, the time when we need it, and we submit those requisition forms to the purchasing department or to the procurement manager. When we submit those documents, then we may be using either the centralized, but let me use the centralized. For example, when the company is using the centralized system, having submitted that requisition forms to the purchasing manager, the purchasing manager goes into the market and starts looking for suppliers. That's the next step, which is called search for suppliers. How do they search for the suppliers? They can search for those suppliers through making adverts, and they give people to bid. They give them adverts. When they put adverts, of course, people can apply. By the time what they put in that advert, they put what they want to be received and how long they want to be supplied with those materials, the quality, the quantity. Of course, they don't put the price. They may put the price or they may not, because sometimes the price is not affected by the company, or the price is not influenced or determined. Most of the time is not determined by the company. It is determined by the max forces of demand and supply. So for them, they just put what they want and they leave the price component, because if you know the price, then you should be buying. But since we are searching for customers, for suppliers, it means we don't know the price. So when after making those adverts, we expect people to come and be applying. But when they're applying, what we put in an advert was like, if the company can deliver those items we have listed down, then they should submit their quotation. Submitting the quotations, it shows how much the company can supply to the organization, and at what price, even the quantities and the qualities, and how fast they can deliver those items. Having done that, we've received the quotations, then we screenshot, or we do screening of those quotations. Then we select those suitable ones which can deliver to us what we need at the right time, in the right quality and quantity. Then, having selected those ones, we can either go back and advertise them that we've gone through, or we call them. When we call them, then we send to them a purchase order. When we send a purchase order will be having the items we want, the rates. Of course, when they are supplying their quotation, they put the rates at which they are selling the items. So we shall be having the quantity, we shall be having the rate and the amount, plus the quality, the description of the items we want. Having made that purchase order, then we expect to receive the goods. When the supplier is submitting the goods to us, it comes with the goods received note. We verify everything through the receiving and the inspection department of material, or material department. After they have reviewed everything and they find that it is okay, then they will get us also a purchase invoice. To the extent, if let's say you are paying cash, if you are paying cash, you just pay direct. Having verified that whatever you've received them and you've inspected them, they are okay, so you can pay if you are using cash. If you are not going to use cash, then they give you the invoice. When you receive that invoice, then you arrange on how to make the payments. Then the process, when you clear the invoice, then the process will be done. That's how we get to have the material we are using in the production. So allow me stop here for today. And in the next video, we are going to be handling the techniques of inventory control. These are very, very, very key because they involve some calculations, and I made them separate because they have some calculation which we are supposed to go into, but we go into slowly as you get to know much. I encourage you guys to subscribe to my channel so that you get to know more and more, because we are dropping more videos which can help you understand. I wish you the best until we meet in the next video. Good afternoon, viewers. This is your tutor again, CPA Charles Cafe, and today I'm going to take you through the inventory valuation, and we are going to take a practical question, and this question is from CPA, that is Cost and Management Accounting, question 2, level 1. It is question 2, part B, May 2019. That's what we are going to be looking at, and we are going to find out how we can value our stock, the stock we have in the store. How can we value that stock, especially when we are issuing some stock out and when we are buying out some, we are increasing our stock. One of the reasons why we want to look for this value for the stock, or why do we really want to know the price at which we are costing these inventories we are receiving? One, we want to know the figure for the closing stock, and that closing stock, as you know, in our financial statements, you know that closing stock, if it is finished goods, then it will be going for income statement and the balance sheet. So we need to know what will be the figure at the end of the period that we shall be having, so that we can transfer that into making other preceding documents or financial statements. And the other thing we need to know this thing, we need to know we are costing those items at what price. If we are issuing them out, are we using first in, first out, or we are using last in, first out, or we are using the average costing method? Those are the things we are going to be looking at. Today, I decided to pick a very simple question, but just note it's very simple, but it is a standard question. So I picked that so that it can help us to understand how we can go when we have other complicated scenarios. So this one is just acting as a basis or a foundation that will help us to handle where we shall be seeing other complicated issues, like having returns on purchases, returns on issues, when we issue out those goods we've returned. So we are using which price. So I use this as to make sure you get a foundation that can help you really understand and make sure you can analyze as we go further. Because when I do this, I'm going to start with FIFO, because the question is saying they're asking for FIFO. The company is using FIFO. So when I finish this, we may use the same question to see the other formulas, or we may select a different question and we use other methods. But as we know, when we are doing inventory management or inventory valuation in cost and management accounting, our emphasis is to look at all the three. It's not like in financial accounting, whereby you are looking at those inventory valuation methods, we only consider the FIFO and the weighted average, because the other one of LIFO doesn't recognize the IS2 of the inventory management. So when we are doing cost and management accounting, we are taking everything, because for us here, we are not following the IS2. So allow me proceed and we'll go through the question so that we can analyze each and everything. The question says, Tase Juice Uganda Limited, located in downtown cities of Kampala, is the leading producer of fruit juice in the central region. TJU buys a variety of fruits from Owino market, such as oranges, pineapples, and mangoes. Now you see these oranges, pineapples, and mangoes, those are the raw materials they use in the manufacture of that juice, which are supplied directly to TJU's store. The fruits are then processed, packed in different brands, and dispatched to the shops and supermarkets where they are sold. On 31st March 2019, the store ledger card showed 350 kilograms of fruits in the store, valued at shillings 4,500 per kilogram. This date they are giving us, it is the date of the previous period. Remember, our period, the one we are computing starting from, we are looking for the closing stock of 30th, that is 2019. But what they are giving us, this was in March. It means this one, which was the closing stock at that time, it will be our opening stock at April 1st. It will be our opening stock. So the opening stock units, they are 350 kilograms. They are valued at 4,500 per kg. The company uses the FIFO, that is first in, first out method, to value the inventory of raw materials. The following information relates to the fruits received and issued during the month of April. So we are seeing what we have: a table, we have the purchases, we have the issues. So what we have here is that since this is a raw material, this is not finished goods, it's raw materials, meaning that these are the raw materials we are going to put into our production so that we can produce the juice. So they gave us the purchases, the date, quantity, the cost. Now you're seeing here they're giving us the quantity in kilograms, but they have given us, this one is a total cost, because they have given us cost, meaning it is the total cost. It is in thousands. That's why you are seeing these zeros up. They will be part of these figures. So it will be like for the first one, it will be 1,380,000. So they've given us the date and the quantity. So required, they are saying prepare TJU's store ledger card and determine Roman 1, the value of closing stock as at 30th April 2019. Those are 14 marks, you see. So those people who are fearing CPA, I'm telling you, the things are passable and people pass it. So you just need to concentrate. Don't skip anything, because even those theoretical aspects, see, they are asked and people can get a lot of marks out of there. Then the part Roman number 2, they are saying the direct material cost charged to the production. Here they are saying the direct material cost charged to production. So what we want to find out, what was the cost of those issues, leave alone what we've purchased, but what is the total cost of what we issued in the production of juice. So when we are trying to look for these direct material costs, it will be the cost items we issued out, the total of it. It will be our raw materials that are consumed in the production. Hope you've wrote the question. Allow me kick off. So I had organized something here. We have to start with our heading, and our heading is going to be Tassages Uganda Limited. Then we put what we are preparing. We are preparing a stores using FIFO method. Using FIFO method, they have given us when we are supposed to prepare that, because when you see here they said as at, that's why I did not say for the period ending or ended. I said exactly what they told what to do in the question, as at 30th April 2019. So we are going to be having, this is how our store ledger card or our stores ledger account is going to be looking like. It will be having what we are receiving as in terms of the purchases and what we are giving out to the production department, because those were just the one we are receiving, they were just raw materials. So what we are giving to the production and the balance that is going to be remaining. Those are the most important things which we are supposed to put. We must be having a purchase, we must be having an issue, and we must show the column for the balance. The reason why we are showing this, we are showing how much we've bought, we are showing we've issued out, and what is remaining. Those are the things we know or we need when you are preparing the store ledger account. So when you are using FIFO, the difference in terms of which raw FIFO, as the name says, first in, first out. It means you receive first is the one that is supposed to be issued first. If let's say you receive a batch of 10,000 units, and that 10,000 units you've received, we make sure when you are issuing out those raw materials, we make sure we first complete the 10,000 before we go to the next batch. So that's the main difference with the others, as we shall see. Okay, we can start. Here we have the date. This shows when the transaction took place. This is a particular shows what we did, if it is an issue, if it is a return, if it is a purchase, everything goes here. This is a detailed section. We put our narrations. Then the units, of course, those are the units. They are in kgs. They told us they are in kgs. So can adjust this one a bit so that it fits. Yeah, we can even adjust this one a bit. Hope it's okay. We have the unit cost. This is the cost at which we are receiving those items. This is the unit, the whole total cost, as we go on with the balances and whatever. Because what we want in the balances, we only want the number of units are there and their amount. We don't need the unit cost. But other people, you may find, or other books, you may find when they have put the unit cost in the middle of the balance, the units and on the balance side, but it's not needed. We can start off. They told us we had a balance, so a balance comes as a balance, a purchase. We can start with our date. We use the financial, the format of financial statements. We say 2019. Since the period is not changing, we can maintain and we say April. It's only the date which are going to be changing. This is April 1st, 01. Then our details, we have balances. They told us those are balances. That's what we have at the beginning of the period. Balance blot, you can put even blot down. Balance blot down. Allow me use that shortcut. Then these are not, we are not purchasing, but we just have what? The balances. They told us the units were at 4,500. The units are 350 valued at. We can try to compute the answers here. It will be equal sign. You start with the equal sign. These units times the 4,500. So it is giving us that. So our cost is going to be 1575 triple zeros. I'm not excluding the zeros. I'm just using all of them as they gave us. So you've seen how we got that. Then when we go to the second, I'm just going to put second. We had, what did we have? We bought. We started with the purchase. On the date, we did not have any transaction except the balance we had. Then on second, we had 300 units. These 300 units, they were all at 1,380,000. It means we have to look for the unit cost by taking the total cost divided by the number of units to get our unit cost. It will be, they said 300 units at 1,380,000. We have purchases, units, they are 300 kgs. That one we are not given. They gave us 1,380,000 as our cost, total cost. So if you want to know the cost, you get this divided by this, meaning it was valued at 4,600. But when you make purchase, make sure we are adjusting also the balance side, because the stock is going to be increasing. We say equal sign this. If it is increasing, we add. If it is reducing, then we're supposed to subtract. But this one, sorry, I've added the wrong one. It's supposed to be this. We are adding units plus these 300 units, which will give us 650 units. But these 500, they are be valued at equal sign this plus this, the amounts. Then we go on. If there is the transaction on 3rd, the next transaction happened on 8th, we issued out 400. On 8th, we had an issues of, we issued 400. But remember, we issued 400, but since we are using FIFO, we said FIFO recognizes the first transaction. They are the one is to be completed first, then we do the other one later. It means we are going to first complete the balance we had of 330. So we are going to first complete the 350. That 350 is going to be valued. They gave us our, say, cost. The unit cost was 4,500. Then the amount is going to be this times this. That will give us that. That will be our cost. Then we have to reduce, since we are issuing out, we have to reduce the stock. The stock is going to reduce by what we've given out minus the 350, which will remain, meaning we shall remain with the 300. Then we have also to adjust the cost to be this minus this. These 300 units, they are valued at this price. So remember, we had out 400 and we've first issued out meaning there is a balance of 50 units. Now these 50 units, they are going to be part, since the first batch is complete, so we are now going to go to the second batch. The second batch we bought 300 units. So if we bought 300 units at 4,600, it means on that 300, we are removing 50 units at a value of that. Then this one, the cost will be this time this, and it will give us that. So we have to reduce also the to be the 300 minus the 50 units. We have also to adjust this by saying that amount minus this. So it will give us this, meaning this 250, they will be valued at this. But this closing stock we have as per this date is part of the last stock we have, or the last batch we received. So that's, we are done on that on 8th. Let's go to the next transaction, which happened on 13th. 13th, we gave 500 units at 2,350,000. On 13th, we purchases. Sorry, it's supposed to be here. 13th, these are purchases. We purchased 500 units at 2,380,000. Hope it's the one. Let me first delete this. Is it 2,380,000? It is 2,350,000. This is 50,000. So this one to be here, 2,350,000, because it is the total cost. Then you have to get the what is the unity cost. The unity cost will be this divided by this. It will be valued at 4,000 because when you multiply this times this, you must be getting this. So we add just our balances. Since we have purchased another stock, it means now we are going to be increasing the stock. We add that, the 500, we are adding the units to go to 750. Then we also add just the cost. It will be this plus this. It will be that. Then we are done on 13th. So let's go to the next date. The next date is 14th. Make sure when you're doing this, you follow the dates. Don't do the number. Let's say you do the number, you do on second, again you go have to follow the date. So we go on 14th, we issued out 350. This 350, it happened on 13th. This is an issue, but we said we gave out 350. Remember, if these 350 were there, because we stopped issuing out when we had reached the second batch, and the second batch had only 300 units. It means, but on these 300 units, we removed the 50 units which we first issued out. So we remained with the 250. This is what you are seeing here. So we have to first issue out that 250 first, and we are issuing it at the same purchase price that is on the second batch. The cost will be this times this, which will give us that. Then we have to reduce also the balance here. It will be 750 minus the 250, which will give us 500. And we have also to reduce this minus this. So we had given out the 250, but remember we're supposed to issue out 350, but we gave out the 250. It means we are remaining to issue out 100 units. Those 100 units, they are now going to be valued at the preceding unit cost of the batch. That's why we've been calculating this unit cost to help us value when you are issuing out some stock. It will be 4,700. So when you multiply, it will be this times this, will give you that. Then you less also the stock. This, since we are issuing, stock is reducing, and you add just also the cost, that minus. So it will be that. That's what we are supposed to do there. Then we'll go to the next. The next date is, this is 14th. Now we'll go to 20th. 20th, we purchased units at a 400 units at 1,860,000. This happened on 20th. If it happened on 20th, it was a purchase of what were the units? They were 400 at a cost of 1,860,000. 400 units at a total cost of 1,860,000. So we check what will be our unit cost divided by this. That will be our unit cost. So we adjust our balance here. It will be this plus what we've purchased these 400 units. Shall we go to 800 units? We adjust also the total cost. That will be that. Then we'll go to the next date. The next date is 22nd, because this one is 24th. 22nd, we issued out 650. We issued, it is 22nd, we issue this. These are issues. We issued out 60. But remember, these 650, we are supposed to first complete the stock we had on the third batch we bought, which came on 13th. It means that batch we remained with only 400 units. So we are supposed to first issue out the 400 units, and when those ones are done, then we shall check the other one. So we first issue out the 400 units, but we are issuing them at the cost of the third batch. According to that, this time, sorry, cosine this, multiply it by the unit cost, and it will reverse that. we increase, we reduce the stock because stock is decreasing. So we have that to remain 400. Then we have also to adjust our total cost. We remove what we've given out and we remain with what is remaining. So we have done out the 400, but remember we are supposed to give out 50, but we have so far given out the 400. So we are remaining, we are remaining, because we said whenever we are starting a formula, make sure you are starting with an equal sign. That's why you've seen it was not coming. We are supposed to give out 250. This 250, when you the 400, you'll be getting the 600 and the 650 that was given out. So, but this one, since we completed this unit, so we are, this 250, they are going to be part of this. So they will be valued at this cost of 4,650. So what will be our total cost? It will be this times this. Let's enter. And we have to adjust also our stock by, since stock is reducing, we have also to reduce the number of units. Sorry, this, even this one, cosine this minus, we are issuing, so we remain with that. That one will be done. Then we go to the next date. The next date is 24th. We are purchasing. On 24th, we are purchasing 360 units at a total cost of 1,728,000. 1,728,000. We are the units. This is the units. They were 360 at a total cost of 1,728,000. Is it that? 1,728. 1,728. Yeah, it's that. Then we get unit cost. It will be cosine this divided by this. So adjust our balances. It will be cosine this plus this, the number of units we have purchased. We have to increase our stock value plus this. So that one will be done. We go to the next one that happened on 25th. We issued out 260. On 25th, we issued out, this is 25th. These are issues. We issued out 260. But this 260, remember, this fourth batch, we had completed only, we had remained with 150. So it will be the 150 that we shall first issue out. Sorry, it will be the 150 that we shall first issue out at a cost of 4,650. So it will be costing us this time multiplied by this. It will be that. Then we reduce the units. It will be this minus this. So adjust also our total cost. It will be this minus what we have given out of this. Will become to that. But remember, we are supposed to give out 260. We issued out only 150. So the balance, the balance is 110. This 110 is supposed to be deducted from the preceding batch, which was purchased on 24th. It will be valued at 4,800. Cosine this, multiply by this, enter. Then we can also adjust our units, because we are the number of, when we less, we have also to less the cost. We remain with the cost, the actual cost of the goods still available in the store. That one is done. We go on the next day, and the next day is, this was 25th. Then we go to 26th. We have again an issue, because this is 27th. First finish this one. We are issuing again 100 units. On 26th, we are issuing again, these are issues. We are issuing 100 units. But remember, in these units, we said we had a balance of this. This batch was completed. So on this batch, which was purchased on 24th, the 360 will move only 110. It means we can still issue out because stock is still there. This minus this, we are still having something, so we are valuing it at the same. So it will cosine this, multiply by this. Press enter, then we'll adjust our stock. Since stock is reducing, we have also to less minus this, cosine this minus this. So we've remained with that. Then we go on the next date. The next date is 27th. We bought 320 units at 1,488,000. 1,488,000. The units are 320 at a total cost of 1,488,000. These happened on 27th, and these were purchases. So we want to know the cost. Let me hope that the figure is 1,488,000. Yeah, it's the same, 330. To be cosine this, divide by this to get our unit cost per each. So adjust our balances. Since we are purchasing, now we are increasing our stock by 320. It will be that, it will be 470. Then we increase also, we value our stock at the right place. That. Then we go on the next date. That one is done. The next date is finished this. It is 28. Again, we are purchasing. We are purchasing because this is the 28th. This is the last one. 28th, we are purchasing 200 units at 984,000. We are purchasing 200 units at a total cost of 984,000. So these are purchases. They happened on 28th, and we need our unit cost. It will be this, divide by this. We add just our stock, cosine this plus this. We adjust also our total cost. It will be cosine this plus this. So we go on the last one. The last transaction took place on 30th, and we issued out 300 units. It was on 30th because our statement is ending on 30th April. So these are issues, and we are issuing out 300 units. Yeah, 300 units, the one we are issuing out, but we said these units were still there. The one we bought on 24th, we issued and we remained with the 150. So we are going to first issue out that 150 at a cost of this, the 4,800, and we make sure we have cosine this times this. Then we adjust also our stock. It will be this minus this. So it will be cosine this minus this. So we issued the last two because they were supposed to be 300. So it is 150 plus 150. But this one is going to be valid at our next or preceding batch, which was bought on 27th at 4,650. So it will be cosine this, multiply it by this, get that. We adjust our stock. It will be cosine this minus this. Say this, enter. So we adjust this one by saying cosine this minus this. So our closing stock is going to be this. This is the figure for the closing stock. The closing stock in units. This is the closing stock in units, and this is the figure of closing stock. And here, the closing stock, we said closing stock is equaling to 370 kgs at 177,500. Those are in shillings. How do you can prove? If you want, you can prove that. Remember, we said using FIFO, we said that this stock you are seeing, the closing stock that is going to remain here, is part of the stock of those recent purchases we made. Meaning, if on the purchases we bought on 27th, the 320, we issued out only 300 and we issued out only 150. It means the 320 minus the 150. Sorry, put equal sign here. It will be this 170. This 170 is going to be valued at this 460 because it is the number of units that are remaining here. They are valued at 4650. So if you want to get the total amount, it will be equal sign this times this, then we get that. That will be the cost of the item that are remaining here, plus our 200 units which we bought at 950. If you get those number of units, they were 200, because for them we did not issue any. They were bought at 4,920. When we try to multiply, it will be equal sign this, multiply it with this. It will give us that. So if you try to add this plus this, you must be getting this total. So it will be equal sign this plus this, which give us exactly the same figure which we are looking for as this. Hope you've seen how we got that. That's our figure. This was just proof. Put proof. That's how we prove this. This is total. So that's it. And the other preceding question asked us to get this was given 1 mark, direct material cost charged to production. We say those are the ones we issued out. So we can come here and we say sum. If you are not summing, you can just say equal sign, we add it manually. This is our issues. These are our issues here. This one from here to here. This is our issues. These are the issues. So we want to get the total. It will be this plus this plus this plus this plus this plus this plus this. I'm just doing it manually because I want you to be following what we are doing. Plus that plus this plus this last one. Press enter. These are the units we've. These are our direct materials consumed in production. Allow me use that for short form. That's that. So that's it. And the question is done. Maybe you can try to put a little bit some borders so that the work looks a bit fine. Can stop there and just put from here. We put all borders. You can even try to put some comma with the separators. If you want, you can even put in the shillings inside, but since we had put it up, it comes very fine. Those are the 15 marks. I hope you guys have got that. Then when we meet for the last in, first out and the other weighted average, I'll take you through again other steps where we are having returns on purchases, returns on issues, and when we are issuing out. But at least I want you to first get the basics. Thank you for today, and God bless you. Good evening, viewers. This is again Charles Kafel, and I'm here to take you through the LIFO method. In our first video, we saw how we can calculate the value of closing stock using FIFO, that is first in, first out. So allow me take you through to the next one. This time it's going to be the LIFO method. This is our solution. Yet, of course, when you are starting any financial statement, you start with the name of the company, what you are preparing, and the period. We've used the same question that we did when we are using FIFO. I've just changed only the method, and it is the same company. So we can add just here to get a clear view of the units. Then here, I hope that one's enough. Let's start. Go through the question. The question says, Tasse Juice Uganda Limited is located in downtown Kampala City, is a leading producer of fruit juice in Central Region. TJU buys a variety of fruits from Owino Market, such as oranges, pineapples, and mangoes, which are supplied directly to TJU's store. The fruits are then processed, packed in a different blends, and dispatched to shops and supermarkets. This on 31st March 2019, store ledger card showed 350 kilograms of fruits in the store, valued at 4,500 per kg. The company uses last in, first out, that is a LIFO method to value inventory of raw materials. The following information relates to fruits received and issued during the month of April 2019. Here, what we are emphasizing on, we want to look at the cost, because if you check in the required, they are saying prepare TJU's store ledger card or store ledger account and determine the value, Roman 1, the value of the closing stock as at 30th April 2019, 14 marks. And Roman number 2, they are talking about the direct material costs charged to production. So they have given us the data here. We have the purchases, we have the issues, and you have the unit cost, and the units we purchased plus the units we issued out at different dates. So we can proceed by first taking the company name. It is Tasse Juice Uganda Limited. We had made some analysis. We said we start with the name of the company, what you are preparing, then the date. That's how the title is supposed to be described. Then you have the purchases, we have the issues, we have the balances. Then we can start off. They said 31st March 2019, we had the closing stock of 350 kgs valued at 4,500. Then this one on 1st April 2019, since this one is 31st, then on 1st April, it will be our opening balance. So we go in the figure for dates. We start with the years, because the year is not changing, it's only one, so we put it, we make the first, followed by the month, that is April, then followed by the date, that's first. First, we said we are not buying, but these are balances for last month. You can call it balance brought down, and it is going this side. They said it is 350 kgs. So what will be the cost? You can value it from here to say cosine this. The cost, they say that the unit was 4,500. So we can value it at, can value 4,500, and it will give us that amount, which will be 1575000 triple zeros. So that will be that we shall be having on first. So we go to the next. We go to our table. The table says on second, we purchased quantity 300 units at 1,380,000. We said we are buying. We said the units they were 300 units at a total cost of 1,380,000. So if it is that, then what will be our unit cost? We said it's 1 million. It will be equal in this, divide by, it will be the total cost divide by the number of units. Then we shall be getting our unit cost as 4,600. Then since we have purchased on second, this is on second, and these are purchases. So we have to increase our stock. When we increase our stock, you know, when you are purchasing, what you do in accounting, when the purchases are increasing, you debit them, then you credit whatever means you are using to pay for those goods. So when we say they are increasing, we are debiting. So debiting meaning we are adding back to what we had. It will be this, cosine this plus what we've purchased, and it will be 650. So we increase even this one plus this plus that total. So when we are done with that, we can go to the next transaction. The next transaction took place on 8th, and on 8th they are saying they issued out. When they issued out 400 units. We issued out. This is on 8th. We are issuing issues, and the units are 400 units. But here now we are saying that when we are using LIFO, it means what we've received earlier, as the word said, last in, first out. What came in last is the one which is supposed to be taken out first. Why? And when you do so, it will bring that the goods which are already stored, they may even expire, because when they tell you to get the differences between FIFO and LIFO, we just know that this one, it values these items list cost, because you may find, if let's say we had an inflation, you may find that the recent goods we are buying, we had an inflation and the prices were high, so you may find that you are valuing them at a very high cost, which is as a result of the increment in the prices. So one of the challenges, and you may find out that you are overstating the value, you are over or understating the value of the closing stock. So we said, since we are using LIFO, it means what we bought last. This is the something what we at last is the one we are supposed to issue out first. So we are supposed to first issue out the 300, because this 300 cannot accommodate the 400. So we shall first issue out 300, then the balance will pick it from here. So we shall first give out the 300 at a cost of this, the 4600, which will give us this, multiply it by this, and you get that. Then we'll less this one to be cosine this minus this. So we shall be remaining with that. So when we remain with that, then we are saying that let's also reduce the cost, the total cost. That, remember, we are issuing out 400. It means this 100 units is supposed to come as the next one to total up to the other 400 we have issued out. Then we are issuing that at the other price they gave us for the opening stock, which is 4,500. It's 4,500. So we can multiply that, we get this, multiply by this, and get that. Then we have to reduce also the balance of, it will be that minus this. Press enter, and you can adjust also the total here. We say that minus this. Of course, some students may ask, how about if what we are supposed to issue, if let's say we had issued 300 and we find that the opening balance here was, let's say, 100 or 90, which couldn't accommodate this, they cannot give you that question. They will give you whatever method they give you, they will make sure that these units, they are there. You can't issue out something you don't have. So you keep that. Just say that if this one, just know there is a mistake, because when they give you something and you're using a certain formula, which is, because if you try to deduct and you deduct from let's say, because they cannot even deduct from anywhere, because the stock will not be enough. You can't issue something you don't have. So we can proceed on the next day. The next purchase happened on 13th, and we bought 500 units at 2,350,000. 2,350,000. Can put it here, 2,350,000 before we forget it. And we bought 500. These were purchases, bought them on 13th. So that's it. We can find the unit cost equal this. It will be the total cost divided by the number of units. Press enter, you get that. Then you add just our balances. So it will be this. Since we are buying, it will be that plus this. It will give us that. Then we shall also add just our cost, total cost to that, plus this. Hope we are at par. Then we go on the next date, which is 14th. There is an issue of 350. On 14th, we issued, these are issues, we said 350, is it so? We issued out 350. So if it is 350, we first see what do we purchase earlier here. We bought 500, so we are going to issue at the latest cost. So long as the item, the stock is enough to issue out, you issue, because this is 350 and this one is 500, so we can be able to issue out that equal to this, multiply by this, get the cost. We can reduce the units here by getting minus this. It will give you that 400 units. Then you have to also reduce the cost minus this. So we are getting it right. We go to the next date, that is on 20th. We bought 400 units at 1 million. Said we bought 400 units at 1,860,000. 1,860,000. Bought how many units? We bought 400 units. And these are purchases. We bought them on 20th. I hope the date is okay. Then we divide this, the total cost divided by the number of units to get the unity cost. Then we can add just our balances here, saying cosine this plus the number of units we've purchased, the 400, it will top up to 800 units. So we also add just our total cost, that plus this. Let's enter. We go to the next one. They are saying on 22nd we issued out 650. This 650 you are seeing we are issuing, this is an issue on 22nd. We are issuing 650. But remember here we've purchased 400 units. It means we have to first issue out the 400 units and they get done. When we complete the 400 units, then we shall go back to the most recent. This multiply by this, cosine this minus this, then it will be this minus this. We said we are giving out 650 minus what we so far we've given out. Sorry, I'm supposed to put minus so far what we have given out of that. We shall have to give out the 250. But remember, this 250 is supposed to be part of this recent purchase of 500 units. But on these 500 units, we issued out already the 350. It means if we had issued the, let's say we've said the 500 units minus the 350 we gave out already from that stock, we remained with 150. It means we are going to first give out that 150. This one we can remove. We put 150. So this 150 is the one we are going to first issue out, but we are issuing it out on 4,700. So it will be equal sign this minus this. Then we add just our units as this minus this. Then we also add just our costs to cosine this minus this. But remember, we are not done yet, because this 400 and this 400, it means here we've so far given out we've so far given out the 400 plus the 150, that is 550. Then this, it will be this 550 when you get the 650, that's what we are issuing, minus the 550, then we shall be having 100. Now this 100 units is going to be removed from the other order we had here. Remember, on this one we removed only 100 that was deducted first. Then it means on these units we remained with the total, what we are remaining with as in terms of units is 250. But on this 250 is part of this, the first one we received, which is the opening stock. So when we remove this, we remain with 250. Now the 250, we are removing 100. So that 100 is going to be valued at 500 to be equal sign this times this. Press enter, and you add just also these units, it will be this minus this. Then it will be remaining with 150 cosine this minus this. When you see that this 675, the reason as why it is coming like that, it is because of this 150. It means that 150 is the only stock that is remaining from here. So it will be the 150. If you want to prove it, you can prove it from here, and you see that what we are doing is exactly the same. Multiply it by the selling price, which was the cost price, which was for 500. You'll be getting the same exact answer. So that's how it is. Hope you guys, you are not confused now. We can push through with others and we see how we can finalize this. It is here. Then we go to the next one. The next one is we finish this 650. Then we are going on 24th. We purchased 360. This 360 is valued at 1,728,000. It is 360 valued at 1 million. It is valued at 1,728,000. It is 28,000. Yeah, 360. Hope I've picked the right figure. It is 1,728,000. 1,728,000. Yeah, it's the right one. But these are purchases. They happened at what was the date? The date was on 24th. This is 24th. Then we want to know the unit cost, which is will be this divide by this. Then we add just our stock here by cosine this. Since we are buying, we add plus the number of units we purchased that, and we can also increase our stock from here, this plus this value here. So I don't know if you are confused, but you can keep watching this same video and you try to get to know how you can understand that. And if you don't, you see that you are not getting it, make sure you comment and you put your question in the comment section so that we can keep in touch and we sort ourselves out. So that one is done for 24th. Then we go to 25th, we issued out 260. 260, this is an issue which happened on 25th, which is issues. We issued out 250. Is it 250? Let me check again. We issued 260. It is 260, meaning this 260 is supposed to be picked from the recent purchase, which we bought on 24th. That is 360. Yes, it is there. So we can just take out the 4. It is valued at 4,800. Then get the total cost. It will be this times this. Then we get the total units, which will be this plus. Now we are lessing because we are issuing out. We are removing, stock is reducing. And we reduce that. Then cosine this minus this will give us that. So we can proceed to the next one that happened on 26th. We are issuing 100 units. This is 26th. We have also an issue of 100 units. But remember, we are using the most recent. This one is not yet complete, so we are supposed to first finish up this one. This one we issued on the 260, meaning we remained with the 100. If this was remaining, like if what remaining here was, let's say 90, we could first issue the 90, then we check on this one. Actually, it is not even this one, it is this last one, because this one still has some stock which we have not yet sold or issued out. So it will be that valued at this, which is 4800. Then we get our, yeah, it is that. Then we can adjust this by saying equal sign this minus this 100. That's 150. That 150 is going to reflect here the value, that minus this, it will give us that. That's 670. That will be the cost. This cost is this opening stock which was not issued out, because we have issued out all of this one plus even what we have just received on 24th. So we go to the 27th. We are purchasing. We purchased 3. We purchased 320 at 1 million. On 27th, we purchased 320 at 1,480. 1,480. It is 1,480. 88. Let me check, confirm the figure. It is 1,488,000. Purchased the number of units, they were 320. 320. These are purchases on 27th. Then we want to find the unit cost. The unit cost will be this divided by this. Most of the times in the question, they give you this and this. Then when they give you, just multiply to get this. But if they give you this one and you don't have this one, you just divide. Hope you are not getting confused. Cosine this, we are adding because the stock is coming in plus this. Then it will be equating to this plus this. That will give us that. Then we'll go to the next transaction. The next transaction on 28th, we still purchased 200 units at 984,000. 200 units at 984,000. We still purchased at a date of on 28th. Then we want to look at what will be the unit cost. It will be this divided by this. Get that. When you've got that, we can still go ahead and adjust our totals here. Adjust the totals because we are purchasing this plus this. Then this one will be equal to this plus this. So we'll go to the last transaction. The last transaction in that month of April happened on 30th, and we issued out 300 units. This is on 30th. These are issues, and we issued out 300. There were 300 units. But remember, we take the recent purchase, meaning we have to first complete these 200 units, and then we call the remainder, the 100, pick it from here. So we are going to first exhaust the 200, which is there at a cost of 4,920. Then this one will be this times this. Enter, then we get our units. It will be this, since we are issuing out, it will be this minus that. So it will give us 400. So these ones, we are going to be having this minus this. So when you have finished that, we can go to issue out, because we issued we were supposed to issue 300 units, but we had issued with the 200. It means it will be the 300 we are supposed to issue minus the 200 we issued out already, which will remain with 100. Now this 100 is supposed to be picked on from this. Remember here we had not issued anything. It means the only stock we are left out to be issued is supposed to be this stock we purchased on 27th and the opening stock. That is supposed to be issued at 4650 and it's supposed to be giving us a total value of this times this. That is, can reduce the stock here by saying cosine this minus these 100 units. We shall be getting that to be cosine this minus this. Then it means this one is going to give us, this one is going to be our closing, the value for closing. This is our closing stock. So you can come here and say closing stock equals valued at 70 kgs, valued at 1,689,000. So you are seeing now this one, the reason why these people, they don't like LIFO because it understates the value of closing stock. You know, when you understate something, you know the implication, because this figure is supposed to be taken to the income statement. When you take it to the income statement, it will reflect, because when you include it in your trading stock, because we say when you get the cost of sales, it is opening stock plus purchases minus closing stock. So when you less this small figure, it will give a high cost of sales. And when you get the high cost of sales, it means that high cost of sales is going to reduce on the net profit or on the gross profit that is supposed to be taxed. So it's not good. They don't recommend it because it gives a closing stock, which makes the gross profit to be a bit low, which can't taxation purposes. You know, when you're taxing and you are charging that tax to something which is already reduced, and it is reduced because of the as within, it means you are going to be paying a less tax. So if you want to prove this, that what we did, okay, you can get that. We said the proof, we are going to get it from here. We said on this one, remember this one, we issued it out here and it got done. So the only stock that is remaining, this was the one purchased on 27th. We issued out only 100 units. So it will be, we purchased the 320 minus the 100 units. Let me put a cosine here. It means these 220, they are still there. So how do we value them? Can just say that we are putting its value 4650. Then we try to, when we want to get this, it will be this times this. That will give you that. When you get that, remember we said that on this stock, if you check here, we only issued out the 100 and we came and issued out the 100 here. Those are the only units we removed, this and this only. Meaning we removed the 200 units, this 100 plus this 100 from this one. So it means that those units are supposed to be 350 minus the 200 units. It means we are still having, sorry, I did not put the equal sign. So we still have 150. And this 150, they are supposed to be valid at 4,700. So its value will be this times this. Then we get that. If you want to confirm, we add up, we add these two. We get here the total, because that one is supposed to be equating to this one. Sorry, I've made a mistake here. These units, they were issued at 45, not 47. Here I had put a high figure, it was supposed to be valid at 45. So it means if you change this, because these units, they were valid at 4,500, not 47 as I had put. Because when you check, you just see that they are varying, they are tallying with what we've got up here as our closing stock. And that's how you do that. Then The other one, the other one they told us of the direct cost. The other question was like the direct material costs charged to production. These ones you just add. I said you just add these issues. If they want them in units, you add these units we've issued out. If they want them in cost, but here they are saying direct material cost. So it means they want this value, not these units. The direct material cost is equating to, let's just get a sum here. Can just sum up. We say equal sign. We add this plus this plus this plus this plus this plus this plus that plus the next one plus this one, and then the last one, that. Press enter, and this will be the value of the goods we've issued out. So that's it. And please, if you get challenges, make sure you ask that in a comment section below so that I can get to know how I can help you out. You can also try to make this one and we apply borders so that you can get it something a bit, which is a bit clear. I hope there it's fine. Is it fine? Yeah. Apply, and you can put the whatever, the separator, so that we get to know how we've done that, and you can save. That's how it's supposed to be done. And thank you for following. Maybe I can use the same question. We do the weighted and we see the difference, because you've seen the difference here is that they don't give the same figure for closing stock. They are supposed to be different in a sense that we are using different costs. The amounts, they are the same, but the prices, they are different. That's why the total cost is different. Thank you for watching. I'm just making you guys to give you a brief reminder that you're supposed to subscribe, and whenever I put in or I upload a new video, you'll be able to watch it and we improve our learning. And that's all for today. Thank you. Good morning, viewers. This is your tutor again. We are looking at the inventory valuation, and this is going to be our last method, because we said we are going to be using the same question and we do all the inventory valuation method. We've finished first in, first out. We've done first out, then we are remaining with the weighted average cost, which we are going to do now. So we are using the same question, and that question was about the Tasegis Uganda Limited, which is located in the downtown of Kampala city. They said it is the leading producer of fruit juice in central region. TJU buys a variety of fruits from Owino market, such as oranges, pineapples, and mangoes, which are supplied directly to TJU's store. Proceed, the fruits are then processed, packed in different brands, and dispatched to shops and supermarkets. On 31st March 2019, the store ledger card showed 350 kilograms of fruits in the store, valued at shillings 4,500 per kg. The company uses the weighted average cost method, that's WAC, WAC, to value the inventory of raw materials. The following information relates to the fruits received and issued during the month of April 2019. We have the purchases and the issues. Then we have the required prepare TJU's store ledger card and determine the Roman 1 value of the closing stock as at 31st April 2019. It means since they are doing this, they are counting their stock at the end of every month. It means they are using the periodic stock taking, whereby you compute the stock after a certain given period of time, not like when you're using the perpetual stock taking or inventory method where you take the stock continuously on a daily basis. But this one, you can proceed with Roman number 2. It says the direct material cost charged to production. So we go to our solution. We start with the name of the company, that is Tasi Juice Uganda Limited. What we're preparing is the store ledger card or the store ledger account using weighted average cost method as at 31st April 2019. We have the purchases, we have the issues, we have the balances. But here, for the balances, we can add, let me add something here for the unit cost. I will explain why I'm adding this. Let me add for the unit cost because I want to explain something in detail there. But if you know what you are doing, even if you don't put it there, then we go for amount. Said amount that is in shillings. It's also in shillings. Say this one is in shillings. And try to enlarge this, and we see this one is in shillings. Enlarge this one also a bit, so that we'll be seeing everything. So we can start. We said on this one, let's include also the unit cost. There's something I want to explain. We can start. We said we had a balance of 350 kgs that were valued at 4,500. Before I proceed, let me try to explain to you something small. When we are using average, that is the weighted average cost method or weighted average costing method. Here, we are using the assumption that the goods we've got, we value them at their cost. We get the unit cost, we divide the total cost we are spending divided by the number of units, so that we get what will 1 unit cost, and that's the cost we are going to be using when we are issuing out. Let's say we buy stock at the same time. Let's say if we buy 10,000 units and we buy also other 10,000 units, we combine the costs, we get the total. After getting the total, we divide by the total number of units, we get the unit cost. This is just an average, and you know from mathematics that this is like a mean. It's an average where you are getting the total over the number of what you are dividing. So let's proceed. We said our balance here on, this is 2019 April 01st, plus we have balance brought down or balance brought forward. So we put it in our balances. The balance, we said it was 350 valued at 4,500. Then our price, our total cost will be this time, or multiply it by the unit cost, and it will give us that. It will be our cost. So we can go to the second transaction, which happened on 2nd. That was a purchase of 300 units at 1,380,000. So we purchased The total cost is 1,380,000. We bought 300 units. So these were purchases. So we need to know the average or the unity cost. The way we are getting this by dividing the total amount divided by the number of units is the same way we look for it's like we are looking for the average per unit. It will be this, the cost divided by the total units. And if that will be that, then our stock will increase by this plus this. The only change is when we have issues. That's when we're giving out stock, that's when we shall be knowing what we are going to use, which price are we going to use. So it will be this here. For the unit cost, you don't put, it will be this plus this. Then if you want to know what will be the cost, if you are to issue out, we are going to be issuing, we get the average there to be equal sign this divide by this, the number of units. It means that if we are issuing out anything we are issuing, we have to issue that at this price. This will be the price, and that's the only difference between the FIFO and the weighted and the LIFO. This weighted, for it, you just getting an average cost per unit, and that's how we get everything there. This one you can even round it off, because here it is in, we can, but since we are using Excel, let's ignore those ones. We can minimize them if we want to. So let's go to the transaction which happened on 8th. We issued out 400 units. Now we are not looking at the it was on 8th. These are issues. These issues, we issued out 400 units. Let me hope they're 400. Yeah, they're 400 units, the one we issued out. But we are going to value that at this price you are seeing here. We copy it and we paste it here. It will be, it will be that. So if you want to find the cost, it will be this multiplied by the unit cost, and it will give us that. When we get this, since we are issuing out, we reduce the stock the same way we did the one for LIFO. That minus this number of units we are issuing out. Then for this we said we don't put, we only put when we have got the cost. And to get our total cost is this. Since we are issuing out, we have to less this, and what will remain there, it will be this. And this stock will be valued at this. This will be the total cost. So if you want to determine what will be the unit cost per each, it will be equal sign this divide by this, and we get that. So if you happen to get any issue, we are not issuing it at this price, we are issuing at this one. That's the difference between those two. Then we are saying on 13th, we 500 units at 2,350,000. It is 2,350,000. We bought 500 units. These were purchases. So to get our unit cost, it would be this divide by this. The same way we are doing it here is the same way we do it this side. It will be this plus this. That's our number of stock. So that there you don't put. Then we put our total cost. Since we are purchasing, it means we are going to be increasing the stock. It will be that plus this. Then to get what, if we happen to have any issue, we shall be issuing those goods at this divide by this. That this will be the cost that we shall use when we are issuing out. This, they said it happened on 13th, so we go on 14. I think this one is the easiest. On 14th, we issued out 350. These were issues of 350. This 350 is going to be issued at this price. We copy it and come and we paste it here. Then we can try to look for the total cost that we are going to spend. It will be this multiply by the number of units. We shall be getting that. Since here the stock is reducing, we shall less this minus the 350. It will give us 400 units. Then when you come here, it will be equal sign this. Since we are issuing, we less minus that. So we find the average to this divide by this. If we happen to issue any item, we are issuing it at this cost. So that's how it is. You can go to the next one. Next transaction, which on 20th we bought 400 units at 1,860,000. 400 units at 1,000,000. Said 400 units at 1,860,000. It is 1,860,000, and they were 400 units. Let me hope they are 400 units. Yeah, on 20th they are 400 units. So we are valuing that. These were purchases. This happened on 20th. What will be the unit cost? It will be this divide by this. Then we add just our balances here by saying this plus this, since we are purchasing. Let's enter. Then we try to get also our total cost. It will be this equal sign this plus this. Then we get the unit cost. This is the average cost. It will be this divide by this. So the next issue will be issued at this cost. Then on 22nd, we issued out 650. We issued out 600. It is on 23rd, 22nd. These are issues of 650. We don't mind about the number of units we are issuing. We just mind about the cost. What are we using to issue as in terms of the unit cost? Paste that one there. Then we try to look for the total cost. It will be this, multiply it by this. So since we are issuing, we less the stock is going to be reducing, that minus this. So when you come here, it will be equal sign this minus this. So we need to know what will be the unit cost. It will be equal sign this divide by 150. So we can go to the next one. The next transaction happened on 24th, and we purchased 360 at 1,728,000. 1,728,000. Saying here it is 1,728,000. Purchased the number of units. They were 360 units. These are purchases that happened on 24th. What will be our unit cost? It will be this equal sign this divide by this. This one we are getting it, but it is not even necessary. If you know what to do, you can even exclude this one when you are working with this weighted average cost. So long as they have given you the total cost, this one you may even ignore. But if they give you this and this, when they have not given you this, then you are supposed to include all of them. But that one, as per this question, we don't need it. Then here it will be equal to this plus the number of units we've purchased, and our inventory will be 550. What will be the cost? The total cost will be this plus this. Then the unit will be this divided by this, because what we want here is only this column. This column is the one that makes us to get the cost that we are going to use when we are issuing out the stock, and that's what we need. So on 25th we issued out to 260. 20, is it 25th? Yeah, it is 25th we issued out. 25th we issued out. These are issues issued out 260 at this. This will be our cost. Copy that, we paste it here, then we try to get the total cost. It will be this, multiply it by the number of units, and it will give us that. Then this stock is going to be reducing, will be this minus this. Let's enter. Then we go to the last one, which will be cosine this. Since the stock is going out, we are reducing minus this. Here we can get our unit cost, the unit variable cost per unit, the unit variable cost, which is that. Then you can go on the next transaction, which happened on 26th. We issued out 100 units. On 26th, we issued out 100 units, and these 100 units were issued at the same cost. This, copy and paste it here, cosine this, multiply it by this, will give us that. And these units are going to be also reducing. It will be cosine this minus the number of units we are issuing out. To be cosine this minus the total cost of the issues. Then we can get our unit cost. It will be cosine this divided by the number of units. It will be that. So we go to the next transaction, and the next transaction took place on 27th. We bought 320 units at 1,488,000. 1,488,000. We bought that at 1,488,000. Bought how many units? They were 320. These are 320 units. These are purchases. This one we forgot to write issues. This one happened on 27th. Is it 27th? Yeah, it is 27th. Then you can get the unit cost, which will be cosine this divided by this. We add just the inventory, which is that, plus the one we have purchased. We can also increase our total cost. It will be this plus this. So we compute the unit, the average variable cost, which will be cosine this divided by the number of units. Then we go to the next transaction. The next transaction, which took place on 28th. 28th, we again made a purchase of 200 units. These 200 units, they happened on 28th. These are also purchases of 200 units at a value of, so we get the unit cost here. It will be that divided by this. It will be that. Then what will be our new inventory in units? It will be cosine this plus what we've bought, and it will give you that. So what will be our total cost? It will be cosine this plus this 984,000, which will give us that. So we get our unit variable unit cost. It will be that. Meaning, if you are making any issue, then we shall be issuing at that price. On 30th, this is the last transaction, we issued out 300 units. On 30th, we issued out, these are issues, we issued out 300 units, and these 300 units were valued at that. So we copy that and we paste it here. Then we can get the total cost, which is this, multiply it by this. Then we also reduce our stock. it will be equal sign this minus this. It will give us that, and our total cost will be cosine this minus this, which will give us that, and we can get our unit cost as this divided by this. So that's how it is. That's how simple it is when you are doing with, because we are done with that, but they said here they wanted the figure for the closing stock. Our closing stock is this. That's the value of our closing stock. It is 1759076.13 valued at this, and the number of units, they are 370. The number of units, they are not supposed to change at whatever method you are using. The number of units, they must be the same. The only thing that will change, it will be the total cost, because we are using different cost units. I hope you've got that. Here we can come here and we say that our closing stock is 370 kgs at valued at 1,759,076.13. That's how it is. Here there is no proof because this amount is valued at this. When you multiply this times this, you must be getting this. So there is no proof. Maybe to get the here for the direct material used in production for the part 2 that is requiring us to get that, we said we add up the issues. Can get it from here. We get equal sign this plus this, because these are our issues, plus this plus this plus this, then we get our answer. It will be this, and that's everything is done now. We can try to at least to put some, can try to put these borders and we see how we can generate something. We put all the borders, and we can also put the separators so that we get to identify them, because you are seeing when you put the separator, you are removing the points. Of course, when you remove the points, then you'll be getting that figure when you've just removed the points, but you can maintain our points if you want. And I hope that's done. So we can stop here for today, and we'll see how we can do other things. Just subscribe to the channel so that when something is posted there, you can be able to review and try to understand what you are supposed to be done. Thank you, and God bless you. Welcome back. Hope you had a wonderful day. This is your tutor Charles Kafel, and I'm here to take you through labor costing and control. When we are talking about labor costing and control, here we are trying to mean how we can accumulate the costs we are incurring on the human efforts we are using in the production process, and we are computing the cost in terms of their basic salaries, allowances, and other bonuses, plus overtime and other benefits in regards to employment. First of all, you should understand that when you're demanding for labor, we only need that labor force simply because we have a certain activity that we need that employee or worker to do for us. So in that sense, the demand for labor is always a derived demand, since we only demand for labor as when the activity we want that individual to do for us is available. So allow me explain what a labor cost is. And when we are talking about the labor cost, we mean those expenses we have incurred when we are engaging workers in the production process. And when we are talking about the labor is simply the human effort, whether employed or whether skilled or unskilled, that are involved in the production process. So when they ask you for the definition of labor, don't again give a definition for labor cost. And when they also ask for the labor cost, don't again provide a definition for labor. When we are talking about labor cost, we are talking about the expenditure or the cost we are incurring. But when we talk about the labor, those are the human efforts that we use in the production of. So here we are saying labor cost. This is the expenditure that an entity incurs as a result of engaging workers, and these may include the basic pay, allowances, and bonuses. But they don't stop there, because there are other non-cash items we give to employees, as in bonuses and overtime allowances or premiums. So you should know that when we are employing workers, for them, they see the kind of job they see whatever they are doing, and the money we are paying to them as the cost. For them, they see it as their reward for the work they are doing for the organization. But to the entity or to the business or to the company, it's an expense. When you're paying out money to employees, those becomes the operating costs of the business. So when you are talking about these costs, we have different classes, and these labor costs are classified into the direct labor costs, and those are the costs that are incurred in the production and can easily be traced on the product. Or those are the costs which can be identified on a given product or cost center or a process. But these other indirect costs, those are the costs which cannot be, they are incurred in the production, but they cannot be easily traced on the final product. So we classify those costs into the direct labor costs and the indirect labor costs. And we are saying for the direct labor cost, these are the costs that are directly identified with a cost unit or a job or a process or a product. We said a cost unit is the final product or the last item of a process. That's what we called the cost unit. So those costs which you can directly trace them to the product itself, they are called the direct labor costs. But you have also the indirect labor costs. For these indirect labor costs, those are the costs that are not directly identified or traced with a product or a service. And these may include the salaries that we are paying to the, let's say for a carpentry workshop, the salary we pay for the workshop supervisor, a direct is an indirect expense, because we cannot trace that supervisor is not directly involved in the production of the output. That's why we are saying the salary that is paid to the workshop supervisor in a carpentry industry, they are treated as the indirect labor costs, because we cannot trace those costs on the final output, but they just act as supporting staffs in the production, because when they are not there, we expect also the production not to go very well, because it is also hard to manage labor or employees. With that said, let's look at how we can try to control those costs, because the main point in labor costing is, one, we are trying to look at how much are we spending on the employees and how can we control the cost we are incurring when we are employing those workers, not necessarily the extent that we are affecting the production. Because from the employee point of view, let's say you try to minimize the costs, the costs you are paying to them, like in form of reducing their salaries or giving them a less salary, you may find that their work is a bit affected. They don't work to their efforts, or they don't give a high output. So we are trying to look at how can we control these costs to the extent that they are not affecting the employees' productivity and the efficiency. So some of these costs, they can be controlled in different categories, or each department can contribute towards the controlling of these labor costs. The first department that can help in controlling these costs is the human resource department. The human resource department, those are the people who recruit the people who are going to be working for the organization. So we make sure that when they are recruiting those workers, they select those people who have the exact skills and experience that is needed to do a certain task. And they don't stop there from recruiting them. They also go ahead and give them the right training and make sure that they are performing to the required standards. So the human resource department, this recruits employees with the right qualifications and skills. They train them and maintain a database for all the employees. As the reason as why they maintain a database for all the employees is that they want to forget about the ghost workers when it comes in times of making payments. You make sure you record whatever employee that the company is employing, and you try to follow up on them, and you see how they are doing. We are saying having the right people is key in ensuring minimum wastages, high productivity, and consequently low costs. Because if you have the right people, the people you have recruited, they have the qualifications and the skills we need to do a certain kind of job, you may find that you will be incurring less costs because they are competent enough to do the job well. So when they are competent and they can do the job well, it means even their productivity is going to be a bit high. So when they increase, when there is a high productivity and efficiency, we expect that we are going to be incurring less cost, because what we expect those employees to do is exactly what they are doing. So we will be having a low cost per unit, because when you're producing more, you expect that when you try to divide the cost of the items you are producing by the amount they are paying you, you'll find that there is a very minimum amount that is spent on each unit that you produce. That is the first department, which helps in controlling costs. They control them how? By recruiting the right people with the right skills. The second department, which is the engineering department. This engineering department is you can call it the technical department. It's that department which oversees the need for workers, and they try to analyze what is needed for the job and what is the cost that is going to be incurred in when those employees are recruited, and what are we really expecting for them to do. Because this human resource effort for them, their role is just to check the right people, but they compare those people with what the engineering department has provided, whereby the engineering department, first of all, it gives the job specification. When they give you the job specification, you will be knowing what exactly is required in that job. So when the HR department is operating For them, they just consider what job descriptions are there, and they compare with what the applicant can do. So the engineering department, for it analyzes the job before it is forwarded to the HR department. So what they do, they make sure they give the right specifications for the job that is available or for the vacant that is available. They analyze even how much amount of money is going to be paid when you are executing the job description, the job specification they have given above. So here we are saying that the engineering department does the following, and the following activities, they are the one who's helping us to control the costs. First of all, they do the job specification. This is a description of the specific knowledge, skills, and abilities that are required to perform a job. It is a summary of the minimum requirements for a person to apply for a job, and it aims at ensuring the best people to perform the job are engaged. So when they do this job specification, they outline the minimum requirement which they need for that specific vacancy that is available. Then it will be the role of the HR to execute whatever they have discussed. The second thing, they do the job analysis. This involves examining the tasks performed in a job, the necessary competences or the competencies required to perform that task, and the connection between the tasks and the competencies. Of course, when you try to look at a certain job, you will see that if the person has this minimum, let's say minimum level of education, we expect that this person is supposed to be knowing this and this and this. So we compare what we expect from the minimum, let's say, education requirement of an applicant with what the kind of job someone is going to be doing. What are the tasks we are supposed to be doing? Then we compare. When we analyze, then we can make a conclusion and we say this, for the person to apply for this job, it must be having, let's say, a degree, let's say in accounting or a CPA, depending on the nature of the job you're applying for. The last one they do is, the second last is a job evaluation. This is a systematic way of determining the value of a job in relation to other jobs in an organization. When they are determining the wages or the salary to be paid for a certain job, you may find they compare within the organization. You may find that the job you are going to be doing is having a lot of activities that you are supposed to do, but they cannot allocate too much money that is not even in the range of the people who are above that job are earning. So they look at how the organization is performing in terms of the salary scale, and they also compare the activities someone is going to be doing. Then they decide which amount they are supposed to give for that particular job. That's why when you go for an interview, you find that when they ask for the salary expectation, if you give a certain amount which is not in the range of their budget, you may find that they will not call you for the job. Reason, it is because they cannot pay more than what they had budgeted, because they first make the analysis before they call people for interviews. By the time you come for the interviews, the salary is already there. It cannot be even adjusted. And if it is supposed to be adjusted, again, it's supposed to go back to the engineering department to see whether what you are suggesting and what you can bring to the table matches the money you are requesting. The last one is material renting. Material renting or performance appraisal. This one is always done by the supervisors and the HR department. For them, they are the ones who are responsible to check as per the job description that we said in this job you are going to be doing this and this, and we see what is the output, what have you been doing as in regards to your job responsibilities. If they find that what you have been doing is not exactly to what they want, you may find that it will be hard for you to get, let's say, promotion. Sometimes they may even terminate your contract before you complete, after the completion of the probation period. So allow me proceed to the next department. The next department, as far as controlling cost is concerned, is the timekeeping department. The timekeeping department is very important in an organization, and the reason why we need this timekeeping department is that we want to avoid the idle time that may be, the abnormal idle time that may be created by the employees. Because you may find that someone comes to work, but the person doesn't do necessarily what they have come to do at work. You may find someone comes, let's say, early and he sits, or someone comes and after signing in, the person leaves, and for you think the person came, so you are assuring that the person is working. Kumbe, the person is not even around the company premises. So it is better to know the time that the person has came and at what time the person is supposed to leave the organization. When you know the time someone is at least has reported for work, you expect the time, you expect that at that time someone will be doing something that is beneficial for the company. And this one helps a lot, especially when you are paid on time, when it is, the payment is basing on time, which is the time rate method of payment, whereby someone is paid for the number of hours someone has spent at the organization. If the company is following that method of payment, then they should be able to locate the time someone has spent at the organization so that they can multiply by the hourly rate or the agreed payment per hour, so that they can know how much to pay the person. So when you keep time, you try to avoid those unnecessary wastages. Someone comes at work late and the other person comes late and leaves early. So try to exclude that. So the timekeeping department, this maintains employees attending registers and computes the time that workers spend at the organization. The last one we can talk about as far as controlling cost is concerned is the cost accounting department. Remember, we said cost accounting is all about accumulating the costs. So the cost accountant is the one responsible for knowing the costs we are spending on labor, the cost we are spending on raw materials, and the cost we are spending on other expenses. So this one, they are the one who's making the computations of the amount of money that is supposed to be paid to each employee. The reason as why they come in as people who control the cost, we want to make sure we are paying exact amount of money someone. Let's say if you are paying by on time basis, not on a piece rate or other methods. You may find that someone may forge the time that me I worked, let's say, for 10 hours, yet in actual sense someone has worked for 8 hours. So we make sure we compute the exact time someone has been at the organization, we multiply by the payment. So the role of a cost accountant is to make sure they pay you the exact amount of money or for the exact hours you've worked in the organization. And that's all about how we accumulate those costs and how we can control the costs. The other thing I want to look at is labor turnover. Labor turnover is the rate at which employees leave the organization and join the organization. The rate at which you may find in an organization that many people are leaving the organization, but as they leave, more people are coming. It is normal to be having at a certain rate, or at a certain extent, it is normal to be having that labor turnover. But when it becomes too much or to the larger extent, it becomes bad to the organization, because at the end of the day, when more employees are leaving the organization, you are incurring more costs in terms of recruiting new people. And on top of recruiting them, you are also supposed to train them, because they come when they don't know the company products and the procedures, plus other regulations within the organization. So at a smaller extent, it is important, because by the time someone leaves the organization, you may find that there are other people who have been working and they need to get promoted. So it is important for some people to leave, but to a smaller extent. But to a larger extent, it is a bit dangerous, because you are incurring more costs. So when we talk about the labor turnover, this is the rate at which employees leave and join the organization. It is a practice for some workers to leave the employment while new workers join to replace those ones leaving, leading to a change in the workforce. When the workforce is changing, meaning you are getting new faces as the old faces are going away. In the same way, the other organization will be receiving the people who've left somewhere. So that's how it is. But as I said, that change in the workforce is what we call the labor turnover. But what we are trying to look at is, what is the rate, or to what extent are people leaving the organization? That's what we are trying to look at. The calculation is, we always compute this thing in percentage, to the extent that when it exceeds 100, you just know more people are leaving the organization or more are coming in, depending on which method you are using to calculate. But we always put it in 100. We can convert it to 100. So I want to talk about what are some of the causes that can lead to labor turnover. What causes people to leave the organization, and what causes others to be joining to replace those who left. There are some of the causes, and these causes are categorized into the controllable causes and the uncontrollable ones, whereby these controllable causes, those are the causes that makes someone to leave the organization, and even the management itself or the company has no control about. But the uncontrollable one, those are the uncontrollable one. The controllable ones, those are the ones whereby someone is leaving the organization, but the company has control. The company can control someone from leaving the organization. So when you are giving these controllable causes, you may find that most of the times it can be prevented from happening. So when I start with the controllable ones, the controllable causes of labor turnover, the first one, we have poor working relationship. This poor working relationship is in terms of, let's say, there is some bad habits which are existing within the organization, and that habit forces someone to leave. Let's say there is sexual harassment. Someone leaves the organization just because, not because the person was paid poorly, but because the relationship between the people he or she is working with, they are not friendly. So someone may try to leave the organization, reason because of the poor working relationships. The second one, we can talk about the pure remunerations or the payment. You may find that the hourly pay, if someone is paid per hour, you may find that someone is paid a less amount of money, to the extent that he cannot earn even a living. By the time the end of the month, the money is already done. So you don't expect that person to be working, because at the end of the day, the money that person receives, you may find it is all wasted in transport and meals. So when someone is paid poorly, he can try to leave the organization. The third one, we can talk about lack of career development. Someone may be at the organization, let's say the person has worked for an organization for more than 5 years, and there is no change. There is no kind of that someone has been given, let's say, a study package to go and improve on the skills, or they are not even giving them further training. Someone may just say no because of this factor, then It's not good for me because I'm not building my career. I'm just here eating the money they are paying, they are giving to me. So someone can just say, you know what, I'm leaving. But we are saying these causes are controllable to the extent that you can prevent that person. You talk to the person and you try to, if the person says there is no career growth or development, you don't promote people, you don't even motivate them. So you try to pick out some of the motivation, these most motivations. They can be either by benefits in kind, or you give them some study packages and others. So that is in the sense that those costs, they can be controlled by the management. The last one, we can talk about the poor working conditions. Poor working conditions is different from the poor working relationship. The other one is the way how people interact with each other, the poor working relationship. But this poor working condition, it is the general, let's say the policies. Let's say someone is not supposed to, let's say, to rest or to have something, let's say to eat even water. It's not provided for at the workplace or the workplace. You may find someone just leaves the organization, not because the organization is not paying, but because the environment where the person is working is not favorable for the person. Then we can talk about the uncontrollable ones, whereby the organization has no control about the change of or the movement of the employees. The first one, we have the greener pastures. This happens to most especially these, let's say if someone has got another opportunity, let's say outside the country, and they are giving the person a different amount of money, so they will just try to leave the organization. And even if you try to stop them, they will not leave, because when they go out, let's say when they go outside the country, they expect so many benefits to be attached on the new employment they have acquired. The second one, we can talk about the family problems. Someone may be having family problems, and those problems, they force the person to leave the organization. And let's say someone may be told that, let's say we are changing the environment, we are supposed to be leaving the other side. So if you want to be working at the organization where you are, then the family is going to be separated. That one can force someone to leave the organization. The third one, we can talk about the health issues. If someone is, let's say, having some health problem, someone is sick, you expect the person to leave the organization and goes elsewhere, whether to work or to go for further treatment. The fourth one, we can talk about further training. If someone goes for more studies, someone can just leave the job because he wants to get some extra knowledge on whatever he or she had at that time. The fifth one, we can talk about early retirement. This early retirement makes people to leave the employment even when they are not supposed to leave. Because someone, when the person applies for an early retirement, you expect that the person is going to leave the job before even the retirement period. The last one, we can talk about death. If someone dies, automatically we expect that person not to work anymore. And that's all I wanted to talk about the causes. Let's look at some of the effects of labor turnover. We said labor turnover, to the smaller extent, labor turnover is good. It's good in a sense that some employees are going to get chances to get promoted. So the people who are left in the organization, when, let's say, the person leaves the organization, those ones who are left and they are given an opportunity to be promoted, you may find that they can do better and they improve on their performances so that they can maintain their promotions. The other one, you can talk about when someone leaves the organization, we expect that some people are going to come in with a different experience. So we expect more qualified people. I was saying we expect more qualified employees to join in and help the company grow to a next level. That is to a smaller extent. Those are the ones I can give you to the smaller extent, or the positive part of it when there is labor turnover. But we can talk about the extent when employees leave the organization to a larger extent, or there are so many employees who are leaving the organization. That one, we said it affects the organization in such a way that the company is going to be incurring more costs. They can be in terms of the preventive or the replacement costs. The preventive costs, those are the costs we incur to maintain the people who are leaving the organization, to make sure that we convince them they stay and they be working for the organization. But when they insist and they leave the organization because of, let's say, for the other uncontrollable causes, then we expect to incur more costs on hiring the new applicants and training them, because they don't have any idea of whatever the company may be doing. So we expect to incur more costs, and those are grouped into the preventive costs. Those are the costs we can give to the old employees not to leave the organization, or we incur the replacement costs that are supposed to be paid to the new recruits. So these preventive costs, we can talk about them in terms of cost of providing benefits like lunch, pension, gratuity, and some even you can give them shopping vouchers. Because let's say someone has been working for an organization for 5 years, you say that the people who have been working with the company for more than 5 years, we are giving them, let's say, gratuity of 5% of their, let's say 5% of their salary. That one, it will be on top of what they are receiving monthly, but at least it is an appreciation that someone has been working for the company and the company has benefited. Even the person is given something. Then we can talk about the cost of providing good working conditions. We said the good working condition may be, you may provide some small services. You can provide, let's say, water, lunch, and some break. You give them break time. The other one, we can talk about the cost, the recreation facilities. That one is, I think it is self-explanatory. The other one, we can talk about cost of providing educational facilities. You may be giving educational facilities to their families or their children's, or you are giving the educational facilities to themselves by giving them, let's say, study packages. And when they are, let's say, on study leaves, you give them a reasonable study leave when you are paying them. Those are some of the preventive costs. But let's talk about the replacement costs. These replacement costs, those are the costs we incur as the new employees are joining the organization because of the old one leaving the organization. One of the costs we incur the cost of recruitment and the selection. When you are doing a recruitment, you may find that you are incurring certain costs. Let's say these costs may be in the cost of advertisement. You put the job vacancies in the newspapers, whereby you incur some costs. There is also cost that is incurred after the applicants have applied and you are screening them. The people who do that job, they are paid money. So we are incurring costs. That is cost of recruitment and the selection. The other one is cost of training new workers, because they come, even if you recruit someone who is experienced, but we know that you are supposed to give them training because they are not aware of what the company is dealing in. They have to know the do's and the don'ts of the organization, and they also get to know the product the company is dealing in. The third one, we can talk about cost of the tools and equipment that are damaged because of inexperience or incompetency. You may find that at their first time of work or the first 2 months of work, they may be causing losses in the organization, not because they just want those losses to happen, but they don't have the skill that is needed to do the job in a right way. Then the last one, we can talk about the cost or the loss that is incurred due to the interruptions in the production. When the employees leave the organization, we expect that whatever they have been doing is going to be on hold. So when those things are on hold, we expect that we are going to be incurring losses. If those people they were engaged in the production process, we expect that the goods they have been producing, they are going to be reduced. So when they reduce, we are expecting a loss, because we may be having a steady supply, a steady demand, and when the employees are not enough, we expect to be producing less. And when you are producing less, we expect that we are losing some customers. As we're losing the customers, the costs, the loss we've incurred is as a result of those employees who left the organization. By the time you make the other one ready to replace the one who left, you will find that you've made a lot of losses. So let me give you the general ways of how we can reduce the labor turnover. This is as in general how we can reduce the labor turnover, but I know you can give out some of these because we have been talking about them and they are the same things, but here we are just giving them in general. The first one, we can talk about open communications, whereby you ask the employees what do they want before they leave the organization. You sit with them, you discuss what they want, and you may find, or you may be having a solution to their problems. The other scenario, you can even just put a suggestion box that employees put in there, so that those employees, they put in their complaints, and with time you pick those complaints and you try to improve on some. You may not do all of them, but at least you give a change to whatever scenarios those employees were facing. The second one, we can talk about engaging employees or encouraging employees to participate in the management. When you encourage someone to be part of, let's say, the management meeting, you may find that people, they will not even argue that we want, let's say, more salary, because they will also find, they will find out from the meeting that what the company is going through is a bit complicated to the extent that they cannot even demand for a salary increment. Because if you exclude them, for them, they just be thinking that the organization is performing better, which will not be the case, because when you make them get involved in the meetings, you may find that they get to know what the company is really facing. If it is a general problem that the company is facing, for them, they also understand and they lower their expectation gaps. The third one, we can talk about the non-monetary benefits. These non-monetary benefits are good to the extent that if someone is not paid well, but at least at the end of the month or at the end of the year, someone gets something like gifts and donations. Someone, let's say, gets these old company cars. You may find that someone has got, let's say, a company car, and the company car may not even be worth what the employee is offering to the company, but at least the person gets motivated and pushes the activities that are supposed to be done by him or her. The fourth one, we can talk about the way we handle the conflicts between our employees. Let's say our employees have some misunderstandings. We expect them to be having a room where they can address their issues so that they get assistance. Because those things happen because since the organization becomes the collection point, someone comes from a different place and they join the organization. So when they join the organization, they come with whatever they have, and it's the employees who are there, the fellow colleagues, the person is going to be dealing with, and so they will be having misunderstandings. By reducing, because those misunderstandings, if they are to a greater extent, they can force someone to leave the organization, because those are the ones that are causing the poor working relationship. The other one, we can talk about introducing the incentive schemes. These incentive schemes, they may be bonus schemes, they may be non-cash schemes, whereby you may be allowing, let's say, employees to have a share on the company profit. To the extent that you may put a criteria whereby if someone reaches that target, then they are supposed to be getting, let's say, 1% of the company profit on top of the salary they are earning. That incentive will make someone to work so that to achieve that bonus that has been introduced. So when you're introducing the incentives, make sure those incentives, first of all, they are also attainable, not setting goals that they cannot be, even no one can achieve. You set a goal, but to the extent that you are just making employees not to earn that amount of money you are putting there as an incentive, because you are setting a higher target or unachievable target, which is unrealistic. The second last, we can talk about providing good working conditions. If you provide a good working conditions, I've explained that point that people will stay in the organization. You can talk about even fair rates or fair pays. You increase on their salaries and allowances. And these days, some of these organizations, sometimes they even extend credit facilities to their employees. By the time someone is thinking of leaving the organization, you may find that, let's say, the person has acquired, let's say, long-term loan, which cannot force someone to leave the organization, because you may find by the time someone wants to leave the organization, you cannot settle the loan. So that one also keeps the employees, but that one comes as at least as a last resort or point. Then we are going to look at the measurements. How are we measuring the labor turnover or the labor turnover rate? We have three methods which we can use to determine the labor turnover. We have the separation method, the replacement method, and the flux method. The first one, we are talking about the separation method. This method takes into account only those workers who have left during the period. We are talking about the workers who are leaving the organization. So the point will be, how are we going to be calculating the labor turnover? It will be, labor turnover will be equaling to the number of workers who are leaving the organization or who left the organization over the average number of the employee. We are dividing the average number of the employee, not the total. We are dividing with the average number of the employee or average number of workers during the period. And these average numbers of workers, we are comparing the number of workers at the beginning of the period and those ones who are there at the end of the period. Then we divide by 2 after summing them up. So when you get the percent that is more than 100%, you just find, you just know that there is a very high rate of labor turnover. When it is below 100, you just know that will be an indicator that the labor turnover is not much. The second method, we can talk about the replacement method. Replacement, as the word suggests, those are the people who are coming in to replace those who left. So it will be the number of workers replaced during the period over the average number of workers during the period times 100. The last method is the flux method. This method shows the total change in the composition of labor force. The total change, we are talking about the change, meaning those employees who have left and those who have joined. But you have to make sure that these people who are joining the organization, they are not joining because the company, let's say the company has extended. Let's say the company has created a certain department. Let's say they have put another branch somewhere. No, these employees, they are supposed to be replacing those who were there, not those employees who are coming in the organization as a result of, let's say, an expansion of the company. No, we are excluding those ones. So the labor turnover using the flux method, it will be the number of workers who left the organization plus the number of workers who replaced those who left over the average number of workers during the period, multiply by 100, because we are computing it on annual, on a percentage format. So that the note you are seeing down here is on the basis that the employees who are joining the organization should not be as a result of the extension of the company or a department. We can proceed to the next one, where we are going to be talking about the payroll accounting. This payroll accounting involves just the computation of the gross pay, all the total amount of money that is supposed to be paid to the employees, and the deductions which are supposed to be done or deducted from those salaries. In these computations, we are talking about the gross pay and the total payments. These total payments, we have statutory deductions. There are some statutory deductions like a pay, like NSSF contributions, that 5% as per the Ugandan Act, the 5% that is contributed by the employee and the 10% that is contributed by the company to the NSSF or to someone's NSSF, National Social. Then we have also the non-statutory deductions. They may be in form of, let's say someone took a salary loan and that salary loan is coded on someone's payslip. You may find that those deductions are made before the person receives the salary. That money is deducted before the person receives the deduction. It is deducted in the same way they deduct the pay as you earn and the NSSF. And the last non-statutory we can talk about is, let's say, lunch allowances, lunch deductions, because you may find that some employees they have a benefit. Let's say they have a benefit of lunch. They are given lunch at where they are working, but on top of the lunch they are giving them, there is a certain contribution they make towards that lunch. So that deduction is made before someone receives the salary. Those are the ones. When we are talking about the payroll accounting and labor cost accounting, they are different in the sense that for the payroll, we are only looking at how can we accumulate the gross pay of someone, and we deduct the statutory expenses and the non-statutory expenditures or deductions that are supposed to be removed from someone's basic salary. But for this labor cost, for it, we are aiming at cost ascertainment. We want to know the whole cost we've incurred. We don't care about the deductions. We are caring about how are we accumulating the money we are giving this employee. So they are different in that sense, that the payroll accounting is considering the gross pay, and at the same time it is considering the other deductions that are made on someone's salary. But for this labor costing accounting, for us, the emphasis is about ascertaining the cost of labor. How much have we paid this person, and how much can we trace on the product, and what can we not trace on the product? I've given some differences here, but these differences, they are just as per in terms of what is included, what is not excluded, or what is removed from someone's basic salary. You may find that this side of labor costing, we are just computing the insurance, let's say the insurance compensations we are giving, the termination benefit we are giving to the person, the employee bonuses, the overtime, the salary we are paying, and everything that we are paying to the employee, we add it up. Then for the payroll accounts, for it, after knowing the amount we are paying the employee, we go ahead and look at the Social Security Fund, those NSSF, and the income tax plus other welfare and other charges. Then allow me talk to you about these functions of the payroll, because most of the times when the cost accountant does the costing, the labor costing aspect, then they send the things to the HR. The HR, they are the one who's handling that payroll function. So we want to know what is the role of the payroll function. The first one, they do the balancing and reconciling payroll data. They make sure that the amount they are supposed to pay you, they have added everything, and they also reconcile with the expenses or the deductions that are supposed to be made on someone's salary. They compare someone's salary with the payroll or the pay slip deductions. When they deduct everything, then they make sure. Once again, this is your tutor, CPH House Cafe, and today I wanted to take you through the payroll accounting. Excuse me. It is a payroll accounting which we are going to look at today. I hope you know this is under the labor costing, where we compute their salaries and wages. Within this, we expect that there is a very big difference between a payroll accounting and a cost accounting, or a labor costing accounting. The other one of a labor cost statement, the other one is prepared by the cost accountant, but this one is more of the human resource department, whereby it is specifically handling what the employees are going to be earning and their monthly deductions. So when we are looking at the labor costing accounting, we are just looking at the costs only, the amount of money we are paying to the labor force in terms of what they are offering to us. So when you see this, it means we are going to look at the cost, how we can accumulate the costs, and at the same time we look at the monthly deductions which can be deducted on someone's salary. So this is the question. The question says, from the table below, you are required to prepare a payroll for the month of September 2020. They have given us the clock numbers. They have given us the names of the employees. We have the number of workers, the number of hours worked. Those are the, of course, here, if you see the number of workers, you expect that when they are paying, they pay by hourly rate, whereby they pay as per the number of hours someone has worked. We have the standard rate per hour, which is 10,000 per each hour someone offers. Then we have advances. Of course, these advances, you can't fail to find them, because at the end of the month, you find that some people have already taken out some money as payment in advance before they receive the salary. Someone may go and ask for some advance if that person is in need of that. So when they are preparing the final month payroll, we add just that, what we paid, we deduct from what we are supposed to pay, so that will give the employee the amount which is remaining. We accumulate that under the deductions. We deduct from someone's gross pay, and what remains, we submit it. This one comes as a non-statutory deduction. There are statutory deductions as per Uganda Act that someone who is employed is supposed to pay as you earn. That is an income tax, whereby that money is deducted on someone's salary monthly and submitted to URA. Then there is also contributions that we contribute. Those are the NSSF, the ones we contribute towards our National Social Security Fund, that is deducted. And currently we deduct 5%. When we deduct 5% on our money we are supposed to receive, or our salary, then the 10% will be submitted by the employer. In total, we submit 15% to NSSF. The employee contributes 5%, and the employer contributes 10%. That's how it is. Those are some of the statutory deductions. Then the other deductions we can talk about, we've talked about the advances. The other one can be in form of if someone had a loan, a salary loan that is supposed to be deducted by through a payroll system whereby they just code it when the money is not directed, when the money is not deducted from the bank and it is deducted at the source. So make sure we adjust those. And those are the things we are going to be talking about as we solve this number. Then we go to this additional information. The additional information part 1 says the normal hours per month, 190 hours, and the overtime pay for extra hour at a rate of 50% above the normal rate. And we know the normal rate was 10,000. So if they are saying that 50% of the normal rate, it means if the other one was 10,000, 5,000, you will get 10,000 times the 50%, we will get 5,000, which 5,000 will be added back the 10,000 to make 15. So the extra hours, that's in terms of overtime, will be paid at 15,000, meaning it is 5%, 50% in excess of the normal rate. The second additional information, it says Odong, Mike, and Yeko Sandra are entitled to housing allowance of shillings 150,000 each, and the rest are entitled to 8,000 per month, meaning it's only Odong, Mike, and Yeko Sandra that are going to be receiving 150. The rest are going to be receiving 80,000 per month in terms of the housing allowances. These allowances, these are the amount of money that is paid above the basic salary. Someone may be earning, let's say, 2 million, but there are other allowances which can keep someone's salary increase, and they are not taxed. Some of them, they are not taxed. So the other one we can talk about is the third one. They are saying all employees are entitled to medical allowance of 60,000 each month, except for Odong Mike, meaning it's only Odong Mike who is not going to receive the medical insurance of the 60,000. Then the fourth one is saying all employees are entitled to the bonus of 10% of the pay worked for. If they say 10% of the pay worked for, it means it is the amount of money they have actually earned, meaning it will be the normal, then the overtime pay, then we get 10% of the total, what they got in terms of the basic pay, what they got in terms of the overtime, we add them, we take 10% of it. Then the fifth one is saying only 2 people, Mwanga Loy and Phil Charles, are entitled to transport allowance of 120,000 each month, meaning it's only these two. When it comes to the transport allowance, we are supposed to allocate for only these 2 people. They are the one who is supposed to receive the 120,000 per month. Remember, this account, this payroll we are preparing, it is a monthly payroll. If it was if they had told you to calculate for pay that is supposed to be paid to these guys, let's say in 1 year's time, then you would be multiplying everything times 12. But if they are saying, if they are just giving us a monthly figures and they want everything in monthly figures, we are not going to multiply anything. We are just going to take them the way they are. Then the other one we can talk about, the sixth one is saying payee, that pay as you earn, to be deducted at a rate of 15% of the gross wage. Meaning when you get the gross pay, you will take 15% and it's supposed to be deducted as an income tax. Then the seventh is saying NSSF contribution to be deducted amounts to 70,000 for every employee. Here now they have not given you the percentages, but they may give you the percentages or they may just give you the figure. Here they have given us 70,000. Even if it is not the 5%, you leave it. You go with what they have given you. Then the eighth one is saying, assuming that the standard hours per month were 260 hours. That is the standard, the one that they have set that each employee is supposed to work within that range. This one I added it because I wanted to explain something about the scheme and the house schemes. And let's flip into these videos and we see how we can try to compute this payroll. I made some analysis, as you can see there. Here we are seeing that we have the number of hours. I just copied these ones from the question. I pasted them here. Then, as the question was saying, because they were giving us the normal hours, which we are supposed to be following, and you can kick off, you can give it a title, you can highlight there, you add another cell, you can add another, and we call it a payroll, give it a title, payroll for the month of September 2020, what they have given us. So you can highlight this one, you can try to highlight so that you merge it if you want. You can stop here, then we merge it so that it is, can make it broad a bit, increase, you can even increase the font size. I think there will be enough. Hope everyone can see. Now I wanted to minimize this and allow me remove this one, because this one is not going to be used anymore, because I'm seeing if I leave it there, then the net pay here is not going to be seen. So allow me delete this one so that we get enough space, we can be seeing everything from here. Can now go on with this one has disappeared, sorry. Try to type in, try to put in, we said it's a payroll for the month of September 2020. Yeah, from there we are getting at least something. Yeah, it's back now. I can even highlight these ones so that you can see them. I can highlight those ones. I hope there you can be seeing everything. So allow me kick off and I take you through these computations and we see how we can improve in our areas. Okay, they told us that the normal working hours per month, they are 19,000 hours. It means those are the workers, those are the number of hours every employee is supposed to work for. So it will be 190. So you can double click here so that everything is filled. So here we can go ahead and compute our net, our basic pay, because we've got the number of hours we've worked for, we've got the hourly rate, we have the advances, we have our normal hours, then we have the column for basic pay and overtime. These are overtime hours. The reason why I've put them here, because I just want, when I'm typing, I never wanted to put them somewhere, because I wanted to, at least for everyone to be following, but I know you guys, you can do this. It is very easy. And the other one is overtime pay. Then we have the bonus. We have the housing allowance. We have the medical allowance. We have the transport allowance, gross pay, our pay, NSSF, total deductions, then finally our net pay. So we can go ahead and compute. I said, whenever you are making any calculation within Excel, you start with an equal sign. And we are saying that the basic pay is going to be the normal hours multiplied by the hourly rate. We shall be getting what each employee is supposed to get. But they say this one is normal, meaning that amount is supposed to be uniform to every employee. Everyone is supposed to work for those hours. That's why you are seeing the amount, they are the same hours everyone is supposed to work for, and they are the same they are at the same rate per hour. So we can compute our overtime. But our overtime here, what we are computing the overtime in terms of hours. We want to first know the hours we've spent, then we can multiply by our hour rate so that we can be able to get everything. Said we get the equal sign, which will be this number of hours we've taken. These are the number of hours every employee has worked for. This one worked for 220. So if those are the hours, but they told us that our normal working hours, they're supposed to be 190 hours. So we deduct, when it will be the number of hours worked, that is B3 minus the normal hours, which will give us 30 hours. If you deduct the 220 minus the 190, you'll be getting 30 hours. You double click. This one is not going to be earning, Ivan is not going to be earning overtime because the number of hours that we are supposed to work for, he actually did the same hours. So he spent only 190 hours, and those are the ones worked for. That's why here it is a 0. So we said that the overtime rate, they told us that the overtime rate, they told us here that the overtime rate and the overtime pay for an extra hour at a rate of 5% above the normal rate. Meaning if the normal rate was 10,000, we get 50% of it, then you add it back. It will be the same way like saying cosine, you make it, instead of we taking the one, we shall take the 100, that is the 100%, we add the 50. It will be 150% times the normal hourly rate. Then from there we shall be getting the 15,000. Then you can double click here because it is uniform for every employee. If you see this one is a bit challenging, you can just get the 50% of the 10,000, whereby you'll be getting 5,000. You add back to the 10,000 to make it 15,000. So when you are computing for the overtime pay, we get the time we've spent, which is above the normal hours, then we multiply by the overtime rate. It will be 30 times the 15,000. Press enter, we shall be getting 450,000. Can press double click so that you get everything. That's why here you're seeing this person earned zero overtime because we worked exactly the same hours that were allocated for. Then we go for the bonuses. They told us that bonuses, they told us here, additional information number for all employees are entitled to 5% bonus, to 10% bonus, 10% bonus of the pay worked for. The pay worked for is these are the number of hours someone has worked. So we want to find out how much is it for the person who has worked for 220 hours. And to get that, we need to add the basic pay we've got in the normal hours, then we add it to our overtime so that we can get the total earning as per the bonus requirement, because the bonus requirement is 10% of the pay worked for what you've worked for. Then it will be, we shall just say equals, you can open brackets, and we say it will be the basic pay, that is F3 plus the overtime pay, which is I3. When you've got that, you can close the bracket and say multiply by 10%. Then from there you'll be getting a total of 235,000. Then you can double click there so that you get for the rest. When you've got that, then there we can proceed to our housing allowance. And in the question they said Odong and Yeko Sandra are entitled to housing allowance of 150 each, and the rest are entitled at shillings 80,000. per month. So it is only Odong and Yeko Sandra that are going to be receiving the 150. The rest are going to receive 80,000. We said Odong, this one is going to receive 150,000, and Yeko Sandra is receiving 150,000. So if those ones are receiving that, it means these ones they are going to be receiving 18. So that's these ones are receiving 8,000. If it is 80,000, you can scroll here that you fill these ones. Here you fill the 80,000. Yeah, that one is done. Then you go for the medical. Medical, they said medical allowance, they said all employees are entitled to medical allowance of 60,000 each per month except Odong Mike, meaning it's only Odong Mike who is not going to receive that medical allowance. So it means they are receiving 60,000 per month. Can drag here, but they told us this one, Odong Mike, is not supposed to receive that. So it's supposed to receive 0. So we go to transport allowance. They said transport allowance is that they said only Kafeu Chaus and Mwanga Loy, they are the one who's entitled to transport allowance of 120,000. That's for said Mwanga and Chaus. So this one is entitled to 120,000 and Chaus. This one is entitled 120,000. These ones they are supposed to receive 0. They're supposed to receive 0. So let's compute our gross pay. And to get our gross pay, as you hear the word, it says it is a gross, meaning we are adding all the basic pay plus other bonuses and allowances we've received. This gross, it is the amount, the summation of the basic pay, the bonuses, and other allowances that are given to the employee without deducting without removing the deductions. So it will be the basic pay plus the overtime pay plus the bonus plus the allowance plus the medical plus the transport allowance. So you press enter and you'll be getting 2 million, and double click there so that you can fill everything. Then we go to the payee. They gave us in the payee that pay is supposed to be deducted at a rate of 15% of the gross pay. So every employee is supposed to be deducted 15%. So we go and we check the cosine, we say 15%, that is 15% multiply by our gross pay. Press enter, then you can double click. That one is done. We compute for the NSSF. They told us that NSSF contribution to be deducted an amount of 70,000 shillings for every employee. So it means here we are charging 70,000 every person. So if it is 7,000, you can double click there so that you can get that. Then when we go to the deductions, we said deductions, we added the statutory deductions and the non-statutory deductions. Some non-statutory deductions, I've said some of them may be a salary loan, which is deducted on someone and on someone's salary from the source. It can be a lunch allowance that is deducted if, let's say, some employees are entitled to lunch allowance, or they are supposed to receive lunch from their work, and on that lunch they are contributing something towards that package. And the others which are supposed to be made at the source or by the employer. So it will be, we shall start with the advances. This is the money that was picked before the month ended. Plus, we add the pay plus the NSSF. Those are the only deductions we have. Then you press enter. When you've got that, you can double click here so that you get everything that is filled. Then The last one is the net pay. Net pay, as you hear the word, it is the gross pay minus the total deductions. When you remove the whole of those deductions, then what remains there is what the person is supposed to receive on the account. Then it will be equal sign gross pay minus our total deduction. Then press enter. Find that someone is remaining, double click there. You find that for Mwanga Loy is remaining with only 1,868,250, of which someone is saying we are paying you 2,845,000, but when the money reaches the account, you find it is only this 1,868,250. Meaning, if it wasn't this advance that was deducted of 480, this person was supposed to receive this plus this advance. That's the money, because this amount the person took it before the month ended. So that's how it is, and that's how we compute but the other part I've added, allow me to talk about it a bit in this part 8, because we have finished everything from here. Now we can even save, Control S. When we save, we can go ahead and finish this one. It's saying, assuming that the standard hours per month were 260 hours. Then they are saying calculate the house away scheme and the house scheme plus the loan scheme. These ones we can, let me just put them here because I'm seeing the other side, they may not fit there. So allow me push a bit here, small like that. At least you'll be seeing the net pay. Can say for the house scheme, these are methods that are used by different organizations to pay bonuses to individuals, leave alone this bonus you are seeing here, but they can also compute these bonuses, because these bonuses most of the times they base on the number of hours someone has spent on work. They set a standard hour that someone is supposed to take this, and when you find that you've incurred more than what you are expected, then of course they will take. We are saying that this one, it is a bonus scheme. For it, it says that if you are supposed to give someone a bonus on the time he has saved, because what happens here is that when people are working, they give them a standard hour or a standard rate to a standard hours that the work is supposed to be done. When someone gets or does the work before the time that is set, they pay them something. Actually, these schemes, they are just opposite to the overtime. This overtime for them, you work above, you exceed your normal working hours, and they pay you for that. But this one, it's a scenario whereby you've saved the time, the company has benefited, because when you save time, first of all, you may deliver the work they want you to finish in a short period of time. When you do that, then they expect that they can appreciate you, because if they were to spend those more hours, they could be putting a lot of money. Like here, we are saying that they assume that the standard hours that was set within the organization, they were 260 hours to finishing the job. But you find most of these employees, you are seeing them here, they did the job before these normal hours. So what we do, if let's say I'm computing for this one, let's say I'm computing for Roy, it will be 260. Now we are trying to compute the time saved. 260 minus the time taken, also what someone took. We said when you are putting, you start with, it is 260 minus the 2, which will give us 40 hours. It means this person saved 40 hours. and these 40 hours, those 40 hours are valued at the same rate, because they have not given us another rate, the same rate of 10,000. Now this 10,000, if you want to compute how much this person can receive on bonus, it will be, we shall say equal sign, it will be the 40 times the 10,000, press enter. It will be 400,000. But this 400,000, that will be the exact amount that the company should have paid for these extra 40 hours. But house scheme, for it, it says that if, let's say, the person has saved that time, we shall get the time saved times the time rate, then we divide that one by 2, or we get 50%. The person is supposed to be paid 50%. The person is supposed to be paid 50% of that amount that was saved. It will be 50% times the 40,000, meaning that this person, on top of this money he has got, this 1.8, this one will be added as an extra payment for saving the time. That's the house scheme. If you go to the lower to the house bonus scheme, this is the house scheme. Then there is house aware, as they said, house aware scheme. This one, for it, it says, for the house scheme, for it, it says that on this amount that the person has saved, we are paying him only 75%. That 75%, which is 75% of the amount that the person has saved the organization, it is what they give to the person. Or you can take it as 1/3. It will be 1/3 times the amount we've saved. So we are saying this one is paying us 133,333.3. This is the money that would have been paid to this person. What you get from these formulas, the formulas, if you want formulas, the formulas are given. Formula we have, it is 1/2 times, open bracket, the time saved times the timely rate, the time that is for this one, for house scheme. That's how we pay the bonus. Then for this one is 1/3 times, and you can open bracket, the time saved times, and to get our time saved will be equal to the time allowed, you can call it allowed, or the standard time, minus the time taken. So for each of that, when you get the time taken, it's what we got here. We got, this was the 260, that was the standard time, that is the time allowed, minus the time taken, we took 220. So we remained with this 40. This 40 is the time saved. Then we multiplied it by the time rate, which was 10,000, and we got 400,000. So when we divide this one by 2, we shall be getting 200,000. Then this one, the answer, we got the 400, we divide it by 3. Then we can go to law 1. For law 1, this law 1 says, law 1 scheme, for it, it gives us the time we've saved. It will be the time saved times the time rate, then we multiply by the time taken, and this is, the whole of this is over, the whole of that is over the time, around. So that's how it is. So to get the law 1, it will be our time saved. We said we saved 40 hours. It will be 40 hours. Let me put an cosine 40 hours, or we can say it is this times the time rate, which is that. Then we multiply by the time we've taken that, then this one is, all of it is over. Let me put some brackets. Then we can proceed and we say over the time allowed. Remember our time allowed was 260 hours. So you press enter. So this scheme will be paying this person. Remember, don't forget, when you click, you can check the formulas, they are up here. This one is supposed to give this person, 338,461.5. That's the money that scheme would give to that person who has saved 40 hours. Then it will be the same. You keep multiplying, you get the 200. If you go to this next employee, you go to the 260 minus the 2. If you go for another person, it will be the 260 minus the 250, the time the person has spent. Then you go like that and you put in the same formula so that you can get everything. So allow me stop here for today. I hope you guys have benefited. Let me try to make this one a bit. I highlight it and I make this one become a bit broad. Can try to put our currency signs if you want. Can put currency signs, Control A, so that we make, at least we put some borders, all borders, and you can also try to put in the currency. If you want the currency, you get here, you can check and put the commas. At least you put the commas to separate some of the things. This one happens because the space is a bit small, but if you adjust, it will come back. So we put the commas where necessary and we put the separators. So I hope that one can help you guys. And that's all for today. Thank you. Till we meet again. But maybe to put back for you to copy the question again for some 2 minutes, so that you can be having some time of copying the question. Thank you. Good afternoon, viewers. This is your tutor, CPA Charles Kafel, and today I'm going to take you through this question. It is a CPA question paper, and I've picked paper, this question from August 2019, that is CPA paper 7. I got some questions from someone that I add more on the payroll accounting, that is labor costing. That's why today I decided to pick this question, and I hope it will help you out. It is question 2. I picked all of it so that you know at least where they normally sit, but the theoretical aspects we handled it. And question 2 says, explain any Roman 1 4 causes of labor turnover in an organization. Those ones we talked about them in my notes, the one I gave you, but we can highlight some of them. We said labor turnover is the extent to which employees leave and join the organization. What are some of the causes? We say they may be the push factors or the pull factors, whereby someone may be forced to leave the organization. Those are the push factors. And you may find that there are other factors which attract people to join the organization. One of for them, they want only 4. One, you can talk about the remuneration in terms when the payment or the wage rate is a bit poor, we expect that employees are going to leave the organization. But when the employees are paid well, we expect that they are not going to leave the organization. So what causes them to leave the organization is because of the poor payment or poor wage rates. The other one we can talk about when people have, let's say, family issues, they are so attached to their families so that they can be with their family. They may just say that we are leaving the organization just because we have some family issues we have to sort out, and that can cause a person to leave the organization. The other one we can talk about is if they are going, let's say, for further studies, they may opt to leave the organization and go for further studies. Then the other one, the working environment. You may find the working environment where they're working is not favorable to them. Unfavorable working environment makes the employees to leave the organization. The other one, we can talk about the health conditions. If someone has some health complications, you may find that person may just say, I'm going off and I may not come back. The other thing you can talk about is death. Someone, when the person dies, automatically you don't expect that person to appear in the organization anymore. Last one, we can talk about the early retirement and all of that. So there are so many. So Roman 2 says, explain any 3 replacement costs of labor turnover. These things we talked about them. So I really want you to go ahead and first try to go through those notes I gave you so that you can be able to pick up. These replacement costs, of course, these are the costs which come in as a result of employees leaving the organization. When they leave the organization, the company incurs some costs to replace those people who have left. When people are joining, we expect that those people are going to be coming in when they are very green about what the company is dealing in. So we expect that the company is going to put in cost of training. When you're training the workers, you are incurring costs. So those costs, they are incurred as a result of employees leaving the organization. The other one we can talk about is, we can talk about the cost of advertisement, the cost of outsourcing the employees. It may be because when you're making, when you're looking for, when you want to replace people who have left the organizations, when you put in adverts, you're putting in costs. You have to put in shortlist or screening costs for those applicants. They have applied, so you try to find out the people who are capable and have their experience and the ability to replace those who have left. The other one we can talk about the losses, the damages to the materials, because materials and equipment. You may find that those people who are coming in, because they are not competent enough, or they don't know what is done in the certain organization, you may find that they are going to make the company incur some losses because of the damages, and those damages are coming as a result of incompetence or lack of experience. The last one we can talk about is the shortage in the production, because when the employees are very few, we expect that they are going to be producing few. And what caused the employees to be very few? It is because some of them left the organization. So when some of them leave, we expect that what we are going to produce is going to be limited. So that cost or that loss we are incurring in terms of, you may find that people's orders, they are there, but there are no people to deliver those orders. So that loss we are incurring is as a result of the labor turnover. I think you can add on more because they wanted only 3. Let's continue, because when you get those 3 and the other one was taking 4 marks, those are 7 marks. You find that only stating and explaining something small gives you the 7 marks as you grab this this one for the computation. The question says, excuse me, Crane Flowers Limited, that is CFL, deals in floriculture. Floriculture means the company is growing flowers. The company employs 25 workers whose monthly emoluments, these emoluments, they're like payments, monthly emoluments per work as follows. So what you are seeing down here, these are the number of employees, their titles, and what they receive in terms. This side, the shillings we are seeing here is the basic salary. This one is the basic salary they are getting per month, because here they said monthly emoluments per worker. The horticulturists, we have two, and they are earning 500. The accountants, they are two, they're earning 450,000. The general manager will have only one, is earning 600,000. Marketing officers, we have three, they are earning 200,000. The drivers, we have two, they are earning 150,000. The casual workers, we have 15, they are earning 125,000. So we may go to scroll a bit. We are saying the workers are entitled to the following. One, the horticulturists earn a daily overtime allowance. This is over and above their basic salary. So this is what they earn when they work for the overtime. They are earning allowance of 10,000 shillings, and they are expected to work overtime for only 102 days in a year. It means what we are going to be computing, it may be in a year, because what the information they are giving is regarding for the transaction that has been carried out during the whole year. Secondly, the second additional information says the general manager is entitled to a weekly allowance of shillings 15,000. If the general manager is entitled to weekly allowance, this payment is weekly. It means if you want to find out how many number of weeks are in a year, those are 52. So it will be the 52 times the 15,000 to get the annual pay or the annual allowance for the general manager. So if it is a monthly, you multiply by 4. We assume that there are 4 weeks in a month. Those are normal assumptions. The same way we assume that a month has 30 days. That's how we assume. Then for the accountants, they are saying additional information number 3, accountants are not entitled to any additional monetary allowance, but enjoy free accommodation provided at staff quarters. Since that one is not monetized, we can't recognize it. Yes, if they had given the value of accommodation, we would have computed that, but since it is not monetized, because they are saying there is no additional monetary allowance, it means the rest of the things they were paid in kind, and they were in kind, they were not given value. So we can't know that this accommodation was for this. But if they had given the figure, then we would have added it also as an allowance. The fourth additional information says marketing officers are entitled to 2.5% commission for every sale made. It means those marketing officers, they said up here there are 3. Each of them is entitled to 2.5 so long as they make sales. The 3 marketing officers are expected to make the following sales. These are the sales they are supposed to make, but these are direct monthly sales. So if you are computing an annual basis, we are supposed to be multiplying these sales by 12, because these are just monthly. John is expected to sell 12 million, because there is these zeros, these figures are in thousands because of these upward zeros. Mark is supposed to sell 14 million, and Anne is supposed to sell 10 million. Number 5 is saying additional information. 5 is saying all casual workers receive a daily allowance of 2,000. It is a daily allowance of 2,000 and they are able to work for 26 days every month. It means these people, they are paid on a daily basis. So, but they are supposed to work only 26 days. It means if you are computing for an annual period, you have to get those, you have to first get the 26 days times 12 to get those 26 in a whole year. When you get that, then you multiply it by the daily pay. Hope you've got that. But all of these ones, they are above their normal basic salary they gave up. Still, 6 is about casual workers. They are saying 5 casual workers earn a bonus for watering flowers based on house bonus scheme. The standard time for watering flowers is 56 hours per month. Each hour is paid for at shillings 3,000 during the period, during year ended 30th June 2019. Actual hours worked were 52 per month. Then these are the actual hours, that the hours they worked. They worked 4 hours in a month. So if they are monthly, we're supposed to multiply them by 12 so that we can get the annual basis. So, excuse me. The last one says, in a bid to motivate staff, senior management intends to increase all monthly salaries by 5% in the new financial year starting 1st July 2019, but no adjustments will be made to additional bonuses and allowances. Note, CFL uses house bonus scheme to calculate bonuses, okay? Because you know when you're using house bonus scheme, you must be having the time, the standard time, actual hours worked, so that you can get the time saved and you multiply it by the time rate and you divide it by 2 or multiply it by half or 50%. So they are saying required, determine CFLO's expected labor costs in the new financial year ending in the new financial year starting 1st July 2019. If they are saying it is a new financial year starting 1st July 2019, it means that this 5% is supposed to be effective starting from this very date, because they said this one is going to be effective in the new financial year, of which the new financial year is the one we are preparing. So it means when you are multiplying these bonuses, these basic salaries that are up here, we are supposed to multiply also by this increment. Of course, this 5%, something to increase, it means it will be from the 100 plus, which is exceeding. So it will be 100 plus 5, that will give you 105%. Or someone may just get the 5% and add it back. Okay, let's go to the solution and we try to calculate. I'm going to use Excel. Hope it is okay with you guys. Okay, let's go. You said you first create, whenever you are creating a statement, you first start with the name of the company. The next line will you are preparing, then the last one will be date or the time or the period where you are preparing for that. Let's kick off. Let's kick off and we see how we can handle this. I hope this one works and we have that when it's a bit broad like that. Hope everyone can be able to see. Let me zoom a bit like that. We can start. We've wrote our heading and we have to kick off. We start with we start with the basic salaries. Of course, this one we have already answered it. So allow me proceed with these ones. We start with the horticulture. Let me just copy it here, paste as it is. Here they are saying there are 2. So we are supposed to get this. It will be this multiply by this, by 500. Then we multiply by 12 because we said it is going to be for a full year. So multiply this, they were 2, we multiply what they are getting and multiply it by 12. But remember, they told us that the percentage, the 5%, this 5% is going to be effective, this, the increment in the basic salary. They told us there is this 5%. So one can do like this. It says equal sign 5%, which is 0. Let me just write 5%. We multiply it with less. This is 500. Oh, sorry. We multiply it by 500. Then we'll be getting this. When you get this, you add it back to the 500. Then the answer you get, then you'll be multiplying it. But it's better. The other person can do like this and says it is just 100. So it will be 105%, multiply it by 500. Sorry, I did not put cosine. It will be this, because if you add this one, it will be this 500. When you add these 2, you'll be getting this plus this. It will give you exactly like this one. So it's better we use the other one, because the other one will be saving you time. And then this one we multiply, we said we multiply again, we multiply it by 1.05. We said we will be getting equal sign 2 times 500 times 12 times 1.05. Let's make this one a bit bigger. We'll get the figure. This is our figure. This will be giving us, that will give us 1,260,000. It is 12,600,000. 12,600,000. That one will be done. And we go to the next person. The next person was, we have accountant, there are 2. So it will be accountant, say the accountants, and there are 2. So it will be 2 times their earning. Each of them is earning 400 and, sorry, multiply it by 12, multiply it again with 1.05. So it will be equaling to, I'll compute it from here, to multiply it by 450,000, multiply by 1. It will be that. So this will be giving us 11,340,000. That's for the accountants. We can proceed with the next one. Was the general manager and was earning 600,000. Was only 1, so general manager is 1. So it will be 1 multiplied by 600,000 times 12 again times 1.05, because there is an increment on their salary. So it will be this, and put it here. It is 1 sin 1 times 600,000 times 1.05 times 12. To the next person, that is the marketing officers. There are 3 there, and each is earning 200,000. Officers, there are 3, and each is earning 200,000. Multiply it by 12, multiply it by 1.05. It will be equating to, put it here, 3 times 200,000 times 12 times 1.05. Let's go to the next one. The next one is the drivers. We have 2, they're earning 150. Drivers plus they are two, and they are earning 150 times 12 times 1.05 equal to 2 times 150 times 12 times 1.05, and make this one a bit bigger. 2 times 50 3 times 12 times 1.05 times 1.2 times 12 times 1.05. Hope you guys you are getting how I got this 1 point. Hope you know how I got this 1 point. Hope you know how I've got this 1 point. The 1.05, it is equal sign 100. It is 105 divided by 100. That's how I got that. They told us it was 5%. So we can proceed the next one, which are co-workers. These co-workers, they are 15. Each of them is earning 125. So these are casual workers. They are 15 and they are earning 125,000 times 12 times 1.05 equals sign 15 cosine times 5,000 times 12 times 1.05. So we can get the total here. That's the total base key. Salary. And try to sum up here. Sum these ones. That's the total for this one. These are the basic pay. I've done it separate. I never wanted you guys to get confused by me computing these ones as I go with the additional information. The only something I picked from there was only that 5%, because for it was reflecting everywhere. But these ones, let me compute them separately so that you can be able to follow. But if you know what to do, you could be going horticulture, you finish everything from even the additional information, you finish everything, then you go to the next person. But if we are just starting, let me take you by that formula or by that method. I hope it will be a bit okay for you guys to understand it better. Then we go to the additional information. The additional information, they said horticulture earns a daily, horticulturists earn a daily overtime of shillings 10,000, and they are expected to work for 102 days in a year. It means now this is horticulture. So it's even coming here back. We can try to do it like that. We say overtime of, remember there are two people who are working in horticulture. There were 2 times the pay. The pay was 10,000 times the number of days times 10,000. Sorry, times 10,000 times 102 days. Then it will be equating to cosine times 102. Let's enter. So if you want to find out if let's say the horticulturists they are done, you could be getting, I'm sure the horticulturists they are over from there, they are done. So if they are done, then you could sum up this one. You could get the total what they paid to the horticulturists by getting this plus this. This is the money that went to horticulturists. Total pay you can just make it like that. This one. So I hope guys you've seen how you can do it. You can either go by this way or you go by this. First sum up this one, then you see how you can do the rest. You can go to the next one. The next one is saying we have the general manager is entitled to work weekly allowance of 15,000. If it is a weekly allowance, it means we are going to be multiplying by 52 because we assume The general manager, sorry guys, but this one came in, this one will delete it because if you include it will be double counting. If you include that one, it will be double counting. General manager, this one we don't need it because we have already worked for it. We just want the money this general manager is getting. You said it is 15,000. It is 15,000. We multiply it. It's 15,000 times 52. Those are the number of weeks that are in a year. It will be equaling to sign this one, multiply it by 52. So you can go to the next one. Then this one is not supposed to be there. The next one, we said the accountant, this one, they are not entitled to anything. So we can skip that one. We got the marketing officer, they are entitled to 2.5% commission for each sale made. There were 3. So it would be 3 times. I'm going to add up these totals. I'm going to sum up. I'm not going to split each, but okay, let me split for easy understanding. Mark is taking 12 million. Marketing officers. Then down on we have Mark. We have John. John has supposed to sell 12 million, then times 2.5% times 12, because these were monthly sales, these ones, they were monthly sales. So you have to multiply by this and multiply by, hope it's all, yeah. For Mark, for John, that's all. Then we can come here and say cosine 1.2, 12 million multiplied by 2.5% times 12. It will give you that. Then for Mark, it is 14 million. This is Mark, 14 million multiplied by 2.5%, multiplied again by 12. This we shall be getting, sorry, sine million multiplied by 2.5%, again multiplied by 12. Be that. So for the last marketing officer, who is Anne, supposed to sell 10 million. Anne supposed to sell 10 million, multiplied by 2.5%, again by 12. The set will be cosine 10 million multiplied by 2.5% times 12. To give you 3 million. Then we can get a total here. Cosine sum. It will give you that. That's the total. This is total commission. That's total commission. Hope we are at par. Allow me go to the next one. The next one says all casual workers receive daily allowance of 2,000 in 26 days every month. So we go to the casual workers. They're saying all casual workers, there were 15 casual workers, and they're supposed to be 15 times 2,000 times 26 times 12. It's supposed to be 2,000, that's the rate, times 26, that those are number of days, times 52 in a, so sorry, supposed to be by 12, those are months. Then we multiply it with the number of the employees. Those casual workers, they were 15. So it's supposed to be this 2,000 times 26 times 12 times 15. These were the number of the casual workers. These are number of months. These are the days each month they are supposed to work. This is the rate per work or per day. Then 5 casual workers are entitled to bonus of watering. There were 5, but these ones, they are paid on the basis of house scheme, house bonus scheme. And we said the house bonus scheme said house bonus scheme equals to 1/2 times time saved times timely, but we said but time saved equals to the time allowed minus the time taken. That's how we get that. When you get these, this is the formula we are going to use. When on the time, if let's say you save, let's say, because here they said the standard time for watering the hours, this is the time allowed or the budgeted time, 56 hours, but someone took these hours, 52. If you less this minus this, they're supposed to be 4 hours. So if it is 4 hours times 3,000, it means that is the whole amount of bonus that is supposed to be paid to the worker. But using the house scheme, we are saying that we are not paying that employee the full bonus, we are paying him a half of that. But remember, this one is per month. Even these labor hours, they were in a monthly basis. So we have to compute them into, we shall get the standard hours. Here we are saying bonuses. We have the standard, and just continue from here so that we don't waste more time. Since I've explained to you, we said it's going to be 56 minus, these are hours, allow me use that abbreviation, minus 52 hours, then all of it is multiplied by a half, again multiplied by the time rate. The time rate was 3,000, that is the rate, then we multiply again by 12, because we are computing annual basis. So it's supposed to be, when you deduct the 56 minus 52, those are 4 hours. Then it will be 4 hours times the 3,000 times the 1, 2, the 12 times 1 divided by 2. It gives us that. That's the figure for the bonus that is supposed to be given to these workers. So we get these casual workers. So we get the total. It will be this plus this. These are the total pay, meaning it is inclusive of the bonuses, and so that's how it is. We can go to the next one, which is talking about, also we forgot these were only 5 employees. We computed for only 1 person here. This one was supposed to be for only 1 person. The one we computed is for 1 person, but there were 5 people. So we have to multiply again by 5 times 5. I'm sorry for that. I'd not seen that. You can adjust from here and we say multiply it by 5. So that we get that. I'm sorry for that. I did not see, because they were said 5 casual workers earn a bonus for watering using this house. I think that's all. It's done. If they are saying expected cost for the workers, if you want, you can even sum up, you get the full cost, but it's not necessary to sum up all of this. You add this and these ones, you can add them if you want, but they are not, it's not necessary to add them up. But you can do it if you want. You can call it grand totals, and put it here, or we put it at least a bit separate from there. It will be plus, I forgot this, it's there for overtime, plus this for the general manager. I think that's all. Those are the ones. You can press enter and you get the whole cost they paid, but this one is not necessary. That's it, and I think it's all for today. maybe can put for you the currency sign so that you don't get confused. Let me put for the separator so that they are a bit separated from. That's it. And thank you for watching. Please subscribe because there are more and more which are coming in, and we are going to be able to learn. There are so many things here for us to learn. So I kindly requesting you to subscribe, and you can share these videos to others. And if you don't understand, please comment so that we can help each other. Thank you. Till we meet again for another video. It's bye for now. Morning viewers, this is Charles Cafe again. Welcome to my channel, and in this video we are going to be talking about overheads and how we account for them. But our main emphasis is going to be on the production or the manufacturing overheads. The one which are non-manufacturing, those ones we can handle them at a later time because those ones are very easy to handle. But let's look at this production or the manufacturing overheads. We are saying, as we spoke last time, that overheads or overhead costs, these are common costs. They are called common costs in a sense that they cannot be directly identified or traced to the cost centers. We are saying these are costs that cannot be identified with a particular or a specific cost center because they are normally incurred in the benefit of more than one product or cost centers. And here we are saying they are in two forms. We have the manufacturing, those are the production, and the non-production overheads. But in this video, we are going to concentrate more on the production costs because they are the ones that forming up the cost of the units we are going to be producing. So our main emphasis is to look at what is the portion of the production overhead that we are incurring in the production process. First of all, you have to understand that how these overheads come in is as a result of increased use of mechanization and automation of the processes. When we are using machines, we expect that the cost we are going to be incurring on those machines, we can't directly trace them to where they are supplying the service to different departments, because we say the cost centers, those are departments, processes, and they include both the production and the service department. So when I'm talking about the cost centers, just know, as per now, I'm talking about the service department and the production departments. But here, when we talk about the overhead costs we are incurring, you can give an example like if let's say you're using robots, and these robots are used to supply raw materials to a given production department and service departments. So if you are using these robots, their cost cannot be directly traced to where they are supplying those raw materials or to a given production department. So what we do when you have these costs is that there are methods we follow so that we can try to find out how much are they, and we accumulate them to the production departments. So I was saying these costs, they come as a result of increased use of mechanization. If it was during the traditional period where we are using labor intensive techniques, or where we are using more workers, because the salaries we pay to those workers, the salaries and wages, they can directly be traced to the cost centers, because we can know that this person has worked in this department and has produced this, and we are paying this person this, so that one becomes the direct cost. But since we introduced this mechanization and the automation of the production processes, so we are likely to incur more costs which cannot be directly traced to a given output. An example you can talk about of these costs, you can talk about electricity. If you're paying electricity for the whole production department, if let's say you have allocated 10 million for electricity for the whole production department, but that production department within has different stages where products go through to until they reach the final destination. So we can't allocate that electricity to those departments which are within the production department. So what should we do to get those costs? We try to know how many units of electricity this department is consuming, the other one is consuming, and the other one is consuming. What we do is that we have some steps we follow to make sure we get those overheads in a rightful amount, because if you don't do so, we are ignoring some costs, because as you know, we are talking about the production overheads and they are supposed to be part of the total costs. So failure to determine those costs and you link them to where they are incurred, you are likely to face a problem with the determination of the total cost. So one of the steps we follow to do that is cost classification and correction. What we do, we correct those overheads we've incurred and we try to classify them into different groups depending on their nature, how they behave. That's one of the stages. The first step is to collect and classify the overheads. Then the second one, what comes next, is we allocate. These resources means you are just assigning or distributing those costs to those different production departments or cost centers. But we can only do that when those items can be traced to those production centers. But if they cannot be traced to those production centers, then the next thing we shall be doing is to apportion them. If we can't directly trace them to that cost center, we apportion them. How do we apportion them? Like for electricity, we get the number of units, we select the appropriate bases, we get the number of units that are used by different departments, the number of kilowatts that are used by different production departments, which contributes to the total cost we've incurred in electricity. That's the second stage. The third stage is when we have accumulated those costs. Remember, we are talking about the cost centers. We have the production cost centers and the service cost centers. If we say in a manufacturing firm, you may find that we have a store department, we have a maintenance department, and we have these production departments. These production departments, they may be having different departments. If it's a mixing department, fermenting department, and others, depending on which type of item the company is dealing in. So you may find that the stores department is the one keeping raw materials that are supposed to be used by the production department. And the other maintenance department is the one helping to make sure that the machines within the production departments, they are working. So when they are working, remember we have to distribute. If let's say it was electricity, we have some electricity that is used in the stores department, we have some electricity that is used in maintenance department, and that is used in the real production department. Then what we have to do is, for this third step, is we remove those we reapportion the service department costs. We take them to the production department. The reason as why we are doing so is because in the service department,
those ones, they are just supporting items to the production, because in the service department we don't produce anything from there. We only produce when the things comes into our production department. So what we do, we remove those costs, since those costs we've incurred in the stores department and the maintenance department, those departments, they were helping the production to prosper. Then we have to remove their costs and we put them back to the production department. That's what we call reapportionment of these costs. Then the last one we do is we make sure that we absorb, after reapportioning those service department to the production costs, then we remove those costs from those different departments, the mixing department, the fermenting department, and we remove those costs and we combine them to make the final output, that output which is coming out of the production process. We find out how much is contributed by the mixing department, how much is contributed by fermenting department to the total production. How do we do that? We do that by absorbing. Now here we are absorbing overheads. The other side, we are just distributing depending on the portions they are contributing. But this time around, when you are absorbing these overheads, we use the absorption rates. That's overhead absorption rate, that's OAR. And that one, I was just giving you a brief idea about how the stages go until we get the total cost that we've incurred, the total production overhead we've incurred in the units we've produced. So we go to say the first step. I'm going to explain the first one, and I leave, since I have given you at least a clue of what is supposed to be done there, let me make this one the collection and classification of overheads. I explain it a bit longer, and we shall take some computations, some practical questions, and solve them out so that we know how we really get those costs. We said that now we are explaining the steps that help us to distribute these overheads to the final products. But remember here, the first step is that we have to first accumulate those costs. Collection and classification of overheads. This involves gathering the overheads from different sources. They may be from invoices, like for the other example of electricity I've been using. If let's say here now, when we mean that we are collecting and classifying the information, we are collecting the number of units that are used by different departments. What is incurred in the production department, what is incurred in the stores department, and the maintenance department, those two service departments. What are the number of units? Now we are in terms of units, the kilowatts we are spending in those departments. By classifying them, we are classifying them by their cost centers, that this number of units they are incurred in the stores department. That's a class, stores department. The maintenance department is a class. So that's how we do that. But when we accumulate those costs, we said that some of these costs, some of them are variable. You may find that some of them are variable and others are fixed. You know, if a cost is fixed and if the cost is variable, you know the impact on the total cost. So we need to know to separate those costs to get the fixed component and the variable component within those overheads, so that we can see how we can control some of them, because you may find that the one which are fixed, they cannot be controlled, but at least the one which are variable, you can try to find a way of how you can minimize them. That's the instance. So here we are classifying the data with these costs. They are grouped into the fixed overheads, same variable, and the variable costs. And the problem comes in when we have those semi-variable or the mixed costs. When we have those mixed costs, we need to also separate them so that we get to know what portion goes to the fixed, what portion goes to the variable overheads. Reason why that is because we want to find a way of how we can control some of them. Those which are controllable, we find a way of how we can control them. These are the methods we use when we are separating the mixed costs to get the variable component and the fixed component. We use so many methods. One of them is high-low method or the range method. The other one is least squares or the regression analysis method. The other one is scatter diagrams or graphs. Then the last one is a simultaneous equation, whereby you form an equation and you try to solve it out, get those costs. But what I'm going to put more emphasis on is, as per this level, these two, they are the ones they ask mostly. This of the high-low method and the regression or the least squares method. These ones I'll take also a question. We shall pick one question, a CPA question. We solve it. We do each and every method using that very question so that we get to know the differences. So allow me give you some brief information about the high-low method. This high-low method, as the name suggests, range method. A range is the difference between the highest and the lowest. But here, what we are interested in, we are interested in to know what is the highest activity levels and what is the lowest activity levels. We compare the activity levels, not the costs we've spent on certain activity levels. I repeat that one. When we are using the high-low method, we compare the activity levels. We pick the one which has a highest level of activity and the one with the lowest level of activity. When we are removing those ones, the highest and the lowest, we pick we pick the highest and the lowest with their corresponding costs, total costs. So that when we are getting to know when we are substituting these formulas, as we are going to see them, you'll find that what we want to get is that total cost, as we know from our costs, that total costs equal to the fixed costs plus the variable costs. So we want to know what component that is there in that total cost, which is fixed, and that is variable. So what we want to first get from there is the variable component. Since you know that the variable cost, to get the total variable cost, it is your variable cost per unit, multiply it by the output or the activity level, of which these have the activity levels, but what we don't have is the unit, the cost, the variable cost per unit, of which if you want to get the variable cost per unit, you get the total cost of the highest activity level minus the total cost of the lowest activity level divided by the highest activity level minus the lowest activity level. That's how we get the variable cost per unit. When you get that variable cost per unit, you can select any of the two, those activity levels. You may decide to go by the highest activity level, then you pick the number of units, you multiply by the variable cost per unit so that you get the total. When you get those total variable costs, since we know that the total, to get our total cost equals the fixed plus the variable costs, and we have the total costs, we have calculated for the variable costs, so we can just get the total cost minus the variable cost we've got, and we remain with the fixed costs. As you can see, the formula is here. The total fixed costs, they are equaling to the total cost minus the variable costs. But these this total cost, we already got it, because when you pick the activity level from here, either you go by the highest or by the lowest, you pick the highest activity level and its corresponding cost, total cost. So you'll be using this corresponding total cost and the corresponding activity level. So when you substitute here, you'll be getting your total fixed costs. So when we have got that, then we have separated, we have known that these are the cost one, these are the fixed one, these are the variable one. Then we can go to the next step, which was this allocation and apportionment, as we shall talk. This one is going to be in the next video that will drop in after we've analyzed this one, because as I told you, we have to first look at how we can segregate mixed costs into a fixed component and the variable component using these different methods. So I'm going to pick a question and I'll do that, but this is going to be in the next video so that you don't get confused. What I can tell you is that please subscribe so that you get to know as when I'm putting another video, so that you can get to learn more and more as we go on. Thank you for watching. God bless you.
Good afternoon, viewers. This is Charles again, and today we are going to continue our series of cost accounting, and we are going to be handling overheads. The last video we talked about cost classifications, and these are the ones we are going to find how we can segregate them, how we can segregate the mixed costs into the variable and the fixed component. So we can kick off. The question we are going to be handling is question, hope you can see the whole screen. It's question, we're going to use this question 6, and this is CPA past paper October sitting 2021. Then this one is 2019 May. So let's first consider this one for October 2021, and we compute the hierarchy method. As I said earlier, that we are going to be concentrating more on the hierarchy method and the least squares. So can kick off now. Go to solutions. This is solution 2021. So what I want you to get in mind, if you're using the hierarchy method, we said we compare the highest activity level and the low activity level. We are choosing those activity level which has the minimum and the maximum. So can go on. Maybe I can give you a brief introduction for those who can't get it right. We can say that when you're using this method, what we want to find out is that we want to separate these mixed costs and the variable costs. But the only way we can separate them is choosing, let's say we can use the equation of a line. We said from our mathematics that the equation of the line equals, it's y equal to mx plus c, and we said this c, we said the y was, this was the constant, this one was the constant, then this one was our gradient, m is a gradient, this is gradient, and our x is the x coordinate, and this is the y coordinate. So you know from mathematics that when you're finding gradient, we get it by getting the y coordinate, y2 minus y1, everything is over y over x2 minus x1. So when you use this, it will be that this y2 will be the y coordinate, of which it will be the highest coordinate minus its coordinate over the highest minus the lowest coordinates in terms of the x values. So when you compare with that, it is the same way we are going to be using this method, because you know from the when you want to compare this equation of the line with our equation of total costs, the equation for the total cost is equaling to y equal to bx plus a, or a plus bx, and this a becomes our total fixed cost, and this a is representing this c within the equation of a straight line, and this b is the variable cost per unit, which in these terms representing the m, which is the gradient. And the way we got the gradient is the same way we are going to be looking for the variable cost. And this y is representing total cost in this equation of costs. This is a general formula and it's recognized even if you use it, that y equal to a plus bx. It's a recognized formula so long as you can explain the coordinates that this is the total costs. If you don't use this one, you can use this and you try to explain the letters you've used. So that's it, but I recommend you use this one because this one is allowed, it is acceptable. You can call it a plus b or b plus bx plus a. Now what comes from this is that this b is the one we are looking for because we don't know that one, and our b will be equaling to the variable costs, and the a will be equal to the fixed costs. Then this x will be equaling to the output, and the y will be equaling to the total costs. So we are going to be using this along with our computations we are going to be handling. So hope you can be able to remember this because we are going to be using them. Now, when you look at our question, October 2021, they have given us that the management accountant of TPL has further provided the following cost data relating to bridal magazine for the 6 months period ending 31st October 2021. So we've got the months, we've got the output in terms of the magazines, the number of units, then we've got the total costs. This total cost is inclusive of the fixed and the variable costs. But remember, when we are using high-low methods, the main emphasis or the main assumption is that we assume that the total fixed costs within this item, they are fixed or they are constant at any given level of output. If you find that the cost within the total fixed cost within the total cost is not constant, then it means you can't apply the high-low method. So we are going to be looking at this, then we shall get another question which has a step up in the fixed costs, so that we know how to handle that. Because when you have the fixed cost which is a bit different, you can't use high-low methods. Maybe if you first make adjustments, as we shall see in the other question, which has some step up in the fixed costs. So we compare these output, the level of output, and in this scenario, the level of output is in terms of the magazines they produced. So when we check what will be our highest and what will be our lowest, here when you compare this, you'll find that this one in August we had 10,000 units of magazine. So this one is going to be our highest. Our highest is this. So we can copy it and we take it the other side, paste it here, and this is our highest. Put here highest. Then we check our lowest activity. Our lowest activity level is this, which has 7. It happened in May. which has 7,500 units of output. Then this one is going to be our lowest. This is our lowest. So we know from that, from this equation, this gradient, when you're finding the gradient, it will be now our highest. This is the highest. So when you are finding the variable cost, because we say the gradient is the same as the variable cost per unit. This one is supposed to be variable cost, is variable cost per unit. So we are saying that the variable cost per unit, we shall get the highest activity, then we'll less the lowest activity. You can just find it from here. It will be cosine this 10,000 minus 7,200, the 7,500. Saying, sorry, it will be this cosine 10,000 minus the 7,500. It will give us 2. It is giving us that. Then also this one will be 75,500 minus the 58,000. This will give us a 17,500. So the other way someone you can express this one, you can take that, because when you get this, to get our variable cost per unit will be equaling to this. It will be this one divided by this. Then it will give us 7 shillings. These shillings, this is the variable cost per unit. So if you want to get the total variable cost, you will be getting, make it a bit broad. We say this is our unity, the variable cost per unit. So we want to get our total variable costs. Total variable costs, this will be equaling to, because we said this, the fixed, the total variable cost is this bx. So it will be our b, which is the 7 times any level of activity. Here we are saying you can choose. The first step, you say choose any, choose either. We are saying we choose any of the activity levels, either high or low, either the highest or the lowest. So we can take any, and in this time I'm taking the lowest, and our lowest, this was in May. I copied that and I paste it here. So when I take this is our lowest. So I'm going to use this activity level. It will be, to get our total, our variable cost, total variable cost will be, equaling to 7 cosine that times this. It will be multiplied by the 7,500. It will give us a total variable cost of 52,500. So if you want to get the fixed costs, then the fixed costs, we say they are going to be equaling to the total costs minus the total variable costs. Remember this one, at any given or within a relevant range, and our relevant range is here, is the level of output which they gave us. So when you compare from our lowest, the lowest activity level we chose, the total cost is 58,000. Then the total variable cost is this 52,500. So to get the fixed cost, it will be fixed costs will be equaling to cosine this 58, or it will be this, it is 58,000 minus the 52,500. That will give us 5,500. Now this is our total. This is our total fixed cost. If you choose, let's say we take the highest activity, it should be also giving us the same information. If we take the highest, then it will be the variable cost will be equaling to variable cost, saying the variable cost equaling to this. This is the variable cost per unit, which is 7. It will be cosine this, multiply it by the level of activity, which is 10,000 units. We'll be getting 7. We will be getting 70,000. And these are our variable costs. So to get the total fixed cost, the fixed costs will be equaling to, they will be equaling to 75,500 minus the 70,000, which is the total variable cost, and it will give us the same total of 5,500, and this is our total fixed costs. And we said that total fixed costs are constant at any given level of output, because here you are seeing at the highest level of output, which was 10,000 units, the total fixed costs remain the same. We incurred the same amount as in 5,500. Even when the level of activity, which was 7,500, we incurred the same total fixed cost of 5,500. And that happens within a relevant range. And we shall see if the costs exceed the relevant range. You may see that the total fixed cost will change, but there will be just a step up or an increment, and at that level it remains constant until it exceeds another range of activity. So that's it, and that's how we calculate we segregate these total costs, because from here you can even, the management can take the decision of how they can control these variable costs, because the variable cost at the lowest activity level, it was 52,500, but when we increase the level of output, they also increased. So it means they are varying in the same proportion to the level of activity, because we are seeing it is the variable cost is 7, but we are multiplying that figure to any level of activity. And if you don't produce, that's why, because when you don't produce, it will be 7 times 0, which will give us 0, which confirms us that at 0 output, we don't incur the variable costs. We only incur the fixed cost, because even if you're not producing, that amount of the fixed cost is still paid. So that's it. We are going to look at the least squares method of how we can separate these variable costs in the next video. Thank you for watching. Good afternoon, viewers. This is Charles again, and today we are going to continue with our series on overheads. That's cost accounting, paper 7, and we already finished the high-low method. So allow me go to the least squares method, and we're going to be using this question 6, May 2019, that is CPA paper. And it says the academic registrar of the Shak Public University has identified the number of hours taught as a cost driver for extra teaching overheads. The following is a summary of the number of hours and overhead costs for the paper taught. For the papers taught per month, we have the months, we have the number of hours, then we have the cost they spend, that's the overhead cost. They are saying these overheads, they gave a cost driver as the number of hours taught. It's like this cost they have incurred on teaching, it can only be traced to the number of hours. If you want to determine these ones, we shall see the cost drivers. Those are the ones that we use to absorb the overheads. We shall see them when we reach to that. And the required is saying using least squares analysis, estimate the overhead costs when 350 hours are taught. The saying it is 10 marks. And you have here explain any two causes of over and under absorption of overheads, 2 marks. Accounting treatment, it's also 2 marks for over and under recovery of overhead. These ones we shall talk about them, but to give you a brief idea is that when you say you plan to produce 10,000 units and you have a cost of let's say 10 million, and that's what you are trying to spend. That's what you are estimating to spend on the production of the 10,000 units. And when the actual production takes place, you find that instead of producing the 10,000 units, you have now produced 12,000 units. It means we've incurred more than we were supposed to produce. So it means there is under absorption, there is over absorption of overheads, in the sense that you've used the same amount, which is 10 million, to produce more units than you expected. So that one will be added as a gain in the profit and loss statement. Then for the over, it is the opposite, where you produce less than your expectation and you've incurred the same cost. That one becomes a loss and it's supposed to be deducted from the figure of gross profit in the profit and loss statement. So what I explained, and that's how we treat it in, but we shall learn more as we reach there. So allow me kick off to what we plan. So can go to get a sheet. This is solution 2019. I have extracted this formula from online for you because it will look nice when it's a bit. So we are going to look at this one later, but let me try to explain something. We said the equation of the costs, the cost equation, we said it is y equal to bx plus c, and this was derived from the equation of the straight line, and we said y equals to the total cost, or you can call them mixed cost, total cost, because an example of the total cost is a mixed cost. Because as you know, the total cost has both the component of the variable cost and the fixed component. So we said B was the variable cost. This is variable cost per unit. And the X was the activity level. This is the level of activity or output. We are using level of activity because sometimes you may find that it is not output and they have given you, let's say, number of hours. They have given you machine hours, labor hours. So we are using level of activity in that sense. And our A was the fixed cost. And we said, but remember when you're using regression analysis, this method it gives the relationship between the total cost and the level of activity. So when you're trying to look at the relationship between those two variables is that we want to know whether if the level of activity changes, we expect that all the mixed cost how will the mixed cost or the total cost respond to the changes in the level of activity? If the level of activity doesn't change, because we know that our X, and in this case, our X will be equaling to the independent variable. And the independent variable is something which doesn't change or its occurrence doesn't depend on the other. So our Y, which is the mixed cost, will be the dependent variable, and this variable, it's something which depends on the other. If let's say we want, because here we are trying to look at the relationship between X and Y, and in this case what we want to know is that when the level of activity is increasing, what will happen to dependent variable? Is the dependent variable going to be constant, or it's going to be changing? But from here, from our equation, we've got these are the methods we use to determine this A, which will give us the fixed costs, and this B that will give us the variable cost per unit. This B will give us the variable cost per unit. So when we compute these ones and we get the values, then we can substitute in our formula so that we can get the relationship, or we can get the straight line, because you can do it graphically and you plot those figures and you try to look for this A and B. Or you may be using this, when you have got A and B, you can put it in the system here in our equation, and this equation will be giving us what we are going to be using to determine if, let's say, they give you a certain level of activity and they want you to determine what will be the cost, or they give you the total cost and they want you to determine the level of activity, as we are going to see. Because this method is your thing, you can try to prove how they came about, but this is a bit mathematical, it will be a bit confusing. I hope you can get these formulas. And the other way you can find this A, we have an alternative for A. We can say that our A will be equaling to this, because we are just making here, we just make A from here the subject of the formula, which will be our Y minus our BX. And as we say, this Y is the same as saying fixed costs. Fixed costs are equaling to the total cost minus the variable costs, the total variable cost. But in this time round here, we are looking at these values when we are just giving in their average or the mean. Since we are going to be using the whole data set, like for this one, you will be seeing that we are going to be using the whole data set from January to May. So what we want to come up with one digit that we can use. And the only way we can get that is for us to get the midpoint of these values, whereby we shall be adding this one, we find the sum of this, and the sum of this we divide by their numbers. This is 1, 2, 3, 4, 5. So when we get the total of this one, we shall divide by 5. And this one we sum up, we divide by 5. That's how we get that. So in this case, this one will be having, since we want the average, then we shall say that all over, that is over. Let me try to increase the font size here, you'll be able to see it well. Let me try to increase a bit, make it broad, and increase the font size to that point. Then we say this one is supposed to be divided by the number, that is the number of items they have given you. Divide by, can say this one divide by, can put this one in a bracket. Then we say divide by n. Say that we divide by n, and now our n will be representing the number of the data set. You can either use this one or you use this one. Other books you may find when they are writing summation y over n, summation x over n times b. You may find when they are writing it like that. But here, you just know here we want the total values of the mixed cost and the total values of, let me also put total so that you don't get confused. Total y, you put this y in bracket. Don't want you guys to get confused. And this number, because this number is very, very easy. Here we are saying we want the total value of x, but this one is multiplied. So we put a multiplication sign, use that this, what we are getting from here, we are just lessing it is the total. So you can get it like that by getting the total of y, and our y, we said it is the dependent variable. So from there you can get you get also the total for x, then all over you divide it by the number. There are 5 in total. So that's how we calculate the a, because if you want to get the a, you have to first get this b, because this b is not calculated yet, because it's, you first look for the b, so that you put it in this and you get what we are going to be using as in terms of, let me put it up there so that you can be able to do other things from this space. Allow me remove this because I don't think this one, it will be of any use, because you have already known the costs. You can remove that, and that's how we get those formulas. When you master those formulas, then you can either use this or this for A. But if you are looking for the B, this B has no alternative, so you have to be able to master this. We are saying it is n. N means the number. Let me also put our n. We say that our n equals to the number of observations, what they have given us. So that's how we get our n. We just count the how many and you put that one. So having known those ones, then we can be able to proceed with our solution. We said we are going to be using least squares. It is least squares. Let's get our data values. Okay, we just want the number of hours and the overheads we spent. Said in January, I'll try to copy these ones. These are our data values. And here we are seeing that because we are going to be following this formula, and we shall be seeing what we need. We need x and y, we need x squared, and we need, that's all we need, because the rest we just need the total of each. We need summation, the totals of x value, the y values, and that's all we need. Can start from our x values, but they say these are hours. The unit is hours. Then we need our y value, which are in thousands. These are in shillings. So we get our x and y. They are also in shillings. We also need our x squared. Now we can call it x multiplied by x. That's our x squared. But we say these ones are in hours. So we can proceed. All of this is not coming to be 200. This is 240. This is 260. 300. 320. 2,500. 4,100. 4,400. 5,000 and the 5,300. Those are our values. Can get a total here. So sum this. This is going to be our total. So it's not there. Also get the total for the cost. What is that? Then we get this. Our xy will be this multiplied by our total cost. Also get their grand totals. So we get our x squared. This is our x multiplied with the same. Will give us that 40,000. Okay, we get this, the total, and that's all we need. For having got those totals, we can now proceed with our submissions. We put them in the formula, and we said we first get our b, and the b will be equaling to this. Said we want to start with b, and b will be equaling to this. It is going to be our n, and our n in this case is 5. It will be 5 multiplied by the summation xy. Summation xy is this, which will be our 21. It is 21,288. This one we can put it in a bracket, minus, can open here brackets for summation x is this, which is 1,320 minus, sorry, it's multiplied with the summation y, which is 70,000, and we close the brackets. All of this is over, all of that is over our 5, multiply it with, then we can open the brackets and we say our x squared, which is 357,600 minus this one, we can put it in bracket and we say want our x, summation x bracket squared. So it will be this 1,320 bracket squared. Can multiply it by itself and you'll be able to get that. This one will put another bracket to close the other one, and that's how we shall be getting that b. So we can try to simplify everything now by getting this. Can say cosine, can say that it is 5 cosine 5 multiplied by this, then we press enter. At least what we are lessing, what we are deducting, we remove it from here. We are saying minus, so this one, let's put it here. What we are going to be lessing, it is cosine 1,320 multiplied by this, it is that. So what you are going to be dividing is going to be this, which is 5 multiplied by this one. We shall be getting that. Then for this, it will be cosine 1,320 multiplied by 1,320 will give us that. So when we deduct this, cosine this minus this, we shall be getting that. Then we get also this, sorry, supposed to be here. One which was here was this 1,320 multiplied by 1,320. Then to get for this one, it's supposed to be this minus this to give us that. So we get the division, and this time round it's going to be this one divided by this, be equal to 307, and round off we make it 8. Then we get our a, and our a, we said it's going to be equal to this, so it will be the total of this divided by cosine this, the total of y, divide it by 5, be giving us that. Then we also get our x, this, which will be cosine this divided by 5. So when you get the difference, you shall be getting this minus this. So this is our a. We can now try to form the equation of a straight line, which is going to be y equal to, we've got our a. Oh, sorry, here we've made a mistake. This one was supposed to be multiplied by our b before we less it. This answer we got here is supposed to be multiplied by b. So it will be this cosine this multiplied by the 308, and it will be giving us that. So our a here will be cosine this minus this, which will be giving a negative answer, which is 67312. So we can try to get our equation, and our equation is going to be, since we said we are generating it from here, we have our x, our b, we've already got it, it is equaling to 308 x. Then here, since this one is a negative, so you're going to be lessing the 6712, and this becomes our equation of the line. So then the question said we have to determine the cost when the hours are this, and we said the hours, we say the hours our x, so we are supposed to put where the x is, we put the value, the 350 they have given us this, so that we can determine the total overhead we've spent. So our y will be equaling to, they have told us when x equal to 350 hours. So we can try to find our y, and our y in this case will be equaling to this, which is the 38. It will be this one multiplied by the 350 that were given to us. Then we less the 67312. So the total cost will be 40,488. And that will be our final answer. Good morning, viewers. This is Charles again, and today we are proceeding our series on overhead costing, and we are going to look at the regression or least squares method of cost separation. And the other time we saw how we can separate the mixed costs into the variable components and the fixed components using the high-low method. And today we are going to use a linear regression method, so that, or a least square method, we see how we can separate these mixed costs into the variable component and the fixed component. And we are going to use the question, that is question 6, May 2019, that is the CPA paper, and we are going to use that. We see how we can separate these costs. So it says, the academic registrar of Ishak Public University has identified the number of hours taught as a cost driver for extra teaching overheads. The following is a summary of the number of hours and overhead costs for the papers taught per month. Here they are saying, as we earlier said, that these overheads, they cannot be directly traced to the final product. And what we can only do is by getting the appropriate base, which we can use to apportion those costs. And after doing that, then we can remove from the production department and we try to absorb them using the OAR, or the overhead absorption rates, as we are going to see in the next videos that will be talking about how we absorb overheads. But as per now, we are still separating the costs into the mixed costs and the variable costs, and we see how we can really try to allocate these costs to where they belong. So we have the number of months, we have the number of hours, and the overhead costs in shillings. That's January, we incurred 3.5 and we spent all that on the 200 hours that were taught. February, we have 240 and we incurred 4.1 That's 4,100,000. In March, we incurred 260 hours, and the total cost was 4,400,000. In April, we incurred 300 hours at a cost of 5 million. In May, we incurred 5.3 on 320 hours taught. So required, using least squares analysis, estimate the overhead costs when 350 hours are taught. The question wants us to find a linear regression line so that we can determine the total cost that will be incurred when 350 hours are taught. First of all, what I want you to get into your mind is that when you're using this linear or whatever least squares method or the regression line method or analysis, this one gives us the relationship between the variables. And in this case, we have the overhead costs as our variable and the number of hours as ours. It stipulates this variable overhead variable. It stipulates these variables into the fixed, the dependent, the independent, and whenever you get a question, try to find out which one is depending on the other, because we said that to find the relationship between two items, you must find a relationship that exists or what combines those two variables that have been given the question. Now we are seeing that the number of hours taught. To get this total cost, we base on the number of hours. If let's say someone teaches more hours, you find the total cost is also increasing. As you can see, for the 200 hours, we spent 3.7, but when it proceeded to 240, we paid more, which brought in the 4.1. It is either increasing or decreasing. You may find that when the number of hours are increasing, the costs are reducing. It's also possible. So our main emphasis is not how they are increasing, but we want to find out how related are they. Is it that when the number of hours are increasing, we expected the total cost to increase, or is it that the number of hours when they are increasing, we expect a reduction in the total cost? That's what we want to know. That's the relationship between the two variables. And as we say, the number of hours in these terms, they are not changing. For them, they are fixed. It means they are independent variables. Then these overhead costs, for them, they are dependent because they are dependent variables because their cost depends on the number of hours that have been taught. So for us, what we want to know, is it at a fixed rate? Is it that when the number of hours are increasing, the total cost, they are not changing? It means they are remaining fixed, or they are variable in nature. That's what we want to find out. And that's the motive of this method, or the main emphasis of this linear regression. It's for it to find out the relationship between, and this relationship, as we said, it follows the equation of a straight line. So when you are applying this, you make sure we are going to be applying the cost function. Okay, having understood that, part B says, explain any two causes of over and under absorption of overheads. These ones, we are going to see them, but to give you a brief idea so that by the time we reach the other side, you'll be having something in mind. Here, when you're talking of over and under absorption of overheads, the main emphasis is, if let's say you had budgeted output levels and you are said at a certain production, I'm expecting to produce 10,000 units. But when the actual production takes place, you find that you have produced 12,000 units instead of the 10,000 units you had budgeted for. And we've used the same cost, because when you set output, you have also to set the total cost that you are going to use in the production. of those units. And you find that you've produced 10, 11, 12,000 units using the same cost. It means that we have got a gain. We had budgeted for less, but we've got more. It means that will give us an over absorption of overheads. And that over absorption will be added back to the profit to provide for us the gross income. And that's the accounting treatment of over absorption. On the other way, when we budgeted produce 10,000 units at a given cost, we find that instead of producing 10,000, we have produced 9,000 units. So that difference or that loss in units between what we have planned and what we have actually produced is what we call the under absorption of overhead. That we have used the same cost, but instead of producing exactly what we wanted, we produced less. So it means that will be a loss in that way. It will be a loss, so it will be deducted from the figure of the gross profit in the income statement or profit and loss account. And that's the accounting treatment of under recovery of overheads or under overheads. Absorption and the overhead absorption and the overhead recovery, they are the same. So don't get confused there when they use those two words interchangeably. So we shall see them as we go to the next videos, but let's concentrate this linear regression and we see how we can sort it out. So we got the solution. The solution is going to be, we said it May 2019. This is May. I had stipulated as I said that this equation, it follows the equation of a straight line, and we say the equation of a straight line is y equal to mx plus c. As we saw in the previous videos, that we said that one can be related to the y equal to bx plus a, and in these terms we have our y as the total costs, our b as the variable cost per unit, our x as the level of activity or the level of output, and our a as the fixed costs. But this one, this linear regression goes ahead and gives us the variables. We are supposed to be able to determine the variable and the variables we've given in the question. And here we are saying, we are the independent, as we said, independent. Here we are saying that our x, which is the level of output or the level of activity, and this time it is number of hours. That's why it is better here when you are stating the x, don't say that it is a level of output. No, sometimes you may find that they have not given you output or units produced, and they are giving you number of hours, as we've seen in this question. They are using number of hours. So here x is our level of activity or the activity level. So our x is constant. Why? Because for it doesn't depend on the cost of hours we are incurring in the production or the number of hours we are using in teaching. They are fixed, but what only changes is the cost we are incurring. That's why we are saying that level of activity, and that is the number of hours for them, that is our x is independent, and our y is the dependent variable. Reason, this is depending on the number of hours we've incurred. So we can proceed with our calculations, and I had got for you here, this is the linear regression method that we use when we want to determine these variables, because what we are interested in is determining the fixed costs and the variable cost. And we said that the only relationship between those two costs is either when the costs are increasing, may remain fixed. When the number of hours are increasing, the total cost may remain fixed or may be variable. And that's the relationship we are looking at. That's why here we are trying to find our A, and our A, we said it is the fixed cost. This is how we determine it. And our B, this is the variable cost per unit, because we want to first get the variable cost per unit, then we multiply by the level of output. So this will be the info determining our B. In other books, you may find that they are using this. They are just making this A for determine the A, our A, not using this formula, but they are using this. They are just making this A the subject of the formula, whereby you just take the bx from this side, it will be y minus bx, which will be A. But in this sense, our y, it is now the total cost. Meaning, the reason why they get it like that is because here we are using all the variables being given in the question, all of these variables. So what we want to find out is that we want to get one number that we can use to give us the value for A. And the only way we can get that one number is adding this number, the level of activity and the overhead costs, we get their average. When we get that midpoint, it can help us to determine the rest. But the only way you can get this A is after finding the B, because it will be the total cost with less the variable costs. And this will say this B is the total variable cost. This B is the variable cost per unit, multiply it by the level of output, and it will be the variable costs. So here we are taking the total cost minus the variable. The whole of this is variable cost. But to get this total of activity, you sum up this and we divide. Since we want to use only one number, we divide it by their number. And this n will be the number of observations we are given. And the observations were the 200, 240 up to 320. Add up these ones and these ones, we get there. We can even do it from here. We get the total here. We say sum of this, close the bracket, let's enter. This is our total. And to get this one, you say cosine sum. We are summing up, meaning we are adding this up to that. Close the bracket, press enter. And this is our total cost. When we see these ones, this is our total. For this y, because we say this is the y, the total will be this. Then we divide by the number. There are how many? There are 1, 2, 3, 4, 5. There are 5. Those are the number of months they gave us. There are 5. So you divide this one by 5. But when you are using this, you first find our B. And to get our B is by getting these variables, each of these variables you are seeing here. B says it is n, and the n we say that those are the number of observations into summation x, y. These are variable. When you see this I means number of observations that we are summing up from I1 to the last I, that is 5. Our I, those are the numbers here we are counting, the number of observations, 1, 2, 3, 4, 5. So we get the summation from the first one to the last one. That's what this means, that we are multiplying x I and y I. This is the x I and this is the y I. It means we are multiplying this times this and this until we finish the whole number of observations they have given us, and that will be here. So to get our, and it proceeds and says minus summation xi. Summation x from this I, this is 1 up to the number of observations. We say this I, let me put it here, that I is equaling to the number of observations. It means it's from 1 to up to our n. And our n, we said our n is the number of observations. So I hope you don't get confused from there. This I says from 1 to up to, you reach the number of observations we have, and summation x, and we said when you're summing x, summing y, you sum all of this. This is the total we've got. So we get the summation x squared. Since we can't put x squared here, it is the same as saying x times x. We are repeating the same number. That's how we get the squared figure. And here we get, this is summation x bracket squared. So I hope you can master that formula and we can proceed. We said these ones they gave us, these are the, I've removed these ones from here. We don't need these months because we are not use them. We just want these figures. They are the ones that are going to help us to compute the rest. So this is where I got these figures, and you see they are the same like the way I've posted them here. So we are going to just proceed with our scenario, and we said to get our xy, it will be this x1i times y1i. It will be this multiplied by this one, and we press enter, it will be giving us that. But remember, here we have these 3 zeros up. These are in shillings. When you multiply number of hours times the you getting shillings. And here it is XX, and it means you are getting hours because it is hours times hours. So here it is equal sign. You can just drag like this, you get for the rest here, or you can just double click there and you get the rest. We said we have also to get the summation xy, as they said here, it is summation xy. So we have to get also the total here. It will be equal sign sum. This one, we are starting from there up to there. Let's enter. That will give us that, and we shall get also the x squared. This is our x squared, and our x squared in this scenario is this multiplied by the same figure. So it will be giving 400,000. When you get 200 squared, you'll be getting 400,000, 40,000. Can double click here and you get the rest there. We get also the total, because here in the question it says summation this, and we are summing the x squared. It will be sum of this up to the last one. Let's enter and make them a bit broad. Sorry, assign sum from here up to here. Sorry, cosine sum from here up to here. Try to make this one a bit broad. Here we've defined all the components that are within this formula. So we've got the totals, and we have our n, and we said in this time our n equal to 5. Our n is 5, so we can substitute in this formula of ours, and we try to get, can put this one in, can fill in put in the borders. So we can come here and say we are getting now our b, and we said our b is equaling to, this is the variable cost per unit, to be equaling to the n, and we know our n is 5, multiply it by our summation x y. This is our summation x y, but allow me put these whole figures so that you can be able to follow. 240, and we are saying minus, you can put these ones in brackets so that you can be able to follow up. You can look up even this one and open another bracket here. We said we are lessing. Now it will be summation x. Our summation x is this one, which is 1320. Multiply it by the summation y, and our summation y is 22300. So we can look up even that, and we put it is over. We said it is over. So it is over n. Our n is 5. Multiply it by our summation x squared, and our summation x squared is 357676000. So this one you can put also this in the bracket, but we are seeing this 5. We are seeing that this 5 is multiplying only this box. It means this, the whole of this will be in the bracket, because in the formula here you are saying that this 5 is not multiplying the whole of everything. It is just multiplying this x squared, summation x squared. So we get minus, we put it even this one in bracket. It will be our summation x, and our summation x was 1320. But instead of saying squared, because there is no, you can put it here, we shall just say multiply it by the same figure, 320. That's why I want you guys to be following, and that's how it's going to be. Can I highlight this one? That will make it a bit bold. you'll be able to see. Let me increase also the font size. Hope you can be able to see there. Then we can try to find our B. Since we are using Excel, just say B equals, and put it, we can calculate it from here. We said it is 5. It is 5 multiplied by, I'm going to be writing each of them separate. To be cosine 5 multiplied by this, which will be this one. Press enter. Then let me write this one the other side. Then the preceding, it will be this multiplied by this. It will be that. So allow me also this one, I write it down here. It is cosine 5 multiplied by this, and will be giving us that. And this one, I'm going to put it here. So it will be cosine this multiplied with the same, because it is x squared. So it is this minus this, it is this minus this. So I can put it here, and we are saying cosine this minus this one. Press enter, and over this minus this. So it will be cosine this minus this one. So the final answer is a division. We are dividing the upper one over the lower one. So it will be this divided by this. So we can put that one. We say our B, our final B will be in this one. Let me put it there. It is this cosine this divided by this, which gave us 15. But remember, this 15, we had the zeros up. So don't forget that we had these zeros up here. If you had included these zeros within here, here and here, because and don't forget the zeros. So when you get this, you multiply by these zeros by 10,000, by 1,000. So that will be getting 15,000. Since we excluded those zeros, we can maintain it to 15 so that you don't get confused. So we get our B. Since we've got our B, we can be able to get our A. And our A, we said it is the total summation Y minus B. So our summation Y is this. Can put it here. It is 22300 minus. But remember, this one is divided by N, divided by 5. The answer you get, less minus our B. Let me put this one in bracket. Our B is 15. We multiply it by our total x over n, and total x over n is this. It should be 11320 divided by 5. Hope you can be able to follow from there, and that's how we get our A. So we can either say from here that we can put our A here. Our A is equal to this. Say the equal sign, can determine it from here. Let's put it down here. It is equal sign this. I'm getting this divided by 5. Give us that. Then what is 15? This is 15 multiplied. You can put a bracket. Don't forget to start with an equal sign. Can put a bracket, and we say it is this divided by 5. Close the bracket and we press enter. It will be giving us this. So it is this minus this. So to get our A will be equaling to this minus this. So we shall be having 500. That's 500. So when we've got that, we can go ahead and say we form the equation, and the equation is following this. It is y equal to b plus a. We just substitute in the variables. We say the a is 500, the b is 15. Then we get our x, and these variables, they are the ones we are looking at. We are getting, now this will be the equation of a straight line that comes from the relationship between those two variables. And we said it is 15, but don't forget that we had our whatever, we had our thousands, then plus, we can say plus our 500. That is the equation of, this is the equation of this equation this is the regulation line that connects between these items they were given us, between the independent and the dependent variable. And the question says that we estimate the overhead cost when 350 hours are taught. So we are going to find what will be the total cost. We can come here and we say when, because we said the number of hours, these are the x. It means when x equal to 350. So what we can just do from here, it is substituting where you see x, you put 350 to get our y. So our y will be equal to y, sorry, I don't want that, I just want the y. Y will be equal to this equal sign, which is 15 multiplied by the 350. Then we add whatever we get, we add the 500. It is this. It will be 5 million. It is 5,750. But don't forget that we had our 3 zeros. So when you get this, you multiply it by 10,000 by 1,000 to get 5 million. So our total overhead cost will be equal to 5,750,000, and that's how we get that. But we get that one from multiplying 5 cosine 5 750 multiplied 1,000, because these figures are in thousand, the total cost in thousand, so it will be giving us that, and this will be our y. So when you've got that, we can now say we've calculated that and we are done with it. Can try also to make these ones a bit broad, and there we are done. That's how we use the regulation line to compute that. Thank you for watching. We are going to how we can allocate and apportion these overheads. Since we have separated them, now we want to look at how we can be able to apportion these overheads to the production, how we can allocate them to the service departments, and all of that. So allow me stop here for today, and we'll link up in the next videos talking about how we can apportion them. Thank you for watching.